Now what we will try to do is we will try to discuss SF516 we will try to do, which is going to talk about subsequent events. Which is going to talk about subsequent events. So before we could understand what are subsequent events, first we need to understand a few dates. Number one, date of financial statements. Date of financial statement means the date of the balance sheet, the period ending on the financial year, nothing but date of the balance sheet. Date of approval of financial statements. Date of approval of financial statements, which means if you literally look at the definition, they will say the date on which the people with recognized authority have taken the responsibility for the financial statements. If I put it in simple terms, the date on which the board of directors sign the financial statements and take the responsibility for the financial statements, that we are going to call it as date of approval of the financial statements. Thereafter, date of auditor's report. What is date of auditor's report? Date on which auditor mentions the date of auditor's report. Between date of approval of financial statements and date of auditor's report, you have to be a bit careful. The date of auditor's report cannot be earlier than the date of approval of the financial statements. The date of auditor's report should not be earlier than the date of approval of the financial statements. Quite logical. First, let the management take the responsibility, then you take the responsibility for your auditor's report. So, date of auditor's report should not be earlier than the date of approval of the financial statements. And then finally, date of issue of the financial statements. What is it? See why the managements are getting their financial statements prepared and audited, because they want to issue. To whom they want to issue? Stakeholders. A bunch of stakeholders are there. Many people are there. So the date on which the financial statements are made available to that stakeholders, that will be the date of issue of the financial statements. So 4 dates I have. What are they? Date of the balance sheet, date of approval of the financial statements, date of auditor's report, date of issue of the financial statements. Now, why I have to do all this is because we are going to discuss something called subsequent events. See, subsequent events, we are aware from the accounting standards. So, what is the meaning of subsequent events from the accounting standards perspective? Those events which are occurring between the date of the financial statements and the date of the auditors, so not auditors, date of approval of the financial statements, right? So that we call it as subsequent events. So that is the definition of subsequent events as per accounting standards. And depending on the accounting standards, these events, subsequent events could be adjusting events or non-adjusting events. If they are adjusting events, they are required to be adjusted in the financial statements. If they are non-adjusting events, they are required to be given as a disclosure. So this is what we know regarding accounting. See, in the accounting standards, they spoke about subsequent events from the accounting perspective, what impact it will have on the financial statements. But even we as auditors, from our audit perspective, also we might sometimes get to know about some subsequent events. So, from the auditing point of view, what is the meaning of the term subsequent events? They say that SF560 specifically says that subsequent events are those events, as per SF560. Subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report. The date of financial statements and auditor's report. Let us say, for example, 31st of March of 2026. That is from the next day, 1st April 2026. And date of auditor's report. Auditor will sign the audit report now. Let us say auditor signed the audit report on 20th of April 2026. Those events which are occurring between the date of the financial statements and date of auditor's report. Some events should have happened between these dates, but the fact came to auditor's knowledge after the date of auditor's report. Some event has happened between the date of the financial statements and the date of auditor's report, but the fact got to auditor's knowledge. But the fact came to auditor's knowledge when after the date of auditor's report. Then only we want guidance. Then only we want guidance. If auditor got to know about some event before the date of auditor's report only, there is no requirement of any standard. Why? Because if you got to know about event before the date of auditor's report only, whatever action you want to take it through the auditor's report. When we will land into trouble? After the date of auditor's report. We have signed the audit report, we have mentioned it. After that, if you got to know about the subsequent event, then the trouble is going to come. Clear? So that's why subsequent events are those events. As per SA560, subsequent events are those events which are occurring between the date of the financial statements and the date of auditor's report. And the fact came to auditor's knowledge after the date of auditor's report. Right? So now, what auditor should do? In case if you got to know about subsequent event after the date of auditor's report, what will be your responsibilities? That's what the whole standard is going to talk about. But before that, what is the objective? With what objective the standard has been given? So if you read the objectives of SA560, they say that as an auditor, you need to obtain sufficient and appropriate audit evidence. whether subsequent events that require adjustment have been properly reflected. So now they are asking to check the compliance with accounting standards. As per accounting standards, if you've got to know about any subsequent events, whether all that subsequent events are properly adjusted in the financial statements or not. First, check the compliance with the accounting standards. And in case you got to know about subsequent event after the date of auditor's report. Now, second objective is talking from auditing perspective. First objective is accounting perspective. Second objective, in case if you got to know subsequent event after the date of auditor's report, how you have to respond. Respond appropriately, they say. How to respond also, they will try to say it in the same standard only. So two objectives, whether subsequent events that require adjustment in the financial statements have been properly reflected. Second objective, respond appropriately in case if you got to know about subsequent event after the date of auditor's report. Respond appropriately. How to respond appropriately? That's what we are going to see now. Sir, before we can respond appropriately, coming to the first objective, sir, if there are any subsequent events as per accounting standards, we need to check whether they are properly reflected or not. But first we should know whether there are subsequent events or not. Before we can check whether subsequent events are properly reflected in the financial statements or not, first we need to know whether there are subsequent events are there or not. So what audit procedures you have to perform to identify whether there are any subsequent events there or not, whether any subsequent exist or not. To know it, what audit procedures you will perform. So these audit procedures you will perform, simply they say that try to obtain understanding of management procedures to identify subsequent events, which means even before you as an auditor, management is having the primary responsibility to identify subsequent events because they are required to prepare financial statements, they are required to comply with accounting standards. So before you, auditor management is having the responsibility to identify subsequent events. First, go and ask the management what process they are following to identify the subsequent events. First, ask the process. Then inquire management, and those are with guidance only. Directly go and inquire. Sir, you have followed that process now. Did you identify any subsequent events? So understand the process followed by the management, then inquire them only. Sir, did you find out any subsequent events? And also, you put some extra efforts, like read the minutes of the board of directors and shareholders meeting. So especially which have happened after the balance sheet date, if any board of directors meeting has happened, shareholders meeting has happened, read the minutes of that board of directors and shareholders meeting. And read the interim financial statements. Before you can complete the audit, if the interim financial statements are ready, read the interim financial statements and even obtain written representations also that management has disclosed to the auditor all subsequent events. Five simple procedure to identify subsequent events. What are they? Understand the process being followed by the management to identify the subsequent events. Next, inquiry of the management and those chargeable guidance. Read the minutes of the board of directors or shareholders, especially after the date of auditor's report. Read the interim financial statements and then finally obtain the written presentation. By that, you will get to know subsequent events. Now, you will check whether these subsequent events are adjusting, non-adjusting, and accordingly, accounting treatment has been done or not. First objective done. Now, we will come to the second objective. What is second objective? You have to respond appropriately in case if you got to know the subsequent event after the date of auditor's report. So now, how to respond appropriately? They have told that responsibilities in two scenarios. There could be two kinds of scenarios. Two kinds of scenarios. Case one, you got to know subsequent event after the date of auditor's report. Then only subsequent event. Some event has happened between the date of the financial statements and the date of auditor's report, and you got to know about it after the date of auditor's report, but before financial statements are issued. By the time you got to know about subsequent events, you signed audit report, but financial statements are not issued. They have not yet fallen into the hands of the stakeholders. Case one. Case two. By the time you got to know about the subsequent events, financial statements are already issued, gone. They have already gone to the stakeholders. Which one is more problematic scenario? Second case is problematic scenario. Why? Because by the time you got to know about subsequent events, the financial statements have already reached the stakeholders. So first we'll come to the first case. What will be your responsibilities in case of case one? In case if you got to know about subsequent event after the date of auditor's report, but before the issue of financial statements, what it should do? The moment you got to know about subsequent event, three simple things. Go and discuss the matter with the management. Go and discuss the matter with management. So I got to know about the subsequent event. As a part of that discussion, determine whether financial statements need amendment or not. If you do the discussion, you will get to know is that need amendment because of that thing we are required to amend it or not amend it. So discuss the matter with the management. As a part of that discussion, determine whether financial statements need amendment. In case if you have decided amendment is necessary. In case if you have decided amendment is necessary. Yes, amendment is required. Then you inquire whether management is ready to amend the financial statements or not. You identify subsequent event, discuss the management, determine that amendment is necessary. Ask management, are they ready to amend the financial statements or not? When you inquire the management whether they are ready to amend the financial statements or not, two outcomes could be possible. What is it? Number one, management agrees to amend the financial statements. Management agrees to amend the financial statements. If the management agreed to amend the financial statements, what we will do? We will perform audit procedures. We will not blindly believe. We will check whether management will perform audit procedures regarding the amendment, and also we will try to obtain audit evidence regarding the amendment. Yes or no? So perform audit procedures relating to amendment, and also what? Obtain sufficient and appropriate audit evidence. So if the management has done the amendment properly, am I required to modify the opinion? But here there is a problem. Am I required to modify the opinion? I am not required to modify the opinion, but there is one problem. Let us say initially management approved the financial statements on, listen carefully, 15th of May 2026. Management approved the financial statements. I signed my audit report on 20th of May 2026. After that, subsequent event was identified. When the subsequent event was identified, now management has amended the financial statements. When they amend the financial statements, let us say for example, they have amended the financial statements and they will approve it once again. No. And they will approve it once again or not? Yes, they will approve the financial statements. Since they have done the amendment properly, I'm not required to modify my opinion. I'm not required to modify my opinion. My old audit report only will remain relevant. But there is one problem. What is it? The newly amended financial statements contain an audit date of 25th of May. But my audit report will contain a date of 20th of May 2026. So it should not happen. It should not happen. And what they say, date of auditor's report should not be earlier than the date of approval of financial statements. But here it is happening now. Here it is happening, right? So now what they say here is they ask you to do two things. One of the two things they will ask you to do. I have given it at the end here. So they will ask you to do one of the two things. Impact on the auditor's report. In this case, how impact will be there? If they have amended the financial statements, no impact on opinion. But this date conflict is coming now. So because of this date conflict, some actions you are required to take. Sir, what action I am required to take? You do one thing. Amend the report to include the additional date, dual dating. What you do? Old audit report, you keep it intact. In that original date, you have mentioned 20th of May. Example, link it with the example. 20th of May, date is already there. You add one more date below. You add one more date below and mention the date as 25th. Now, today they are amending now. Today they have approved now. Add that one more date. And clearly indicate in your responsibilities that you performed audit procedures, your audit procedures are relevant only till 20th. But you mentioned one more date, no. That date is relevant only for performing audit procedures on the amendment portion only. You performed audit procedures, complete audit you are done till 20th. But if you mention 25th, people might feel that you have performed audit procedures till 25th. No. So clearly explain that 25th of May, that date you have mentioned, that date is relevant only for audit procedures performed on amendment. Dual dating. Able to understand? One option. So amend the report to include the additional date to indicate that auditor's procedures are restricted only to the amendment as described in the relevant date. That is one option. Dual dating. Or else you do one thing. Give a new audit report. Give a new audit report. Saying what? Give a new audit report, and in that new audit report, don't change any opinion or anything. So what you do is you include an emphasis of matter or other matter paragraph. Give a new audit report. You don't want to do dual dating. You give a new audit report. Mention the current date only, 25th of May. Mentioning that date, give a new audit report. But this, once again, if you mention a single date, once again confusion will come. People will think that you have performed audit procedures till 25th of May, but till 25th of May you have performed audit procedures only on amendment. On all remaining aspects, your audit procedures were ended on 20th of May only. That paragraph you keep it in emphasis of matter or other matter paragraph. That's what the other option. Provide a new audit report including an emphasis of matter or other matter paragraph conveying audit procedures on subsequent events are restricted only to amendment. Two options. So in case this all when it will happen when the management has amended financial statements. So if the management amended financial statements, perform audit procedures on the amendment, try to obtain sufficient and appropriate evidence regarding amendment. And there will be no impact on the opinion. Agreed, understood. But there is a date issue there. So to overcome that date issue, one of the two options you have to do. Either do the dual dating and clearly mention that dual dating, that next date, second date, whatever you have mentioned, that date is restricted only for performing audit procedures on amendment. Other case, in the other case, what you do is if you don't want to confuse the readers by giving the dual dating and all, give a new audit report, give a new date only, but explain in the emphasis or other matter paragraph that new date is relevant, that date, till that date you performed audit procedures only on amendment, remaining all other areas audit procedures ended on 20th. Understood? So this is one case. Now the other case is that, sir, what if the management does not amend the financial statements? Management does not amend the financial statements. I found a subsequent event, discussed with the management, and as a part of the discussion, we determined the financial statements need amendment, but management is saying, I will not amend the financial statements. Then what you should do? Here also, there could be two cases. Case one, you signed the audit report, but audit report is not given to the management. Lucky fellow you are. You signed the audit report today. You thought tomorrow I will come to the office and I will give the audit report. But before that only you got to know subsequent event. I asked the management to amend the financial statements. They said no. So you need not worry. Why? Why? Because you have not yet given the audit report. Then what you will do? Tear that audit report, throw in the dustbin, give a new audit report containing a modified opinion. Lucky you there. Then what will be the other case? If you have already given the audit report to the management, then what you should do? If the audit report is already given to the management, first thing what you should do is instruct the management not to circulate the audit report. First thing what you should do, instruct the management not to circulate the auditor's report. Without listening to you, if they have already circulated the auditor's report, then what you should do? Take appropriate action to stop the people from relying on the auditor's report. What you will do? Take appropriate action to stop the people from relying on the auditor's report. It could be any action. Either you can give a press release, whatever it is, take appropriate action to stop the people from relying on the auditor's report. Then finally, anyhow, you will give a modified opinion, you give a new audit report to the management and ask the management to circulate the new audit report. Understood? So this will be the case in case you got to know about subsequent event before the after the date of auditor's report, but before the issue of financial statements. We have one more case. What is that one more case? What if you got to know about subsequent event? By the time you got to know about subsequent event, the financial statements are already issued. So here also what you will do, sir. Today you got to know subsequent event, but by the time you got to know the financial statements are already issued. So what you should do? Here also say, first we will discuss the matter with the management. Determine, as a part of the discussion, determine whether financial statements need amendment. If you have decided financial statements need amendment, you will inquire whether management will amend or not. But before doing it, the moment you have decided that financial statements need an amendment, but by now the point should have already come to your mind. Since financial statements need amendment, whatever audit report which is already circulated, whatever financial statements which are already circulated, they are not correct. They have already circulated, no. So as a part of the discussion, the moment you determine that financial statements need amendment, the thing which should come to your mind is if the financial statements need amendment, the financial statements which are already circulated, the audit report which is already circulated is not. So first what you should do, go and ask the management, sir, you please take appropriate action to stop the people from relying on auditor's report and financial statements. We'll go and request the management to take appropriate action. If management has not taken appropriate action, then what will happen? The standard says auditor himself has to take appropriate action. Auditor himself has to take appropriate action. So either the auditor or the management, someone should take an appropriate action to stop the people from relying on the auditor's report and financial statements. Clear? Next. Okay. Then now inquire the management. Sir, are you ready to amend the financial statements? If you have determined that financial statements need amendment, inquire the management whether they are ready to amend the financial statements. Now, here also two outcomes could be possible. What are the two outcomes? Management amend the financial statements. Well and good. Perform audit procedures on the amendment. Try to obtain sufficient and appropriate evidence. Then will there be any impact on the opinion? There will be no impact on the opinion because management amended. No. These amended financial statements will be once again circulated. So that's why what they have told is give a new audit report. Give a new audit report and in that new audit report, what you do is there will be no impact on the opinion, but in that new audit report, add an emphasis of matter paragraph or other matter paragraph. And in that emphasis of matter or other matter paragraph, explain what is the difference between previously issued financial statements and the now given financial statements. The effect of the amendment, you try to explain it in the emphasis of matter or other matter paragraph. Clear? So that's what they say. If the management amends the financial statements, you will perform audit procedures, you will obtain the evidence. Thereafter, you will give a new audit report, no impact on the opinion, but you are required to include an emphasis or other matter paragraph. Highlight the effect of amendment. What if the management does not amend the financial statements? Then auditor shall give a new audit report containing a modified opinion, either a qualified or adverse opinion he will give depending on materiality and pervasiveness. Reason anyhow you will try to explain it in basis for qualified or adverse opinion. Here also are you required to use any emphasis of matter or other matter paragraph? Not required. Here there is no need. Why? Because reason anyhow we are explaining in the basis for qualified or adverse opinion paragraph. Clear? Right. So this is what regarding SA 560 which we have completed. Now we will come to SA 570 which is talking about going concern. SA 570 which is going to talk about going concern. So let us try to understand what is this going concern assumption. See, as we all are aware, going concern is one of the fundamental accounting assumption. What is the meaning of the term going concern? Why we call it as an assumption? Because we generally assume, when I say going concern, assumption is appropriate. What do I mean by that is, we are assuming that entity will continue for the foreseeable future. What is that foreseeable future? Practically speaking, we can't foresee any future. We will not be able to foresee any future. But when it comes to business terms and all, we can make one reliable estimate. That also for the coming 1 year only we can make reliable estimate. Beyond that, no one can look into the future. So the assumption that entity will continue in the future. It will not either close down. There is not even circumstances which will make the company close down. It is capable. It is having the capability to continue for the next 1 year. Even the owners doesn't have any intention to liquidate. So that is what the meaning of going concern assumption being valid. When I say going concern assumption is valid, it is an assessment. It is an assumption that entity will continue for the foreseeable future. The owners don't have any intention to liquidate, and even circumstances also doesn't require entity to liquidate. It is all sounding good. So now, what is the impact of this going concern assumption is, under financial statements, in the financial statements, we value the fixed assets on historical cost basis. We value fixed assets on historical cost basis. What is the current market prices and all becomes irrelevant. So in the history, we have incurred some cost. On that historical cost basis only, we continue to value. But current assets, we follow NRV. Why? Because what is the differential? Why the logic behind that is, in case if it is a current asset, we hold it with the intention of selling it immediately. We are holding the stock. What is the intention of holding the stock? Selling it. If tomorrow someone comes to our business, we will sell it. But fixed assets, we will not hold it with the intention of selling. We will hold it for the purpose of using it in the ordinary course of business. So since we don't hold fixed assets with any intention to liquidate, we continue to value our fixed assets on historical cost basis. But this thing you can do only till the time going concern assumption is valid. This continuation of this valuation of fixed assets on historical cost basis, this we call it as going concern basis of accounting. So this historical basis of valuation, you can do it only till the time going concern assumption is valid. The moment the going concern assumption becomes invalid, that means what? What do you mean by going concern assumption becoming invalid? Entity will not continue for the foreseeable future. Entity will not continue for the foreseeable future. Either the management themselves want to liquidate the company in the coming 1 year, or the circumstances of the company are so bad that they can't continue for the next 1 year, whatever may be the reason. If the going concern assumption is invalid, the company cannot follow historical cost basis of valuation. They have to prepare their financial statements on liquidation basis. On what basis they have to prepare financial statements? Liquidation basis, they have to prepare the financial statements. What do you mean by liquidation basis of preparation of financial statements? You have to value all your assets, all your liabilities as if you are selling it. You have to determine the net realizable value. You have to start recognizing accounts and liabilities at NRV in your balance sheet, and the difference between NRV and the cost, the carrying value and the NRV, whatever difference is there, the difference has to be taken into the statement of P&L. That is what the meaning of liquidation basis. And the moment going concern assumption becomes invalid, the companies are required to prepare the financial statements on liquidation basis. So tell me what kind of impact a going concern is going to have? Will it have only a material impact or pervasive impact? Going concern assumption is going to have a pervasive impact on the financial statements. Now, having said that, who is responsible for making going concern assessment regarding entity's ability to continue as a going concern? Management. This even we have told you in the earlier part also. It is the responsibility of the management to make an assessment regarding entity's ability to continue as a going concern. Whether they will continue for the next 1 year or circumstances require them to shut down. So this going concern assumption validity has to be checked by management. And the management while making their assessment whether going concern is valid or not, while making their assessment, they do it after considering various factors. After considering various factors, they will determine whether going concern assumption is valid or not. So, what and all are the factors like degree of uncertainty associated with outcome of an event or condition, like pending cases, some pending cases going on, uncertainty. Sometimes a company might be fighting such kind of litigations where by chance if they lose the case, they might have to shut down. So that pending cases they will consider. And even size and complexity of the entity they will consider. The nature and condition of its business, what is the current state of business that they will consider. And the degree to which it is affected by external factors. Sometimes even external factors also will have an impact on the company's future. Like because of Iran war situation and all recently, tile manufacturing companies in the Gujarat have been shut down because they are not getting the raw material. So, like that, we have issues. So, after considering all these factors, external factors, internal factors, nature of business, complexity of the business, various factors they will consider, and finally they will decide whether going concern is valid or not. This is whose responsibility? Management's responsibility. Then, what auditor will do with regard to going concern? What auditor will do? The auditor will try to obtain sufficient and appropriate audit evidence regarding the management's assessment of going concern. If the management has told going concern assumption is valid, whether really going concern assumption is valid for this client or not, the auditor will try to obtain sufficient and appropriate audit evidence. So the objective of the auditor is to obtain sufficient and appropriate audit evidence regarding the appropriateness of management's use of going concern assumption. Same sentence you have to write. If they ask you objective of SF570. So the objective of the SF570 is what? To obtain sufficient and appropriate audit evidence regarding the appropriateness of management's use of going concern assumption. So whatever management's assessment is there regarding use of going concern assumption, whether it is appropriate or not, you will try to obtain sufficient and appropriate audit evidence. This is your responsibility. Okay. Next. Coming to the standard now. Sir, you need to obtain sufficient and appropriate audit evidence regarding going concern. Just now you have told us whether management's use of going concern assumption is appropriate or not. You need to obtain audit evidence. And how to obtain that audit evidence? Audit procedures you have to perform. Sir, what kind of audit procedures I have to perform to obtain sufficient and appropriate audit evidence regarding management's use of the going concern assumption? Here also, like in SA 501, they have divided the procedures into two categories. Risk assessment procedures. First, to perform the procedures to identify whether there is any risk of material in the statement. If you find something is wrong, then only you perform further audit procedures. If nothing is wrong, you can stop with risk assessment procedures. The same thing they will try to convey it in a different way. So what procedures they will try to say here is, as an auditor, you try to perform procedures to identify whether there are any events or conditions that cast a significant doubt on entity's ability to continue as a going concern. What they will say? You try to perform audit procedures to identify whether there are any events or conditions that create a significant doubt on entity's ability to continue as a going concern. So simply they are asking you to identify whether there are any events which is giving you a doubt that there could be a problem of going concern. Simply risk of material misstatement only, no chance. We are basically trying to find out the chance whether there is any event or condition which will create a doubt on going concern. Now the question will come, sir, what kind of events or conditions will create a doubt to the auditor regarding entity's ability to continue as a going concern? You need not search for anywhere. The standard itself has given that events or conditions in the form of indicators. So, and they have divided that indicators into three categories: financial indicators, operating indicators, other indicators. Simply for risk assessment procedures, they are asking you to look for any of these indicators are present. Any of these indicators that create a doubt regarding entities ability regarding going concern, and whether any of this financial, operating, or other indicators are there, they are asking you to find it out. So what are the examples of the indicators? Like if you take the financial indicator, net liability position, the company is always having a net liability position, liabilities are growing. Borrowings approaching maturity, company has taken borrowings in the past. In the coming 1 year, they are approaching maturity. The company is having not any reliable prospects to repay. And negative cash flows, continuously they are generating the negative cash flows. Withdrawal of financial support, their creditors and dollars, earlier they used to give credit period, now they are saying cash on delivery. And also adverse financial ratios are having a very bad financial ratios. Similarly, operating indicators, management themselves want to liquidate. Management itself is intending to liquidate the business. Loss of key management, some of the key management they have lost. Labor difficulties, they are unable to find the labor who are ready to work for their factories. Shortage of the supplies, what are the raw material that you want for your business, it is in shortage. And successful competitor, all of a sudden the successful competitor will come, will wipe out the entire industry. Next, other indicators, non-compliance as well, laws and regulations. Like you take the example of bank. In case if the bank does not comply with CRR or SLR, what will happen? RBI will cancel their license. That's all. They have to go out of the business. And pending cases, sometimes because of the pending cases also you might be thrown out of the business. Uninsured catastrophes. Some calamities have happened, but you have not taken the insurance. Fire accident happened, 90% of the factory burnt. Lucky fellow, you don't have insurance policy also. Gone, shut down your business, go to and changes in the laws and regulations. Sometimes sudden changes in the laws and regulations will happen, because of which you might be going out of the business. Crypto, recently crypto industries are facing that struggle in India. The government has discouraged the crypto to a maximum by imposing the various taxes. Many cryptocurrency brokers have left our country. Clear? So these are all you basically require to find any of these indicators are there. As a part of your audit procedures, you need to find out whether any of these operating, financial, or other indicators are present, which create a doubt regarding entity's ability to continue as a going concern. Sir, you are asking us to find out, but how to find out? You told what are indicators. You are asking us to find out these indicators. How to find out the indicators? Simply, if you read it, by inquiring management. Only one thing you have to do. Simply inquire the management. Management would have already made an assessment regarding going concern. Since they would have already made an assessment regarding going concern, go and ask them, sir, you made the assessment? No. Did you find out any of this financial, operating, or other indicators? If the management has not yet done the assessment, ask them, sir, why you have not yet done the assessment? You should have done it. So why you have not yet done the assessment? Do the assessment and let me know whether you found out any indicators which cast a doubt on entity's ability to continue as a going concern. So simply by inquiring the management, find out whether any events or conditions exist that cast a significant doubt on entity's ability to continue as a going concern. Now, after you have done that, two things could be possible. What are the two things could be possible? Yes, you found events or conditions which cast a doubt regarding entity's ability to continue as a going concern. Other option, you did not find any event or condition that created doubt regarding entity's ability to continue as a going concern. If you did not find any event or condition which created doubt regarding entity's ability to continue as a going concern, very good, lucky fellow, you have to stop with the risk assessment procedure. Done and dusted. Your procedures will not be there. Your procedures will end with the risk assessment procedures. But in case if you find any event or condition that created doubt regarding entity's ability to continue as a going concern, then you should perform further audit procedures. Sir, what are that further audit procedures? So here we have that further audit procedures. Sir, what are they? So what are that further audit procedures is, number one, in case if the management has not yet done the assessment regarding going concern, first get it done. First, get it done. If the management has not yet done the assessment regarding entity's ability to continue as a going concern, first get the assessment done. Number two, evaluating what are the management's plans for future action. You got to know about some indicator. Sit with the management, evaluate how they are going to tackle this. What are their actions for the future? Try to evaluate. And don't just nod for every action what they are saying. Even check whether they are feasible or not. Management will say n number of things, but everything is not practically feasible, right? So sit with them, understand what kind of actions they're planning for the future, and don't just get the actions and ignore it. Check how far they are feasible, how far they're practicable for implementation. And generally companies will prepare the cash flow forecast for the next 1 year, how their cash flows are going to look like. Cash flow forecast they will prepare. Get the copy of the cash flow forecast, do a proper analysis of the cash flow forecast, that will give you most of the evidence regarding going concern. And when you are analyzing the cash flow forecast, you check the reliability of underlying data. Whatever data they have used for preparing the cash flow forecast, is it reliable or not? And whatever assumptions they have made for the cash flow forecast, are they adequate or not? You have to check it. And whether any additional facts or information become available since the date management has done its assessment. Management did the assessment. Thereafter, you are verifying. In the meantime, any changes have happened which could impact the going concern, inquire it once. Thereafter, requesting written representation, even ask the management to give the written representations regarding that going concern assumption. And even additional procedures like analyzing the cash flow, profit, and other relevant forecasts, analyzing and discussing the entity's latest interim financial statements if they are available, reading the terms of the debentures and loan agreement, whether they have made any default to know it, read the minutes of the meetings of the shareholders and those charged with governance, inquire the entity's legal counsel, particularly regarding pending cases, and check the existence of arrangements with banks. Like if they're saying we have a funding arrangement available and all, check the supporting documents like loan sanction letters and all. Okay, so these are all further audit procedures you will perform. Now, after you have performed all the further audit procedures, you might be left with different scenarios. So you perform risk assessment procedures, you perform further audit procedures. Now, finally, you will have your observations. Now, finally, you will have your findings, right? So those findings could fall under different categories. First one, going concern is valid. After performing all the audit procedures, you felt that going concern assumption is valid. There is no requirement for the entity to close down. Everything is perfectly fine. Will there be any special reporting considerations? No, nothing. No special considerations will be there. Second case, you performed audit procedures, risk assessment, further audit procedures, you performed all that procedures. By performing that audit procedures, you concluded that going concern assumption is invalid. You obtained sufficient and appropriate audit evidence, and you have concluded on the basis of that sufficient and appropriate audit evidence that going concern assumption is invalid. That means you have a concrete evidence that entity will not continue for the next 1 year. Now what you should do? Now what you should do is, the standard says, in case if you found the evidence that going concern assumption is going to be invalid, you need to check whether adequate disclosure has been given in the financial statements by the management or what you should do. So if the going concern assumption is inappropriate, don't immediately jump to the conclusion. So you need to check whether adequate disclosure regarding that inappropriate going concern assumption has been given in the financial statements. Let us say adequate disclosure has been given in the financial statements. What do you mean by giving adequate disclosure here? They should have prepared their financial statements on liquidation basis. They should have charged, they should have recognized all their assets and liabilities at NRV. Differential should have been taken into the statement of P&L. In the notes to accounts, clearly they should have explained that going concern assumption is invalid. So now you tell me if the going concern assumption is invalid and management made the adequate disclosure, do you think is there any need for giving a modified opinion? No. Why? Because financial statements are not materially misstated here. We give modified opinion only when the financial statements are materially misstated. But this is the case where the management is giving adequate disclosure. Where there is a material misstatement, there is no material misstatement. So what opinion you will give? Unmodified. But don't you think this is a matter which is very much fundamental to users' understanding of the financial statements? The matter has been adequately disclosed or presented in the financial statements, but which is very fundamental to users' understanding of the financial statements. Do you think any need for highlighting it? Yes. What you can do? Emphasis of matter paragraph, you can use it. What you can do? Emphasis of matter. So if the going concern is invalid and the management has made adequate disclosure, you need not modify your opinion, give the unmodified opinion and explain about that in the, highlight that in the emphasis of matter paragraph. So what if no adequate disclosure is given? Which means what? Going concern assumption is invalid, but still the company is preparing the financial statements on going concern basis only. Now what you will do? Adverse, directly adverse. Why adverse? You have sufficient and appropriate evidence, and the misstatement is material and also pervasive. Directly give the adverse opinion and explain the reason in the basis for adverse opinion. Is there any need for emphasis of matter paragraph? Not required. There is no need for emphasis of matter paragraph. Okay, so two instances we have to. First one, going concern is invalid. Second case, going concern is invalid. One more typical scenario which could be possible is the auditor, depending on the further audit procedures, depending on the evidence involved, he might conclude that there is a material uncertainty relating to going concern. What the auditor can find out? There is a material uncertainty relating to going concern. typical scenario also could come. Sir, what do you mean by material uncertainty relating to going concern? He is not sure. He's not sure. Not anybody is sure, because whether entity will continue as a going concern or not, that is going to depend on some uncertainty. There is one uncertain event. Depending on the outcome of that uncertain event, entity's going concern will be determined. Like, let us say there is a pending case going on against the company. If the company wins the case, well and good. If the company loses the case, the company has to shut down, and the judgment is going to come in the coming 6 months. Judgment is due for in the next 6 months. Now, whether entity will continue in the future or will not continue in the future, it is uncertain, because it is depending on outcome of that future case, which is under nobody's control. So this typical scenario, we are going to call it as material uncertainty relating to going concern. So whether entity will be able to continue as a going concern or not, we are not able to decide it. Why? Because it is highly uncertain. So this will be a third scenario. If there is a material uncertainty relating to going concern, then what we should do? Here also, they are asking you to check whether there is an adequate disclosure or there is no adequate disclosure. If there is adequate disclosure, sir, what could be adequate disclosure in case if there is a material uncertainty? What could be adequate disclosure is, if there is a material uncertainty, the company should continue to prepare the financial statements on going concern basis only. But in the notes to accounts, they should have clearly explained about that material uncertainty. So management has done the adequate disclosure. They have prepared the financial statements on going concern basis, and that uncertainty also clearly they have explained in a detailed manner without hiding anything. Is there any impact of, is there any consequence of giving a modified opinion? No, you can give a unmodified opinion. But once again, bring the logic. The matter is already presented or disclosed in the financial statements. But this is very much fundamental to users' understanding of the financial statements. As an auditor, you wanted to highlight it. Where you will generally highlight it? Emphasis. You could have done it in the emphasis unless the standard has specifically told something. And here, the standard has specifically mentioned. Standard is specifically telling you, don't highlight in a paragraph called emphasis. Use a separate paragraph with the heading material uncertainty related to going concern. With that heading, use one dedicated paragraph and highlight that material uncertainty in that respective material uncertainty paragraph. In the previous case, they did not say it. That's why we have taken it to emphasis. When the going concern is inappropriate and you want to highlight it, then we have taken to emphasis, because standard did not say anything specifically. But when it comes to material uncertainty, they have specifically told that highlight this information, not in the emphasis. Do it in a separate paragraph called material uncertainty relating to going concern as per SA 570. If they would not have told it here, also we would have done the same thing. Take it to emphasis. But since they have told specifically that highlighted in the emphasis of highlighted in the material uncertainty, we have to do it in the material uncertainty paragraph. This is one case. So what if there is no adequate disclosure regarding material uncertainty? There is a material uncertainty relating to going concern, but no disclosure has been given regarding the material uncertainty relating to going concern. What you should do? Modified opinion. Which kind of modification? Qualified or adverse, depending on materiality and pervasiveness of that uncertainty. You have to give either modified or qualified or adverse. But something should have come to your mind. Should be a disclaimer, no? It is not a availability of audit evidence. We are unable to decide whether material uncertainty, whether the going concern is valid or not. It is a case of non-availability of evidence. We should have given disclaimer. So the correct thing is, why we are giving modified is not because of uncertainty. Because material uncertainty is there, that's why we are not giving modified opinion. We are giving a modified opinion because that material uncertainty was not disclosed, for which we have evidence. No, we have a clear evidence that material uncertainty is there, but it was not disclosed. Because of that reason, we are giving modified. Just because there is a material uncertainty, we are not giving modified. We are giving a modified because there is a material uncertainty, but it was undisclosed. For that, we have evidence that they don't disclose it. So that's why we will give either a qualified or adverse opinion. Okay. One more situation also could be possible. One more last situation also could be possible. What is that? Is management is not sharing their assessment only. Management is not sharing their assessment. I want to determine whether management's assessment regarding entity's ability to continue as a going concern is valid or not. If I have to obtain evidence, first management should share their assessment on what basis they have determined, what workings they have done. They should share it. Management is not willing to share their assessment regarding entities' ability to continue as a going concern. If the management is not willing to share their assessment regarding entities' ability to continue as a going concern, then what action? Now it is a case of non-availability of audit evidence. Now you give a disclaimer. Now you give a what? Disclaimer of opinion. Understood? In the standard, they will say either qualified or disclaimer of opinion, they will say, but in my opinion, always disclosure, you have disclaimer, you have to go for. But in the standard, they say if the management is not willing to share their assessment regarding entities' ability to continue as a going concern, it will be a case of non-availability of audit evidence. You have to give either a qualified or disclaimer. But in my opinion, always go for disclaimer. The management is not sharing information regarding going concern. The possible effect will always be going to be material and pervasive. Better we always go for a disclaimer. Understood? Clear, everybody? That's it. So this is what we have done regarding SA 570. So now we have one more last standard from the 500 series, which is going to be SA 580 written representations. So that we will try to do. So now we have last standard from the 500 series, which is SA 580. Let us try to cover, which is talking about written representation. What is written representation? See, it is an extended version of external confirmation, I will say. What is external confirmation? External confirmation is a direct written response obtained by the auditor from a third party. That we call it as external confirmation. Whereas written representation is a written confirmation obtained by the auditor from the management or those charged with governance to support other evidences. To support this other evidences. So auditor already will have some evidence. To support that evidences, the auditor will try to get a written confirmations from the management. So that written confirmations received by the auditor from the management, that's what we are going to call it as a written representation. Now, do you think written representation are an audit evidence? Is written representation an audit evidence? Yes. Written representation is an audit evidence. We don't deny it. But the problem is, it is not an audit evidence on its own. Written representation is not an audit evidence on its own. What is the meaning of it? You can't rely only on written representation. Never ever you should do it. If they would have told written representation can be used as audit evidence on its own, our audit will become very simple. So we'll accept the audit, we'll sign the engagement letter. Along with the engagement letter, we will also ask them to written representation. Sir, please give us a written representation that financial statements are free from material misstatements. Please give us a written representation that financial statements are free from that financial statements are prepared as per applicable financial reporting framework. Get the two written representations, sign the audit report. Audit. But that is not the case, no. So that's what they're saying. Written representation can be used as an audit evidence, but the problem is it does not provide evidence on its own. It is just a supporting evidence. There is not evidence on its own. Next, objectives of the auditor. So regarding which matters I need to get the written representation. Regarding what kind of matters I need to get the written representation. Every auditor for every client, one written confirmation, one written representation which is mandatory is that the management has fulfilled its responsibility for the preparation of financial statements and completeness of information provided to the auditor. Remember this. Every auditor from every client engagement, you must get one confirmation from the management saying that they have fulfilled their responsibility regarding preparation of financial statements and they have completely provided the information to the auditor without hiding. Completeness of information provided to the auditor. This is mandatory. This is mandatory. In every client, at every place, we are required to get this information, confirmation that management has fulfilled its responsibility regarding preparation of financial statements and they have and completeness of information provided to the auditor. That is compulsory. And one more case, what is compulsory is wherever there is a requirement of other standard on audit. Like we are saying, SA 501, they have asked you to obtain written representation regarding litigations and claims. Then SA 570 just now, you should get written representation from the management regarding going concern. SA 560, you guys should get a written representation regarding the subsequent events. So, like wherever there is a requirement of the standard, there also it is mandatory. In addition to that, in any other areas, if you feel that you need written representation to support your other evidences, you can always get that written representation. But mandatory is to fulfill the responsibility regarding preparation of financial statements and completeness of information provided, or if there is a requirement of the standard in remaining areas to support other evidences related to some other assertions. Related to some other assertions, if you want to get written representation, you can get it. And one more objective they say here is when you ask for the written representation, management will give you written representation. When you get the written representation, you have to respond appropriately. Now you have to analyze how to use the written representation. Sometimes management will give you written representation, but you ask written representation from the management, but management will not provide. Yes, that also happens. You are asking for written representation, management is not providing. Then also you have to respond appropriately. How to respond appropriately, that we are going to see it in the subsequent part of the standard. So, to respond appropriately when the management has provided the requested written representation and also when they have not provided the requested written representation, you have to respond appropriately. Now, next point, sir, from whom you are going to request a written representation from? Management. But management is a very broader term, no? Management is a very broader term. So many people will get included in the management. Let us say board of directors. So many people will get included in the term management. Do you think each and every person who is a part of the management will be having information related to financial statements? Do you think each and every person who is a part of the management will be able to get all the information regarding financial statements? So even though we say that we are going to request a written representation from the management, but we request written representation from that part of the management who are involved in the preparation of financial statements. Right? Like for example, in listed companies and all, audit committee will be there. If you go and ask the written representation from audit committee, they can give you better written representation. Or in the company, CEO, CFO will be there. So they will be the concerned part of the management from whom we expect that they will possess all the required information. So when you say you go to the management, you go to that concerned part of the management who are involved in the preparation of financial statements, from whom we can have an expectation that they will have the information. So from that part of the management, you have to get a representation. But sometimes what will happen is you go to the management, ask them some written representation regarding a matter, but they might not have that required information to provide you with a written representation. Simple scenario I will tell you. This is 501. Regarding completeness of litigations and claims, you have to get a written representation. Right? You went to the management and told, you went to the board of directors and told, sir, I want a written representation regarding completeness of litigations and claims, sir. But CFO of the company say, no, sir, I don't have that information because we have a dedicated legal team. Legal team is looking into matter. Please don't ask the written representation. Can you say it like that? No. So generally we expect management to have all the information. But in case if the matter regarding which auditor is asking written representation, if that matter is not, that information is not available with the management, what they should do? They have to go to the concerned persons either within or outside the organization, get the required information, and provide the written representation. They can't simply escape saying, sir, I don't have the required information, I will not provide you with the written representation. They can never say that. In case if they are not having the required information, it is their responsibility to go to the concerned person, get the required information, and then provide the written representation. So, could be that. Can you give me examples of that other people within the management can go and do the inquiry and get the required information? Yes, we have given few examples. Like an actuary, you might be asking a written representation regarding a gratuity provision. CFO is not having information. What he should do? Go to the actuary, get the required information, provide the written representation to the auditor. Or staff engineers, you want some confirmation regarding the working conditions of the machineries and all. You don't, CFO doesn't have the required information. He has to go to the staff engineer, get the information, provide the written representation to the auditor. Or it could be legal counsel like lawyers and all. If you are asking some information regarding litigations and claim, CFO doesn't have required information. Go to the legal counsel and get the required information and then provide the written representations. Understood? Next. Thereafter, written representation from the management to reconfirm their responsibilities. To reconfirm their responsibilities. So let us say, for example, this is both in case of recurring audits also, new audits also. Let us say at the beginning of the audit, we get a written confirmation from the management, written representation that they are fulfilling their responsibilities and completeness of information. Or let us say last year I have done the audit of the client. Last year I have got the written representation from the management that they will fulfill their responsibilities and they will completely provide the information to the auditor. But sometimes what will happen is during the course of the audit, you might ask the management to give the written confirmation once again to reconfirm the responsibilities. Sometimes there might arise a need where you might ask the management to give a written representation once again to reconfirm their responsibilities. Sir, in what circumstances, sir? So if you see it here, the auditor may also ask the management to reconfirm its acknowledgement and understanding of those responsibilities in written representation. This is particularly appropriate when those who signed the terms of the audit engagement on behalf of the entity no longer have the relevant responsibilities. Simply, if I have to put it, management has changed. Those people who signed the engagement letter, those who have initially given the engagement letter, those people are no longer there in the same role. Like that means management has undergone some change. So better to get the reconfirmation to reconfirm the responsibilities. The terms of the audit engagement were prepared in the previous year. Last year you have prepared the terms of the engagement. In the current year some changes have happened. So better you get a reconfirmation once again regarding the responsibilities. There is an indication that management misunderstands. Earlier, they gave the written representation by misunderstanding their responsibilities. But now they got that sorted. Now they have got the clarity. Now they can approach you, asking you for the reconfirmation once again. Or if there is a change in circumstances, like that make it appropriate. Or if because of any change in circumstances, also you might be required to get a new written representation to reconfirm the responsibilities. Next. Now, some example here. So this is other written representation. What is this is? See, I told you that in the objective paragraph, in two places it is mandatory that management fulfill the responsibility completeness of information provided, and also wherever there is a requirement of the standard. That is mandatory. Apart from that, in what other areas can you give us examples of few assertions where management will try to ask written representation? Yes, they have given a few examples here. They have given few examples here. Apart from the mandatory requirements, what are the examples of other assertions where the auditor might be asking the management for written representation? Like a few examples, if you see it here, selection and application of accounting policies are appropriate. Whether management has selected correct accounting policies, appropriate accounting policies or not, for that you can ask for written representation. Whether matters such as where relevant and applicable financial reporting framework has been recognized, whether the following matters are recognized, measured, presented, or disclosed, which matters, plans, or intentions that may affect the carrying value or classification of assets and liabilities. So, whether they have done the proper valuation of assets and liabilities, proper classification of assets and liabilities, or not, you can ask the management written representation for that. Liabilities both actual and contingent, whether they have properly classified, measured, and presented actual and contingent liabilities. You can ask written representation regarding that. Title to or control over assets, liens or encumbrances on assets, and assets pledged as collateral. Whether do they have the ownership of the assets, have they given it as any security? So are the titles are in the names of the companies or not? For that also you can get the written representation. Or aspects of laws, regulations, and contractual agreements. So similarly, you can also get written representation regarding law, compliance with the laws, compliance with the regulations, and even contractual agreements. And they say one more specific point here, written representations about specific assertions. Some specific assertions they are saying where you need to get written representations about. So if you see it here, when obtaining evidence about or evaluating judgments and intentions, auditor may consider one or more of the following. So when you are getting assertions, so this is not, the heading is wrong actually. When you are getting written representation, when you are using that written representation, what factors you will consider? You ask the management to give the written representation here. They will give you a written representation. Now you have to use that as a audit evidence. As a supporting evidence only you have to use it. But while using that evidence also, what factors you will consider? Number one, the entity's past history in carrying out its stated intentions. You ask the management to give one confirmation, like going concern. Plans for future. I asked the management to give a written confirmation regarding what are their plans for future. They gave the written representation. But whether that representation I have to use it or not, that depends on did the company in the past told you about their plans? And if they have told it, have they implemented it in the past? If they have implemented it in the past, there are more chances they will implement these things also. So this one factor you can consider. Or the entity's reason for choosing particular course of action. So there are multiple options available. Let us say going concern assumption only. So to make your going concern valid, you have any number of options. But what the company is saying is, we will go for IPO and make the going concern valid. Why are you not choosing funding in the form of loans and all. So why they have chosen particular course of action, that also you keep in mind before you are using that written representation. Entity's ability to pursue a course of action. If you ask for written representation, they will give you whether they have ability to carry out, whether they are able to do it. Ask the management once again regarding going concern. Sir, will you be able to get your funding? The company told, yes, sir, we are able to get the funding. We are ready to get a funding from the bank. You are ready, but is the banker ready to give? So check it. And also the existence or lack of any other information that might have been obtained during the course of the audit that may be inconsistent during your other course of audit. Did you find out any such information which is inconsistent with what management is saying? If in one area inconsistency is there, definitely in all other areas also they can say your wrong statements. That's what I try to say here. So when you have got written representation regarding certain assertions, you will want to use it as a supporting evidence. So when you are using it as an evidence, you have to consider the following factors. So what are they? The agreed, the entity's past history in carrying out its stated intentions. Why? What is the reason for choosing a particular course of action? Whether they are able to carry out that particular action, and also existence of any other information that have been obtained during the course of audit, which is inconsistent with the management's intentions. Next, date and period covered by the written representation. So from this paragraph, one important point we have to always keep in mind is the date of written representation should not be earlier than the date of audit report should not be earlier than the date of written representations. Or to put it in another way around, the date of written representation should not be later than the date of auditor's report. Like, the sequence is first audit evidence, then audit report. It is not first audit report, then evidence. So some fools are there. Some people will do like this only. They will complete the audit. Thereafter, they will realize SA 580 is there. Now they will ask the management to give written representation at audit file preparation. Some people will do like this. First, they will do the audit. They will sign the report, and thereafter they will realize, okay, we forgot to take the written representation. Now they will ask the management to give written representation. That fellow will give, but mentioning the current date, he will give the written representation. So then it will look like as the first you have given the audit report, then you obtained audit evidence. So you should not look like a fool explicitly there. So that's why make sure that date of written representation is not later than the date of auditor's report. And what should be the form of written representation? The form of written representation should be in the form of a letter. Like the way management is writing a letter to the auditor, in that representation letter format they have to do it. And they say one important statement here. What they say is, read it. If law or regulation requires management to make written public statement about its responsibilities, and auditor determines that such statements provide some or all of the representations required, relevant matters covered by such statement need not be included once again in the representation letter. What they are saying, as per some law or regulation, you are required to make some public statements. You have some responsibilities, and those regarding those responsibilities, you have to make public statement. Like let us say, for example, you have to give a official announcement, or you have to post something on your website regarding the responsibilities. Now, even as an auditor, you need representation regarding the same responsibility only. You need written representation regarding same responsibility. But regarding that responsibility, the company has already accepted that responsibility by giving a public notice. Now, once again, don't harass them, even though you have given the public statement. But I want a separate written representation. No need to do it. The management has already made some public statement regarding its responsibilities. And regarding the same responsibility, if you need written representation letter, don't ask it once again. Why? Because they have explicitly, publicly accepted their responsibilities. What is the purpose of getting the written representation once again? Understood. Next one. Doubt as to reliability of written representation. Sir, what is it? You asked the management to give a written representation. They gave it also. But you are getting a doubt regarding reliability. You are getting a suspicion. Management gave me written representation, but should I trust it or not? Should I believe it or not? Like that, a doubt you are getting. When generally you will get a doubt? When you have a doubt regarding management's integrity, when you found that they are not honest people, or when you doubt their competence. Management doesn't know anything. That CFO is a waste fellow. He doesn't know anything regarding financial statements. Just I was asking something, he was giving something. So when you have doubt regarding entities, management's integrity, and also you have doubt regarding their competence and ethical values, obviously that should translate into doubt on the written representations, whatever they have provided. And particularly, if the written representations are inconsistent with other evidences, you got other evidences, you got written representation also, both should match. but you are finding that there is an inconsistency between written representation and other evidences, then particularly doubt will come or not. So in these cases, what you should do is you should try to proceed further. When other evidences and written representations are inconsistent with each other, you should try to resolve the matter. That means you should dig deeper and find out whether your evidences you have gathered are wrong or written representations are wrong. If the other evidence you have gathered are wrong, then you will realize your mistake, you will correct your audit procedures and do it. So what if written representations are only wrong? You found inconsistency, you dig deeper, you found that management's written representations are only wrong. Your evidence is correct only. Management itself is giving a wrong written representation. You have concluded the management is not able, the management's written representations are not reliable. Then what you should do? Then what you should do? The standard says the auditor shall take appropriate action, including determining the possible effect on the opinion. Because if you have finally concluded that the financials, the written representations are only not reliable, take appropriate action, including what? Modify the opinion, determine the effect on the opinion. But in this case, they say go for disclaimer. Go for disclaimer. If you have decided that written representations are not reliable, go for disclaimer. Why? Because that will be a typical scenario where you are not able to believe the management only. If you got suspicion regarding written representation, entire financial statement itself is given by management. So how far you will be able to continue the audit there? That will give a disclaimer of opinion in these cases. And coming to this last paragraph, requested written representations are not provided. So what is the difference between this case and previous case? In the previous case, management provided written representation, but it is not reliable. In this case, you are asking for written representation, management is not giving only. Then what you should do? First, go to the management, behave like a gentleman, discuss the matter with the management. Sir, what is the problem with you? Why are you not giving me written representation? And re-evaluate the integrity. So what they are saying, re-evaluate integrity. Once again, something similar to external confirmation. When you found that external confirmation responses are not reliable, we reassess the risk of material misstatement. No, something similar to that. If the management is not giving written representation, you will go and discuss. If they are giving all the crap reasons and all, so you have to reassess. You thought management as honest, but now you got to know it. Reassess the integrity, reassess the risk of material misstatement, reassess the risk of fraud. If necessary, make changes to your audit strategy, audit plan. If necessary, make changes to your nature, timing, and extent of the audit procedures. And finally, and even determine the possible effect. If necessary, even you can consider the possible effect on the opinion. And as I've told, what is the possible effect? Disclaimer. Disclaimer. Go for disclaimer. Disclaimer in case of non-reliability of written representation about management responsibilities or failure to provide that written representation. In both the above cases, they told determine the possible effect. And what is that possible effect they are saying? Go for a disclaimer directly. Understood? That's all. This is what I'm writing SA 580. So with this, we have successfully completed SA 500 series. Now what we will try to do is, we'll try to do the 200 series. So now what we'll try to do is, we'll try to do SA 260, which is going to talk about communication with those charged with garments. See, at various instances, till now, whatever discussion we had, at various places we have came across this term called those charged with garments. But never we paid attention what is the meaning of this term, those charged with garments. So if you read the technical definition, they say that those charged with garments are the people with responsibility for overseeing strategic direction, and they are also responsible for obligation relating to accountability. Two things. Those are the governance of those people, those who are responsible for overseeing strategic direction, and those who are responsible for obligations relating to accountability. Sir, what is it? See, I have one simple example I will take to make you understand. Let us say I'm a chartered accountant. Why let us say I'm chartered accountant only? So I have a business idea. Let us say I want to start some restaurant, and all, but I'm all occupied. Okay, so I'm doing the practice. I'm taking up these classes and all. So, but I have a very convincing restaurant idea. So what I have done is I want to start the restaurant at any cost. So I took the place, I rented out the place, I started the restaurant, but I can't manage my day-to-day affairs. So what I have done is I have appointed one person. Let us say I call him manager. Now that person will take care of the entire business. He will procure the material, whatever is required. He will hire the people. He will decide their salaries. He will do the marketing. He will handle the customer service. Everything he will do. And I am paying him every month a salary or share in the profits. I am paying it. So now I am the owner, but the business is being run. All the operational decisions, executional responsibilities fulfilled by my manager. So now when I say management in this small restaurant kind of company, when I say management, here the people who are having this executional responsibility for putting my strategies into action. So that manager will fall under management definition. But who is responsible for strategic direction? Me. What do you mean by strategic direction? If my restaurant has, I started seeing more money and all, whether to open a new branch. If a new branch has to be opened, where it has to be opened? What I have to do with my money? Should I expand my restaurant or should I not expand my restaurant? That strategic direction, who will decide? Will my manager decide or I will decide? I have to decide, right? And similarly, let us say if someone has done something, someone has ate something in the restaurant and it have fallen sick. Let us say food poison happened, and serious issue has become very very serious. Now someone has to come forward and take the accountability. Accountability means someone has to face the consequences. Who will face consequences? I only will face the consequences. It's me who has to face the consequences. So I am the person who is responsible for strategic direction, and I am also the person who will be held with obligations related to accountability. I will fall under those charges with governance and definition in this business case. Whereas the manager, whoever is running the show, whoever is doing all that decisions and all, whoever is implementing the decisions, hiring the people, firing the people, so that all decisions are executional things are done by that concerned person. So he will become manager or management. Even in the corporate scale, also same thing. So the people who are actually taking up the executional responsibilities, making the things happen, they are management. But whoever is thinking into strategic direction and who are providing for what is that other thing, accountability, they will fall under those charges with governance. But in the corporate practice, in the corporate companies and all, in the big corporate companies and all, the differentiation between those charged with governance and management becomes very thin, very thin. And in many cases, both the roles will be played by the same team of people. In both the cases, in many cases, in the corporates, especially in so-called big companies, you will not be able to draw that line between management and those charged with governance. Because those who are those charged with governance, the same people will be taking up the management responsibility also. Like if you take a company like Reliance Industries Limited, they have their family, Mukesh Ambani, that Anant Ambani, all these people are there. They are a group of companies. They are taking the strategic decisions. They will decide which business to enter, where to do, what to do, and all. And they are responsible for accountability. If something happens wrong in the Reliance, we will directly blame Ambani's only. But at the same time, the same family members has become the chief executive officer, COO, and for each businesses, one person will become CMD, chairman and managing director. So what actually is happening? Those people who are providing strategic direction and accountability, the same person are also actively taking up that executional responsibility. So here, in this kind of big corporates and all, that gap almost diminishes, and the role of those charged with governance and management will be played by the same team of people. So practically, what I wanted to say is, in many big corporates and all, those charged with governance and management will be same. Able to get this point. In small organizations, you will be able to bifurcate, but when the companies grows bigger and bigger, then the difference between those charged with governance and management becomes very little. So we understood who are those charged with garnets. Now what is this SA-260? SA-260 says, boss, dear auditor, you are doing audit of the financial statements. No, if you want to do the audit of the financial statements in an effective manner, there should be a proper communication. There should be effective communication between the auditor and those charged with garnets. If you want to do your audit in an effective manner, if you want to make the most out of your audit, there should be a proper communication between auditor and those charged with governance. And you take the initiative, you communicate some matters with those charged with governance. In case if you are conducting audit, you have to identify who are those charged with governance in the organization, and you have to communicate certain things with those charged with governance. So what are the objectives? If you see it here, you have to communicate with those charged with governance regarding your response. Four things that four objectives essay. Number one, you are required to communicate with those charged with governance regarding your responsibilities. First thing, with those charged with governance, you have to go and communicate with them what are your responsibilities as an auditor. And also communicate with them overall plan, scope, and timing of the audit. What is it? Overall plan, scope, and timing of the audit, not detailed plan. Not detailed. Why? Because we already seen in audit strategy planning and program. If you discuss a detailed audit plan, whatever you want to do becomes a predictable and effectiveness of the audit will be lost. So that's why, as an auditor, you communicate with those charged with governance your responsibilities, and also you communicate with them the overview of plan, scope, and timing of the audit. First communication requirement. Number two, not you communicating. Whatever information you want from those charged with governance, obtain all that relevant information from those charged with governance. That is second objective. First objective, you communicate your responsibilities and overall plan, scope, and time. Second thing, whatever information you require, try to get that information from those charged with governance. Third one, provide those charged with governance with the timely observations arising from audit. What is it? Timely observations. So during the course of audit, if any timely observations are there, go and communicate in a timely manner with those charged with governance. Finally, fourth objective, promote a two-way effective communication. Make sure that that communication channel between you and those charged with governance is effective. It is not getting damaged. Clear? Four objectives. Can you remember? Number one, provide those charged with communicate with those charged with governance regarding responsibilities of the auditor and overview of planned scope and time. Number two, get whatever information you require from those charged with governance. Number three, provide them with timely observations during the course of the audit, promote an effective two-way communication. Now, if you dig deeper, sir, first objective, they are asking us to communicate the responsibilities. What specifically we will communicate, sir, regarding auditor's responsibility? So they say that when we are asking you to communicate auditor's responsibilities, what exactly the standard expects you is the auditor shall communicate that as an auditor, you are only responsible for forming an opinion and you are responsible for expressing an opinion. And you should specifically mention that just because I was appointed as an auditor, you will not be relieved of your responsibilities. There will be no reduction in your responsibilities. Tell the management and those channel managers, sir, just because you have appointed me as an auditor, you are only responsible for preparing financial statements. You are only responsible for implementing internal controls. There will be no reduction in responsibilities just because you have appointed me as an auditor. This is what specifically you have to mention regarding auditor's responsibilities. What are they? That you are responsible for forming an opinion and expression of opinion, and appointment of auditor does not relieve the management of its responsibilities. None of your management responsibilities will get reduced just because you have appointed me as an auditor. Next, plan the scope and timing of the audit. You are also required to commit within the first objective only. You are required to commit the plan, scope, and timing of the audit. No, so what exactly I have to communicate? So discuss with those charged with governance overview. Once again, we are telling overview only. Overview of plan, scope, and timing of the audit, including significant risk. Whatever significant risk you have identified, all that you communicate. Next. Now, second objective, we ignore it. Coming to the third objective, you have to provide those charged with governance with timely observations. No. So, what exactly are timely observations? They say that from the audit, if you have any significant findings, from the audit, if you have any significant findings, all that significant findings from the audit you have to communicate. So, any examples of significant findings? See, ultimately, which finding is significant, which finding is not significant, that auditor himself has to decide using his, once again, professional judgment. But there are few examples. Sir, what could be the example of a significant finding? So, some examples they have given. Like number one, significant qualitative aspects, like accounting policies, appropriateness of the accounting policies, whether they're following wrong accounting policies, that qualitative aspects you can communicate. Inappropriateness of accounting policies. Sometimes client will be following an accounting policy, which will be as per applicable financial reporting framework only, but still it might not be appropriate. Like SLM WTV they might be following, but looking at the consumption pattern production units method is more applicable. So like that, if you have any comment regarding inappropriateness of accounting policy, that you can communicate with them. And significant difficulties encountered during the course of audit, if you are facing any significant difficulties, that also you go and communicate with them. Unless all of those charged with governance, this point is very important. Unless all of those charged with governance is involved in the management, significant matters discussed with the management and written representations you have requested. So what they are saying, unless all of those charged with governance are involved in management. What is the meaning of this point is, if those charged with governance and management both are two different persons, both are different. Unless all of those charged with governance are involved in management. I told you in the corporate entities and all management, those charged with governance, both the roles are played by same person. But in case if management and those charged with governance both are different, whatever matters you have discussed with the management, discuss once again with those charged with governance. Whatever written representations you have requested from the management, discuss them also with those charged with governance. But if both are same, there is no purpose only, no. If those charged with governance, management, both are same people, what is the purpose of communicating the same things again? Not required. So that's why unless all of those charged with governance are involved in the management, the meaning of this sentence is management is different from those charged with governance. That means we are able to draw that line between those charged with governance and management. In that case, whatever matters you have discussed with the management, whatever representations you have requested from the management, communicate with the those charged with governance once again. Next, circumstances that affect the form and content of the auditor's report. What they are referring to? Circumstances that affect the form and content of the auditor's report. All that matters also you are required to communicate. What are they? If you want to give a modified opinion, if you want to communicate the key audit matter, if you want to include an emphasis of matter, if you want to include another matter paragraph discussed yesterday, in all that matters. That is what the example of communicate. That is what the examples of matters that affect the form and content of the auditor's report. Next, any other significant matter as per professional judgment. Not just the above. Above are only examples. Any other matter which auditor feels significant in his professional judgment. So this is what timely observations which you have to communicate. Then, in case if you are conducting audit of a listed company, there is a specific requirement that you are required to communicate with those charged with governance regarding the independence. Mandatory. So in case of listed company, you are compulsorily required to communicate with those charged with governance regarding the independence requirements. So specifically what I will communicate, sir. The auditor shall communicate with those charged with governance that engagement team, their firm, including their network, which are operating under same brand name and all, everybody has complied with ethical requirements. Give a written communication, sir. Ourselves, our engagement team, our firm, our network firm, we all have complied with ethical requirements. And also, relationships that might affect independence, even let them know, are you holding any other relationship that might affect independence? That means for the same client, whether you yourself or your partners or your firms, in addition to audit, are you providing any other services apart from audit? If you are providing any other services, how much fees you are charging for that other services? All that information also you are required to give. So why quoting the fees is very important is, in once again CA funnel you will learn one concept. In the case of companies and all, if you can provide audit along with other services, but the fees for other services should not exceed the fees for audit. There is one rule for the same client. If you are providing financial services, but this is only for listed companies and all. For the same client, you can do audit, and under section 144 prohibited services are there. Under Companies Act you might have read it. So that section 144 services you cannot provide. Apart from section 144, you can provide audit and other services. But the fees which you are charging for other services should not be greater than fees for audit. Why? Because if other services are paying you more money, then you will be more concentrated towards that. You will not act independently here. So that's why you have to provide, in order to fulfill that communication requirements, even you have to communicate with those charged with governance, relationships that might affect your independence. Like what audit services you are providing, what non-audit services you are providing, what is the fees for audit and what is the fees for non-audit services. That information you have to. This is mandatory in the case of audit of a listed company. Clear? Then apart from all that, sir, what is the communication process? How you have to do the communication? In case of listed company, they say compulsorily in writing. You have to fulfill that communication requirements in writing. In case of listed company, this communication of independence and all, it is mandatory in writing. In other cases, writing if oral is inadequate. You have to do it in writing if you find that oral communication is inadequate. And by thumb rule, oral communication always will be inadequate. Always oral communication will be inadequate only. So in at all circumstances, you should do that in the written form. And then documentation. What and all matters you have communicated with those charging canons, even those things should be included in your documentation also. Clear? So this is what regarding SA 260. Now we have SA 265. So what is this SA 265? So what is this SA 265? SA 265 is also something related to communication, but it will talk about communicating deficiencies in internal control to those charged with governance and management. Specifically, it will talk about communicating deficiencies in the internal controls as a part of your audit. You will also test internal controls or not. But one thing we have to keep in mind, we will not test all internal controls. Whatever internal controls which are relevant for audit, only those internal controls will do the testing. That you all should be aware. So, as an auditor, as a part of our audit, we will verify internal controls also. Even though our objective is not verification of internal controls, our objective is to express an opinion on the financial statements. But in order to fulfill that objective, in that process, we test internal controls. By testing the internal controls, you might find some deficiencies in the internal controls. So those deficiencies in the internal controls, they're asking you to communicate. So to whom you have to communicate? Some things to the management, some things to those charged with governance. So first of all, deficiency they are saying. What is the meaning of deficiency in internal control? Simply if I have to put it, if the control which is implemented by the management is unable to prevent, detect or correct a mistake. The control has been implemented by the management, but it is unable to prevent, detect or correct a mistake. Or control altogether is missing. Control is not there. Or control is there, but it is unable to prevent, detect or correct a mistake. Both these circumstances we call it as a deficiency. Then there is something called significant deficiency. Sir, what is significant deficiency? Either one deficiency or a combination of deficiency which are significant enough to bring it to the attention of those charged with governance. What you're saying here, if you find a deficiency, either one single deficiency or a combination of deficiency, which you are feeling that these deficiencies are so significant that this must has to be compulsorily taken to the notice of those charged with governance. Those deficiencies we call them as significant deficiencies. Ultimately, once again, professional judgment. Which one will be a significant deficiency, which one will not be a significant deficiency, the auditor himself has to decide using his professional judgment. Clear? So now what is the ultimate reporting requirement? I will tell you in one simple way. If it is a significant deficiency, report it to the management also, report it to the those charged with governance also. It is a significant deficiency, you have to report it to the management, you have to report it to those charged with governance. If it is a normal deficiency, report it to the management only. Report it to the management only. That's all. This is what the summary of the entire standard. This is one single line summary. If it is a significant deficiency, communicate with the management also, communicate with the those charged with governance also. If it is not a significant deficiency, normal deficiency, just to communicate with the management, it will be enough. Okay. So keeping that objective in mind, if we go ahead, examples of matters that the auditor may consider in determining whether a deficiency is a significant deficiency or not. If you found a deficiency, to determine whether that deficiency is a significant deficiency or not, this who has to decide? Auditor. Now, auditor will decide considering various factors whether a deficiency is a significant deficiency or not. He will decide it considering various factors. What factors? Likelihood of misstatement. There is a weakness in the internal control. Agreed. But what is the possibility of converting that into a misstatement? Not every deficiency can lead to a misstatement. Some deficiencies will be there which remain unexploited. Doesn't matter. So likelihood of the misstatement. Susceptibility of loss or fraud of related asset or liability. If at all any misstatement happens, how much amount of fraud, how much amount of error can happen? And subjectivity or complexity of estimated amounts. If that internal control is related to accounting estimates, If higher subjectivity is involved, there will be more chances that it will result in significant deficiency. If lower subjectivity is involved, less chances that it will result into a significant deficiency. Then financial statements exposed to deficiency. How much amount is exposed to deficiency? There is a deficiency in internal control system related to revenue. The revenue of the company is 500 crores. Significant deficiency or not? Because huge amount is exposed to that deficiency, and volume of activity exposed to deficiency. There is a lapse in internal control. Through that internal control, what volume of transactions will pass? Once in a while, one transaction will go through that internal control. Not significant. But every transaction has to get routed through that deficient internal control only. That will be a significant deficiency. So all these matters will be considered by the auditor in determining whether a deficiency is a significant deficiency or not. Examples of indicators. Sometimes some things will indicate that there is a significant deficiency. Hint, not confirmation. Sometimes because of some events, you will get a hint that there could be a significant deficiency. So what are the examples of indicators? Number one, ineffective aspects of control environment. That means client is not having a proper control environment only. Bad environment they have. Like what? Significant transactions in which management is financially interested. Top level management is engaging in all the transactions wherever they are having interest. And identification of management fraud. You are able to find the top level management itself has committed a fraud. And no remedial action for significant deficiencies. Even after communicating them deficiencies, also no action they are taking. All this indicates that there is a bad control environment. When there is a bad control environment, definitely there could be a significant deficiency. One indicator. Absence or ineffective risk assessment process. The management is not studying about their own organization. They are not doing a study of their organization, where there is a possibility of error, where there is a possibility of fraud, what kind of internal controls we should have. No one is studying about the organization. So there could be a significant deficiency. Ineffective response to identified significant risk. Even after finding out the significant risk also, no one is taking an effective response. That could also indicate a significant deficiency. Misstatements not prevented, detected, or corrected by internal controls. Even after implementing internal controls, also still that misstatements are not getting prevented. There could be indication of significant deficiency. Disclosure of fraud or error as prior period item. You are able to find a fraud, you are able to find an error, but management is hiding it as a prior period item. Clearly indicates a significant deficiency. Or management inability to oversee the preparation of financial statements. No one is monitoring the financial statement process. So all these are indicators that there could be a significant deficiency. How you have to communicate, sir? As I have told, communication with the management, communication with those chartered with governance. With those chartered with governance, you will communicate only significant deficiencies. Now, what you will communicate with the management? Significant deficiencies that auditor communicates or intends to communicate with those charged with governance, unless it is inappropriate. So generally, whatever significant deficiencies you want to communicate with those charged with governance, first you will communicate it with management also. But sometimes it will treat as inappropriate. Why? Sometimes if you communicate with the management, management can, let us say management itself is responsible for that deficiency. If you first communicate and then go to those charged with governance, in between they can play a game. So that's why if you feel it as inappropriate, then don't communicate. If you feel it as appropriate, then whatever significant deficiencies you are going to communicate with the those charged with governance, communicate with the management also once. And other deficiencies, anyhow, other than significant deficiency, whatever other deficiencies are there, that you communicate only with management. Sir, what and all things you have to communicate? See, when you are communicating this significant deficiency with the those chartered with governance, don't just let them know only the list of deficiencies. Don't just let them know when you are reporting. Generally, the significant deficiencies will be communicated in a report. What many auditors will do is that report they will just say what deficiencies they have identified, but it will not be enough. You have to provide them all the required information which will make them understand that deficiencies in a better manner. Don't just stop with communicating deficiencies. That's what they say here. Written communication of significant deficiencies shall include description of deficiencies. Definitely, you have to describe all the deficiencies, whatever you have identified. Explain about their possible effects also. Don't just stop with that. Sufficient information to enable those charged with governance to understand the context of communication. Even give them all the background information to make them understand the impact of this deficiencies. Not just that, particularly you should explain that the purpose of the audit is to express opinion. Let them clearly know, sir, our purpose of the audit is to express an opinion. And audit is not for the purpose of expressing an opinion on effectiveness of internal controls. Our whole objective is to express an opinion on the financial statements. our objective is not for expressing an opinion on the financial statements, but in the or not for expressing opinion in internal controls. But in the process of conducting audit, we got to know about deficiencies. Whatever deficiencies which came to our notice that we are reporting. This might not be the only deficiencies. Only those deficiencies as a part of our audit which has come to our notice that we are communicating with you. Don't be of a wrong notion that these are the only deficiencies. Apart from that, various other deficiencies also could be there. So our objective is to express an opinion. Our objective is not to express an opinion on internal controls, but in the process of audit, these deficiencies has come to our notice that we are reporting, but these might not be the only deficiencies. If you do a detailed investigation, you might be able to find even so many other deficiencies also. Be clear in your communication like this. So that's what we say. So you should clearly explain the purpose of the audit is to express an opinion on the financial statements. Audit is not for the purpose of expressing an opinion on effectiveness of internal controls. Matters being reported are only limited to identified deficiencies by the auditor. So whatever we are reporting, those are only which have come to our attention. Apart from that, there will be other deficiencies also. That's what they meant by adding this lines. Understood? So this is what SL 265 is all about. So now what we will try to do is we will try to do 450 also. So SA 450, which is going to talk about what? Evaluation of misstatements identified during the audit. See, this standard is going to talk about mainly two things. One is identified misstatements and the other one is uncorrected misstatements. Two terms have to be very clear. Identified misstatements, uncorrected misstatements. So what is identified misstatement? Which you have found. Let us say, for example, you are conducting an audit of the financial statements while verifying the books of accounts, while verifying the financial statements, you got to know some 20 misstatements. So all of that 20 misstatements which you have identified. Now, these are 20 misstatements. The moment you got to know about misstatements, don't be so harsh. Don't be so harsh. What do I mean by that is, you should not be like, hey, I have identified the misstatements, I'm going to give a modified opinion. It should not be like that. Why? Because not every misstatement should have happened because of fraud. Some misstatements could have happened even because of errors also. So that's why whenever you have identified the misstatements, what will actually happen is we will accumulate all the misstatements. Whatever misstatements we have identified, we will accumulate all the misstatements, and all these accumulated misstatements will be communicated to the management. Sir, I have identified all these misstatements. Management will be given an option to correct that misstatements. Management will be given the opportunity to correct that misstatements. In many cases, what usually happens is when you have identified the misstatements, when you communicate it with the management, they will correct it. They will correct the misstatements. But in some cases, what will happen is, let us say you have communicated 20 misstatements, everything you have accumulated, communicated to the management, but out of that, management corrected only 15 misstatements, 5 misstatements they have not corrected. 5 misstatements they have not corrected. So that 5 misstatements which are not corrected, that is what we are going to call it as uncorrected misstatement. So if the management has not corrected the misstatements, first you have to sit with them and you have to understand why they are not correcting that misstatements. Maybe because, in your opinion, you are considering it as a misstatement, but management might have the other side of the coin. Management might conclude that, management might convince you that, no, sir, it is not a misstatement, you are only wrong because they know the business better than us. So, when the misstatements are not corrected, those uncorrected misstatements should be discussed with the management why they are not correcting it. Is there any valid reason? Or do they not consider it as misstatements? Or do they not consider it as material only? That's why they are not correcting. So whatever could be the reason, you have to get the justification. So sometimes when you discuss that uncorrected misstatements with the management, you get convinced. You get convinced and you might conclude that okay, these are not misstatements, or even though they are misstatements, they are not material, and you can continue to give a modified opinion. But in case if there are uncorrected misstatements left out, but you are unable to get convinced, management is not giving you valid reasons, then these uncorrected misstatements will be compared with the materiality level. It's the materiality, no, as per 320. So these uncorrected misstatements will be compared with the materiality level, and if they are within the materiality level, well and good. If they have exceeded the materiality level, then I will conclude that financial statements contain a material misstatement and then give a modified opinion. Understood. So this is what the overall objective of the standard. This itself, they try to break it down into multiple paragraphs. But this is what the context. You do the audit, perform audit procedures, identify the misstatements, communicate with the management, get them corrected. If anything is left over, uncorrected misstatements, these uncorrected misstatements you discuss with the management. If you are if they are really uncorrected misstatements, compare it with the materiality level. If they have exceeded the materiality level, conclude that financial statements contain a material misstatement and give a modified opinion. Clear? So that's what they try to break it down here. So what is the objective of the auditor as per say 450? The objective of the auditor is to evaluate, is to analyze what the effect of identified misstatements on the audit, and also to evaluate the effect of uncorrected misstatements, if any, on the financial statements. So to analyze the effect of identified misstatements and also to analyze the effect of uncorrected misstatements. Then, first point, accumulation of misstatements identified during the audit. As I have told, you will not communicate one misstatement separately. You will accumulate all the misstatements and then you communicate. And while accumulating, you have to ignore those misstatements which are clearly trivial. You will accumulate all the misstatements other than those which are clearly trivial. So what do you mean by trivial? Irrelevant, negligible. In one way, you can call it as negligible. That means you need not worry about it. So it is different from material here. Many people will feel that not trivial means not material. No, no. Trivial is far negligible amount. Very negligible amount is trivial, not something which is material. Okay. So material, trivial, both are different things. So the auditor shall accumulate the misstatements identified during the audit other than those that are clearly trivial, and you have to recognize the fact that the misstatement can happen because of variety of factors. Consideration of identified misstatements as the audit progresses. Now, what this paragraph says is, sometimes while doing the audit, you do the audit on sampling basis. No? So while doing the sampling, while performing the audit process, what will happen is you will identify the misstatements and the circumstances in which they have occurred. You identified misstatement, and when you analyzed because of what circumstances this misstatement has occurred, so analysis of the circumstances indicate that the same other misstatement also may exist. You are verifying sample here, and by verifying the sample, you got to know about one misstatement, and you understood because of what circumstances these misstatements have happened. And they are revealing that because of the circumstances in which they have happened, they are revealing that there could be other kind of misstatements also. Same misstatements could be there in other areas also. And all that misstatements could be material. Like that, you might get a hint. So this could happen. Or the aggregate of misstatements accumulated during the audit approaches materiality determined in accordance with SL 320. So sometimes during the course of the audit, two kinds of instances could happen. Number one, the misstatements and the circumstances under which they have incurred, they indicate that other misstatements could be possible, which could be material. Or whatever misstatements that you have identified, when you have accumulated all the misstatements, they are approaching the materiality. They did not exceed. Let us say, for example, you kept a 2 crores worth of materiality level. But by verifying the transactions on the sampling basis, you identified the misstatements, and the value of accumulated misstatements is coming close to 1.9 crores. Close to that materiality they are coming. In that cases, you should think whether there is any need to revise your audit strategy and audit plan. In those two circumstances, you have to analyze, consider whether there is a need to revise your audit strategy or audit plan. Why, sir? See, first case, first point if you observe, if in the sample only you are finding the misstatement and circumstances are indicating that there could be other misstatements also. Now, if you increase your nature, timing, and extent of audit procedures, you can find out more misstatements. So, in order to increase your nature, timing, and extent of audit procedures, first you have to go and revise your audit strategy and audit plan. That is the logic. For second point, see, on the sampling basis, when you verify the transactions only, you found out misstatements. They are approaching material, almost close to material. You should not take more chance. If you verify little more, You can find out more misstatements and that could have crossed the materiality level and you could have considered that as a material misstatement, give a modified opinion. So in both the cases, you don't want to take the chance. That's why consider whether there is any need to revise audit strategy or audit plan so that increase your nature, timing and extent of audit procedures and arrive at a good conclusion. Clear? Next. The auditor may request management to examine a class of transactions, account balances, or disclosure to understand the cause of the misstatement identified by the auditor, perform procedures to determine the amount of actual misstatement, transactions, balances to make appropriate adjustments. Sometimes, in the first case, once again, if you find out a misstatement, what you can do is, and if you feel that these kind of misstatements will get repeated, you can understand, you can go and check with the management. So this misstatement happened, why it has happened. Now do one thing for me. Since you are telling this is the cause of the misstatement, identify whether you have done the same mistake in other areas and come to me telling the total amount of misstatement. If you find something is wrong that is repetitive in nature, you can even go and request the management only. Sir, please do the reassessment once again, find out all the misstatements in other areas and correct them. So like that also you can do. If at the auditor's request, management has examined a class of transaction, account balances or disclosure and corrected misstatements that were detected, auditor shall perform additional audit procedures to determine whether misstatement remain. So you give the instruction. Management studied their entire books of accounts once again. They identified the misstatements and they have corrected and they came and informed the auditor. So we have corrected. Now you should cross check once again whether still after that also any some misstatements remain. Next. Communication and correction of misstatement. This is what I have told. So auditor shall communicate on a timely basis all misstatements whatever you have accumulated, provided to the management, unless prohibited by law or regulation. If prohibited by law or regulation, don't communicate it. The auditor shall request the management to correct those misstatements. Why? What is the whole purpose of communication? Asking them to correct it. Timely communication of misstatements to appropriate levels of management enables the management to evaluate whether items are misstatements or not. Inform if it disagrees. If you communicate with the management, they will also let you know whether they are really misstatements or they are not misstatements. And the correction by the management of all misstatements, including those communicated with the auditor, enables the management to maintain accurate accounting records. One more advantage: if you communicate the misstatements, what will happen? You are giving the management an opportunity to correct it so that their books of accounts also will become more reliable. If management refuses to correct some or all misstatements communicated by the auditor, auditor shall obtain an understanding of management's reason, because of what reasons they are not correcting their misstatements, and even ask them to give a written confirmation that they are not material. And for not making corrections, and shall take understanding into account when evaluating whether financial statements as a whole are free from material misstatements or not. Next. Evaluating the effect of uncorrected misstatements. Now, finally, you will be left with uncorrected misstatements. You have to analyze the effect of that uncorrected misstatements. So, what do they say? Prior to evaluating the effect of uncorrected, one more point they say here. See, I told you that uncorrected misstatements will remain with you. These uncorrected misstatements has to be compared with materiality level. But they say one more point here. Before you compare that with materiality level, reassess whether there is any need to revise your materiality level. Reassess whether there is any need to revise your materiality level. I told you, revision of materiality is necessary. So there is no need that whatever materiality level that has been decided at the beginning, you have to follow it strictly. You can even revise the materiality level. So at the end, when you are left with uncorrected misstatements, when you are trying to compare it with the materiality level, just to cross check this materiality level is still relevant or there is a need for revision of materiality level. That will cross check it once. So, the prior to evaluating the effect of uncorrected misstatements, the auditor shall assess materiality determined in accordance with Sep'26. Is it remaining appropriate, or there is any need to revise it? Auditor shall determine whether uncorrected misstatements are material, and then finally, in deciding whether uncorrected misstatements are material or not, you need to consider size of the misstatement also, nature of the misstatements also. Sometimes a misstatement could be small in size, but because of the circumstance in which it has occurred might make it look material. So when you are deciding whether the misstatement is material or not, both look at their size and also nature of the misstatement, and also look whether there are any uncorrected misstatements which are related to prior periods. Word of this uncorrected misstatements, whether anything are related to prior period or not, so we need to check it. Then finally, you have to communicate with those charged with governance. You are left with uncorrected misstatements, no? Those uncorrected misstatements, give them one more opportunity. Communicate with those charged with governance. Sir, your management is not correcting these misstatements. I might be requiring a modified opinion. At least you convince your management to correct the misstatements. So go and communicate with those charged with governance. shall communicate with those charged with governance regarding uncorrected misstatements and the effect that individually or aggregate may have an impact on opinion, unless prohibited by law or regulation. Then auditors' communication shall identify material uncorrected misstatements individually. One by one, each misstatement you communicate with those charged with governance individually. The auditor shall request that uncorrected misstatements be corrected. Request those charged with governance also. The auditor shall also communicate with those charged with governance the effect of uncorrected misstatements related to prior periods. Out of these uncorrected misstatements, if something is related to prior period, that also you separately communicate with them. And then finally, written representation from the management regarding effect of uncorrected misstatements. If the management is not correcting misstatements, and when I ask them, sir, why are you not correcting? They are saying they are not material, sir. So if they're orally saying not material, don't agree to it. Ask them to give a written representation that they are considering all the uncorrected misstatements as immaterial. Next one. And documentation regarding misstatements identified during the audit. So what things you have to specifically include in the documentation is the amount which you set it as trivial level. I told you clearly trivial some misstatements are there, no? What is that figure you have set for trivial misstatements? And all misstatements what you have accumulated, and out of them whether they are corrected or not. And what is the auditor conclusion regarding that uncorrected misstatements and whether they are material or not. So that also you have to include in your documentation. Clear everybody? Able to understand? So this is what regarding SA 450. Now we have two more standards, SA 220 and SQC. One also we have. You guys need break? Okay, take it. Perfect. So we have two more standards to cover, SA 220 and SQC 1. See, as in the introduction part we have already covered. Introduction to the standards, as I was saying, whenever you are doing any engagement, be it audit engagement, be it review engagement, be it assurance engagement, be it related services, you are required to maintain the quality. So that quality control, how you are supposed to do it all, that discussion has been covered under SQC1. So SQC1 is a standard which is providing the guidance regarding maintenance of quality. See, when it comes to maintenance of quality, when it comes to quality control related things, we have two standards which are talking about quality control. One is we already know SQC1, and the other one which we have is SA 220. So we only have two standards which are going to talk about the quality control. Now, what is the difference between the two we have to understand? SQC1 is a quality control standard which will be applicable at the firm level. SQC1 is a standard which is talking about quality control at the firm level as an audit firm on an overall basis. At the firm level, how you are supposed to maintain the quality for all kinds of engagements. At the firm level, what kind of quality control system you should have. That's what is governed in SQC1. Whereas SA 220 is an engagement level standard. This is a what? Engagement level standard, which means it will only talk about specifically at each engagement, particularly for one engagement, how you are supposed to maintain the quality. So that engagement level quality guidance will be given by the SA 220. One more point of difference here, SQC1 will become applicable no matter whatever engagement you are doing. Be it audit, be it review, be it assurance, be it related service, for everything it will discuss. But SA 220 will talk about how to maintain the quality control only for audit engagement. For each audit engagement, how you are supposed to maintain the quality, that's what SA 220 is going to talk about. So these are the two main differences. One is at the firm level and the one is at engagement level. And one is applicable for all kinds of engagement and the other one is applicable only for audit engagement. Now, since we got familiar with the differences, let us now try to understand. Let us try to first start with SQC1. So if you look at the title of the SQC1, they say that quality control for firms that perform audits, review of historical financial information, other assurance and related services. So if you are a firm who is conducting any of this engagement, be it audit, be it review, be it assurance or be it related services, how you are supposed to control the quality, that's what SQC1 is going to talk about. So now what SQC1 particularly says is if you want to maintain quality control at the overall firm level in all the engagements you are doing, you need to implement some policies and procedures. What you need to do? You need to implement some policies and procedures in 6 areas. We are going into the technicalities of the standard now. Pay attention. So in case if you want to maintain quality control at the firm level, what SQC1 is expecting from you, you need to implement some policies and procedures. In how many areas? In 6 areas of your firm, you need to implement some policies and procedures. So what are that 6 areas? As you could see here, number one, leadership responsibility for quality within the firm, ethical requirements, acceptance and continuation of the client relationship and the specific engagements, human resources, engagement performance, and monitoring. 6 areas we have. So repeat that 6 areas: leadership responsibility for quality within the firm, ethical requirements, acceptance and continuation of the client relationship, human resources, engagement performance, and monitoring. So like that 6 areas are there. In each of this area, we need to have some policies and procedures. We'll pick up one by one and we'll try to understand what kind of policies we should have. First one, leadership responsibility. See, if you want to maintain quality within the firm, you should identify someone who will come forward and take the leadership responsibility. If I give to you class, if I give you a task you to fulfill, I did not make anyone specifically responsible. I told class as collectively will be responsible for completing the task. More chances that the task will never get completed because I did not assign the responsibility. On the other hand, within this class, if I identify 2, 3 people and I say these are the leaders and they will take up the responsibility on behalf of the entire class for fulfilling the task, more chances that task will get completed because I assigned a leadership responsibility. Same thing happens in the audit firm also. If you go to each and every person and say you have to maintain quality, okay, they will nod their heads, but quality will not be maintained. Someone from the firm should come forward and take the leadership responsibility for maintaining the quality within the firm. Who should be that someone in the overall firm? They say CEO of the firm or firm's managing partner. Who is it? CEO of the firm or the firm's managing partner, they should come forward and take the leadership responsibility. So that's what they say here. SQC1 requires the firms to establish policies and procedures to promote what? Internal culture based on recognition that quality is essential. We have to create such an internal culture. Being a leader, we should create such an internal culture that everybody is recognizing that quality is essential. And who will be the appropriate person to take the leadership responsibility? Firm's CEO or the firm's managing partner should take the ultimate responsibility. The example set by the firm's leadership encourages an inner culture. So, being a leader, by way of your actions, you have to set an example to others when it comes to implementation of quality control and all. And further, not just leaders, they will assign responsibilities. CEO or managing partner will take the leadership responsibility. But they will assign functions. No, you have to make sure that those people to whom the operational responsibilities are being given, they should also have sufficient and appropriate experience, ability, and also necessary authority. So this is what the leadership responsibility looks like. So mainly the key context here is CEO or firm's managing partner should come forward and take the leadership responsibility. They have to create a good inner culture where everybody is recognizing that quality is essential, not just a CEO or managing partner, to whomever they are assigning the operational responsibilities, they should also maintain the quality. They should also have enough of capabilities and competence. Next, ethical requirements. Second area where you need to have proper policies is ethical requirements. You should make sure that the firm and everybody is compliant with the ethical requirements. So in the ethical requirements area, if you look at the policies, they say that you should establish policies and procedures that provide you with reasonable assurance that firm and also all its personnel, everybody is complying with ethical requirements, including the code of ethics issued by the ICA. And the code establishes 5 fundamental principles, which we already know: integrity, objectivity, confidentiality, professional competence, due care, and professional behavior. And you should observe independence in all kinds of engagements. In all the engagements, you have to observe independence. When I say independence, who and all should be independent? Your firm should be independent. Your personnel should be independent. And your experts, in case if you are hiring any experts, even they should also be independent. I told you the concept of auditors experts. Even whichever auditors experts you are involving, they also should be independent. Not just that, even their firm and network firm personnel, everybody in that audit chain should be independent. And such policies and procedures should enable. So, how you can make sure that everybody is complying with independence? Number one, communication. Most important thing, communicate to each and every person whom you are involving in your firm how important it is to maintain independence. And identify and evaluate the circumstances and relationships which are creating a threat to independence. In case if there is any threat to independence, you have to take actions either to eliminate it or reduce it to an acceptably low level. If not possible, withdraw from the engagement. There should be a mechanism by which engagement partner should provide the firm with all the relevant information about client engagement and personnel of the firm, promptly notify firms of circumstances that create a threat to independence. There should be such a system in the firm where if anyone is noticing any threat to independence, they should immediately bring it to the notice of the firm. And all breaches of independence should be promptly notified. If there is any breach of independence, because of any exceptional circumstances, if any breach of independence has happened, that should be properly notified and appropriate action be taken. At this point, at least annually, at least once in a year, there should be a habit, there should be a practice that the firm should obtain written confirmation from all its staff that they are complying with the policies and procedures on independence. At least once in a year, ask the entire team to give that written confirmation. That means it is like reminding them everybody at least once in every year. So what is the importance of independence and all? So these kind of policies you have to follow in the area of ethical requirements. Then coming to the next area in which you need to have some policies and procedures is acceptance and continuation of client relationship. This point I have already explained in the audit planning, the preliminary engagement activities. Before you accept a client relationship or before you continue a client relationship, three factors you are required to evaluate. What are they? Integrity of the client, checking the competence of the engagement team, and compliance with ethical requirements. Now they elaborate it further here. Sir, you are asking us to, before saying yes to the client relationship, you are asking us to check the integrity. How I will know, sir, whether the client's owners and management is having integrity or not? How will I get to know? There are some matters which you have to consider. So, like matters that the firm considers to determine whether the client is having integrity or not. So, what factors you will consider? So, with regard to the integrity of the client, the matters that conform that the matters that the firm considers are examples. Like what are they? Identity and business reputation. What is the identity this management is enjoying? What kind of business reputation they have in the market? Are they known for good things or bad things? And the nature of clients' operations. Sometimes some operations will itself create a suspicion regarding integrity. Like for example, mostly when the people are into real estate business, obviously some doubt will come regarding their integrity and all. So like that, it depends on nature of business. It also depends on information concerning attitude of the client's principal owners. What kind of attitude your top level management, top level owners have. Whether the client is aggressively concerned with maintaining the firm's fees as low as possible. He's such a miser fellow where he's always concentrating on keeping the fees as low as possible. That means work can get compromised, but he's not ready to pay you more fees. That itself is indicating a non-integrity state. And indications of inappropriate limitation. He's unnecessarily coming and putting a restriction on the scope of your work, which indicates that management is not having integrity. And indication that the client might be involved in money laundering or other criminal activities. And reasons for proposed appointment of the firm and why the previous firm was not reappointed. In case if it is coming to you now, you have to check the integrity. One factor which you can consider is why the previous auditor resigned. If it is because of a natural rotation process, his tenure is completed, that's why you are getting appointed, well and good. But in case if you are getting replaced by another, you are replacing another person, you should understand what are the reasons why the previous auditor has resigned and for what reasons they are appointing you. So these are all the matters which auditor will consider in determining whether the integrity is there or not. Second, conflict between the firm and the client. So what they're saying, if there is any conflict of interest between firm and client, it should be properly resolved. Don't accept the engagement when the conflict is still pending. If there is any conflict between you and the client, first resolve that matter, then only accept the engagement. And where the firm obtains information that would have caused it to decline an engagement, if that information has been obtained earlier, that means you have accepted the engagement. After accepting the engagement, you are getting some information. And if you believe that had I known this information earlier, I would not have accepted that engagement only. I would have declined that engagement only. Such a information you got to know about it now, what you will do? What you will do? So they say that where the firm obtains information that would have caused it to declare an engagement, if that information has been obtained earlier, policies and procedures on the continuation of the engagement and client relationship should include consideration of. In that cases, you have to decide whether it will be suitable for me to continue the engagement or not. On what factors you will decide? Now you got to know the information here. You are feeling that had I known this information earlier, I would have declined the engagement. Now obviously a question will come into your mind. Now I got to know, should I continue this engagement or not? So while taking that decision, what things you will keep in mind? Number one, the professional and legal responsibilities that apply to the circumstances, including whether there is any requirement for the firm to report to the person or the person who made the appointment. or in some cases to regulatory authorities. In that exceptional circumstances, first communicate this matter. Sir, you don't tell me this information. Now you are telling me this information. So go and communicate your responsibilities with the people who have made the appointment. In some cases, you might be required to go and report to the regulatory authorities also in some clients and all. The possibility of withdrawing from the engagement, if possible, withdraw from the engagement. Next. So these are the policies which you need to have in the area of acceptance and continuation of client relationship. Thereafter, we have human resources. So if you want to maintain the quality in all the engagements you are doing, the first thing is you need to have a proper staff. You need to have proper human resources. You should have proper human resources. You should have such kind of policies and procedures which will give you reasonable assurance that you are having qualified, competent, capable people who will do the proper work and give the appropriate reports. So if you want to make your human resources capable, competent, and make them provide relevant services, even in your HR department also, you need to follow some policies. Like what policies, sir? Like as you could see here, there should be policy for recruitment. Just like that, anybody you should not recruit. There should be a proper policy for recruitment. Compensation, pay them proper compensation. Training, just recruiting them and giving the work is not enough. Train them properly. Career development, show them the opportunities for career development. Performance evaluation, don't just assign the work and ignore, do the performance evaluation. How far they have performed better, or is there any scope for improvement? So that performance evaluation you are required to do it. So these kind of policies you have to follow in the area of human resources. Then we have engagement performance. Next area where you need to have policies and procedures is engagement performance. That is when the engagements are actually getting performed. Or during the performance of the engagements also you need to maintain some policies and procedures. Like what? This area is very important. Consistency in quality of engagement performance. So if you want to consistently maintain quality in the engagements, what things you are required to do is at the time when the engagements are getting performed, briefing of the engagement team. Don't just ask the engagement team to jump into the audit. Tell them, give it a bit briefing. That's why we have briefing meetings before engagements are happening, so that everyone will become aware of the common objectives. Processes for complying with engagement standards. Don't call your team and say comply with standards, comply with standards. Tell them what process they have to follow for complying with the standards. Process for engagement supervision and training. To properly supervise them, properly train them. Methods of review. As I've told, don't believe anybody's work unnecessarily. You have to review the work performed by them. And even appropriate documentation. Make sure that each and every team member is maintaining a proper documentation. Next one. In case if there is any difficult or contentious matter, sometimes during the course of audit, a difficult or contentious matters will come. In that cases, there should be proper consultation. They have to take proper consultation. When I say proper consultation, either they can go for internal consultation. Internally, they will have some experienced partners and all. You can take their consultation. If you don't have enough of expertise inside, even you can go for external consultation also. You can approach the another audit firm asking them for their advice. So like that, if there is any difficult or contentious matter, you can get the consultation that difficult or contentious matters. And as I have told, if there is no one internally, either you can take the advantage of advisory services also. And significant judgments, whatever have been made in the audit, should be reviewed by an engagement quality control review. Now there is a concept called engagement quality control review, EQCR. Sir, what is this EQCR? EQCR means there will be engagement team. Now this engagement team will complete the audit. After they have done all their audit procedures, just before they express the opinion, a person who is other than a part of the engagement team, within the same firm only, but a person who is not a part of engagement team, he will come and review all the significant judgments made by engagement team. That process we call it as engagement quality control review. The name itself says whether within the engagement quality control is there or not, someone will come and review. This process we call it as what? EQCR, engagement quality control review. And the person whoever is reviewing it, that person will be called as engagement quality control reviewer, we call them. And this process of EQCR is mandatory in the case of audit of listed companies. Where it is mandatory, in the case of audit of listed companies, it is mandatory. Where an engagement team will be there, they will complete the entire audit just before expressing the opinion. Someone from the firm, but who is not a part of the engagement team, he will come and review all the significant judgments made by engagement team. So this process we call it as engagement quality control reviewer. So that's what they say here. Significant judgments made in the engagement should be reviewed by EQCR for taking an objective view before the report is issued. The extent of review. What extent of review this reviewer will do? EQCR, whether it will be a bigger review or shorter review. It depends on various factors like complexity of the engagement, the risk, and various other factors. The review does not reduce the responsibilities of engagement partner. One more important point. See, if the engagement quality control has conducted the review, thereafter engagement partner signed the audit report. Tomorrow, if the audit report has gone wrong, engagement partner will be definitely made responsible. Can the engagement partner shift the responsibility or the engagement quality control reviewer? Sir, why are you punishing me only? That person also came and did the review. He was also not able to find out. I want a company in the jail. Please call him also. Can you say it like that? No. So there will be no reduction. There will be no reduction in the responsibilities of the engagement partner. You only have to face the consequences. Engagement quality control review. This EQCR is mandatory for audits of financial statements of listed entities. In other entities, the firm will devise criteria. For listed company, mandatory. You have to do it. But what some firms will do is, in other than listed companies also, they do EQCR. They will devise one criteria. If the turnover is more than this figure, we'll do engagement quality control review, even if not a listed company. So like that, the firm will decide the criteria for other than listed companies. There might be a difference of opinion. Now, during the course of audit, differences of opinion will come. Sir, between whom, sir? Between the members of the engagement team, differences will come. Between engagement partner and engagement quality control reviewer, differences will come. Engagement partner is saying something. EQCR came and did the review, but he is having some different view. So there could be difference between engagement quality control reviewer and engagement partner. So in all that cases, if there is any discrepancies, if any issues are coming, all that must be resolved. Report should be given only after all that issues have been resolved. In case, see, this point is important, recommendations of engagement quality control reviewer are not accepted by engagement partner. Engagement partner is saying something, he completed the entire audit. Came for review. He gave some different recommendation. No, this judgment is wrong, this should be correct. But engagement partner is not accepting. I am also a chartered accountant, I am also in practice. Who the hell are you to say me? He is saying he is not agreeing with the recommendations of the EQCR. And the matter is not resolved to reviewer's satisfaction. That means reviewer is saying something, engagement partner is not agreeing. So there is a conflict here. There is a bottleneck here. The matter is not proceeding further. In that case, what should happen? The matter should be resolved by following established procedures of the firm. Sir, if no one is coming to conclusion, both are having their own points, engagement partner and engagement quality control reviewer, then what should happen, sir? In every firm, there will be one established procedure. Like let us say, for example, in one firm, there is an established procedure that if there is a difference between engagement partner and engagement quality controller, they will go to the managing partner. Whatever managing partner says, that will be final. So like that, every firm will have an established procedure. That established procedure they have to follow and resolve the matter. So that's what they say here. Like they have to follow the established procedure of the firm by consulting with another practitioner or firm, or even asking to ICA. So like that, whatever established procedure is there, that they have to follow. And also, the firm should complete the assembly of the final engagement. Just in the audit documentation topic, I have to. After you are done with your reporting and all, you have to assemble the audit files and all. In case of audits within 60 days from the date of auditor's report, you have to assemble the final audit file. And policies and procedures should be designed to maintain confidentiality, safe custody, integrity, accessibility, and retrievability of documentation. Just maintaining documentation is not enough. You should have policies to keep that documentation confidential, and you should keep it in the safe custody. You should be honest with that. You should maintain honesty over that documentation. It should be accessible whenever you want in future. You should be able to access it. You should be able to retrieve it. The firm may at its discretion make portions from documentation available to clients. Documentation is their property. It is at their own discretion. It is at their own choice. If they want to share the copies of the documentation, they will share it. If they don't want to share it, they will not share it. That is purely their property. Next. Thereafter, engagement documentation has to be retained after you have completed your audit file and all. You have to retain. In case of audit, the retention period is 7 years from the date of auditor's report or the group's audit report, whichever is later. And yeah, so that's what they say here. You have to retain it. In case of audit engagement, the retention period is 7 years. So in the 5 areas, you have implemented policies. In the leadership responsibility area, you have implemented policies. In the ethical requirements area, you have implemented policies. In acceptance and continuation of client relationship, you have implemented the policies. Human resources, you have implemented. Engagement performance, you have implemented. Just implementing all these areas of us, just implementing all these policies alone will not be enough. Even there should be monitoring also. Should have one dedicated area of monitoring whatever policies and procedures that you have implemented in all that quality control system. Are they relevant? Are they getting followed? Is there any requirement to make any changes? Is there any requirement to add or delete anything from that policies and procedures? That continuous monitoring also should happen. So that's what they say it here. the firm should ensure that policies and procedures relating to system of quality control are relevant, they are adequate, they are operating effectively, and they are compliant. Everybody is complying with them. It should include an ongoing consideration and evaluation of firm system of quality control, including a periodical inspection of completed engagements. Once in a while, of the engagements, whatever you have completed, take one or two engagements and review them, inspect them, whether in that engagement, whether our entire firm has complied with the quality control system or not. So that periodical inspection also should happen. So these are all the 6 areas where you need to implement the policies and procedures. Now comes SA 220. I've already told you SA 220 is just SA 220 has actually been taken from SQC1 only. The only difference is SQC1 will talk about the overall form level, SA 220 will talk about only at audit engagement level. So now here they have given a few definitions here. Who is engagement partner? Long ago we have covered the person who has taken the responsibility for the audit of the financial statements. Who is engagement quality control? What is engagement quality control review? Just now as I have told. And what is engagement team? All the people, this engagement team also in that introduction part only we have covered. What is an engagement team? Now, let us come to the quality control system. Sir, if you want to maintain quality at the audit engagement level, what kind of quality control system you should have? SA 220 also says the same thing. You need to follow some policies and procedures. In how many areas? Once again, 6 areas. Sir, what are that 6 areas? Leadership responsibility, ethical requirements, acceptance and continuation of client relationship, assignment of engagement team. For human resources only, they replace it with the engagement team. Engagement performance, and then finally monitoring. Let us see here what they say. Leadership responsibility. See, at the firm level, CEO or managing partner is taking the leadership responsibility. At the engagement team level, who should take the leadership responsibility? Engagement partner should take the leadership responsibility. What do you mean by taking leadership responsibility? Go to everybody and say that I'm a leader. No one is going to listen. Then what you should do? By way of, you have to communicate. By way of your actions, by way of your communication, you have to highlight the importance of quality for each and every member. And that's what they say here. The actions of the engagement partner and appropriate messages to other members of the engagement team in taking responsibility should emphasize the importance of quality. By way of your actions, by way of your messages, you have to convey that how much important the quality is. And also, you have to emphasize that performing work that complies with professional standards. Let your team know by way of your actions, by way of your messages, how important it is to do the work which is complying with the professional standards. How important it is to comply with the firm's quality control system. Let them know at the firm level, as per SQC1, we have policies, how important it is to comply with that firm's level of quality control system. Let them know. In issuing auditors report that are appropriate, make your team aware how important it is to issue the appropriate report. Let them know what will happen if you don't give appropriate audit report. Say that if we don't give proper audit report, we all have to go and sit in the jail. But that will not happen. What will happen? If you don't give audit report, I will go and sit in the jail. That's what they have to say. But no one will fear, no. So that's why you have to say this. If you don't go and give the proper audit report, we all have to go and sit in the jail. Like that, you have to say. Next, the engagement team's ability to raise concerns without fear of reprisal. So when you are an engagement partner, don't behave like a weird guy. So you should create such an environment where everybody will be able to raise their concerns without any fear of reprisal. Hey, if I go and ask a doubt to this fellow, he will shout like a dog. I will not go to him. They should not feel like that. You should create such an environment where people will be able to raise their concerns without any fear. And the fact that quality is essential. Always mention the fact that quality is essential. So being a leader, this is what you are supposed to do. Next, ethical requirements relating to an audit of the financial statements. When you are doing audit of the financial statements, here also same thing. You are required to be independent. Same points they say. If you find any threats to independence, you are required to apply the safeguards to either eliminate it or reduce it to an acceptably low level. And in case if you are an engagement partner, for your engagement, if you find any threat, you should immediately take it to the notice of the firm. Same point we have seen from the firm side in SQC1. We told that in the firm there should be a policy where engagement partners will go and communicate the breaches with the firm. Now here they are talking from the perspective of engagement partner. Being an engagement partner, if you find that in the engagement to which you are assigned, if there is any breach of independence, if there is any threat, you have to immediately go and report it to the firm. Acceptance and continuation of client relationship. This point we have already covered it. Before accepting and continuing client relationship, few factors you have to evaluate. What are they? Integrity, competence of the engagement team, compliance with ethical requirements, even significant matters arising during current or previous audit engagements. In the last year, whatever matters have arisen, that also you have to consider before accepting or continuing client relationship. Then assignment of engagement teams, nothing but other name for human resources. Engagement team is nothing but your HR for the purpose of audit. So it should be ensured by engagement partner that engagement team and any auditors experts who are not part of the engagement team, they all should have competence, capabilities to perform the engagement in accordance with the professional standards. All that policies you implement to make sure that all your engagement team, including experts, are having competence and capabilities. Finally, engagement performance. So engagement partner has a responsibility. Who has to direct, supervise, and review the work of the engagement team? Engagement partner should do that. And he is responsible for auditor's reports being appropriate in the circumstances. Ultimately, who will be responsible for the report? Engagement partner. So that's why he has to review the documentation. And also you have to check whether your team has obtained sufficient and appropriate audit evidence. And he is also responsible for ensuring undertaking appropriate consultation in difficult matters. Same from SQC1. If there is any difficult or contentious matter, engagement partner should take the responsibility to undertake the consultation. Next. For audit of financial statements of listed entity and those other audit engagements, if any, for which the firm has determined, engagement quality control review is also required. Just now, as I've told, in case of listed companies, EQCR is mandatory. Apart from that, firm also can devise a criteria and they can decide for which firms they are going to do this quality, this EQCR. So in case of audit of listed companies, the engagement partner shall determine that engagement quality control review has been appointed. It is your responsibility because you are responsible for audit. Since you are conducting audit of listed entity, it is your responsibility to make sure that for your audit, whether an engagement quality control reviewer has been appointed or not. And once that engagement quality control reviewer has been appointed, discuss significant matters arising during the audit engagement, including those identified during engagement quality control review with the engagement quality control reviewer. Whatever matters you feel it as significant, discuss with the engagement quality control reviewer. Not date the auditor's report until the completion of EQCR. 100%. First EQCR has to be completed, then only you should give the report. So that's why don't mention the date of auditor's report prior to the date of completion of EQCR. Next, if differences of opinion arise, as I have told, if there is any difference of opinion, either within the engagement team, with those consulted, between engagement partner and engagement quality control reviewer, you have to resolve all that differences before you express your reports and all. And then finally, here also monitoring. So you should have a proper monitoring process, not just implementing policies and procedures, whether those policies and procedures are relevant, adequate, and whether they are operating effectively or not. You need to check it. And you should also consider the results of firm's monitoring process as evidence in the latest information circulated. See, as per SQC1, firm level monitoring will happen. So when they have done the firm level monitoring, they will identify some issues. All that information will be circulated to all the respective engagement partners. So consider it. Next, the engagement partner should document the following relating to the engagement. So, what things you have to document? What issues you have identified with respect to compliance with ethical requirements? What issues you have faced regarding the compliance with ethical requirements? Conclusions on compliance with independence requirements. How you have concluded that your team has complied with the independence requirements. Conclusions reached regarding the acceptance and continuation of client relationship. How you have decided whether it will be appropriate to accept or continue the client relationship or not. And nature and scope and conclusions resulting from consultation. In the difficult or contentious matters, you would have undertaken consultation. No? From that consultation, what conclusions you have reached. So specifically, these things you are required to include in your documentation. Clear? So this is what regarding SQC1 and SA200. So since we are done with the standards, what we will now try to do is we will try to go to the audit sampling chapter. Audit sampling, analytical procedures, these two we will do it. I told you risk assessment, I might not be able to do it. If not, the video which I will upload, no, in that I will attach that risk assessment part and I will upload it. But we will try to now the next agenda is going to be we have to complete the audit sampling and analytical procedures. We will try to Perfect. So we'll try to do now audit sampling. So audit sampling as a chapter, it is also a standard only. It is also a 500 series of the standard. And the standard which is talking about this concept of audit sampling is SA 530. So what exactly is the concept of sampling? See, traditionally, what people used to do 100% verification. And traditionally, it was possible also. Why? Because businesses used to be not that large. Businesses used to be small, limited number of transactions, limited volume of the transactions. So 100% verification used to be possible. But over a period of time, people have started realizing that this doing 100% verification is not yielding them any benefit. They're not going to get any value addition by doing the 100% verification. Why? Because the logic behind that is day by day, the companies are increasingly focusing on internal controls. The companies are increasingly focusing on internal controls. Every business is looking for internal controls. There used to be no such awareness regarding internal controls in the past, but now the people have started taking the internal controls seriously. Now, when the organizations implement the internal controls seriously, many of the frauds and errors will get prevented by internal controls only. Many of the frauds and errors, many of the misstatements will get controlled at the internal control level. So there is no purpose, even after with that much system of robust system of internal controls also, there is no purpose of doing the 100% verification. And people, the human civilization itself, when they find something as redundant, they always come up with something to overcome it. They always come up with something to overcome. So what they have done, even in audit is also not an exception for that. Even they have also felt that in the audit, 100% verification is becoming very mechanical. It is not yielding any benefits and all. So that's why slowly they have started bringing the concept of this sampling. So that's what the first part you will be able to see. Relevance of audit sampling in modern audit practices. So what happened in the past, what has happened now, why we have migrated to sampling and all. So that's what this I have summarized it here. So, what is the solution for this? The solution for this is we have to go for sampling. Sir, what is the meaning of the term sampling? What is the meaning of the term sampling? So, FA 530 defines the term sampling something like this. Audit sampling refers to application of audit procedures to less than 100% of items in the population. What they have told? Audit sampling refers to performing of audit procedures to less than 100% of items in the population. They did not say performing audit procedures to 50%, 100%, 50%, 60% like that. They did not say. But instead, what they have told, applying audit procedures to less than 100% of the items in the population. When they say less than 100%, it could be 10% also, 5% also, 50 also, 60 also, 99 also. But whatever it is, you are not performing audit procedures on 100%. You are performing audit procedures on less than 100% of items on the population. With what objective? Form a conclusion. You will form conclusion on what? So there is a population here. So first thing we have to understand a few terms here. Population. So what is the meaning of the term population? 140 crores, sir. Not the population. So the population means that data, that number of entries, the number of transactions. So that is what the population here. So there are 100% of items in the population. The population contains so many items. In that, what you will do is a small sample you will select. Let us say, for example, I told you less than 100%. It could be anything. Once again, auditor's professional judgment. Let us take, I have taken a sample of 5%. And on this 5% of the sample, I will perform audit procedures. So I am applying audit procedures to less than 100% of the items in the population. By performing that procedures, I want to form a what? Conclusion. On what I want to form a conclusion. By performing that audit procedures, will I form a conclusion only on the sample I have selected, or will I form a conclusion on the entire population from which the sample has been selected? I will form a conclusion on the entire population from which the sample has been selected. That's what the whole purpose of the audit sample. Okay, so if you look at the definition in a detailed manner, so according to SA 530, audit sampling, it refers to application of audit procedures to less than 100% of items within a population relevant under audit. And you will select that items in such a manner that all sampling units have a equal chance of selection. To the extent possible, whenever we are selecting a sample, we select the sample in such a manner that every sampling unit will have a equal chance of selection. So now what is a sampling unit? Three terms. Population you understood. Let us say if I am verifying purchases, total 10,000 entries are there. The total 10,000 entries will become population. each and every entry will be called as sampling unit. Individually, each and every unit will be called as what? Sampling unit. I have total purchase population of 10,000. Each and every purchase entry, total 10,000 sampling units are there. So from that, I have taken a sample of 500. So that 500 units, I will be calling it as sample. So sampling unit means, do we have? Yeah. So we audit sampling means we are performing audit procedures to less than 100% of the items in the population, and we try to select the sample in such a manner that every item will have an equal chance of selection. And this is to ensure that why we should try to give equal chance of selection. Why? Because items selected represent the entire population. So we are selecting the sample in such a manner that the items whatever you have selected, that should be representing entire population. It should not be that, see, if the population is having some 10 characteristics, in the sample we have collected also, there should be more or less 10 characteristics. It should not be like whatever sample we have selected that is representing only one characteristic. It should not be like that. Next. So what is the objective of the audit? Why we are doing the sampling? What is the whole objective of doing the sampling? The whole objective of the sampling is to provide a reasonable basis for the auditor to draw conclusions. Conclusions about what? About the population, not just the sample. We are not going to just form a conclusion on the sample. We are going to form a conclusion on the entire population from which the sample has been selected. Now, see, one question I have to ask you here. Do you think sampling is mandatory? Do you think auditors have to compulsorily verify the transactions on sampling basis? We have a dedicated standard SF530. Think and tell me. Verification of transactions on sampling basis is not mandatory. The standards only say the objective of the auditor is to express an opinion. Whether you do it by doing 100% verification or you do it by doing sampling, the standard is not bothered. The only objective is to express an opinion. How you are going to do it, that is your professional judgment. See, SA 530 does not say that you have to verify the transactions on sampling basis. They did not say it. What SA 530 in fact says is, in case as an auditor, you have already decided using your professional judgment that you are going to verify the transactions on sampling basis, then SA 530 will come into picture. When as an auditor, using your professional judgment, you have taken decision that you are going to verify the transactions on sampling basis. Now SA 530 will come into picture and it will give you guidance. It will give you guidance regarding which approach to follow, what things you have to consider, what characteristics you have to consider, which approaches you have to follow, what methods are available. Then SA 530 will pitch in and give you the guidance. Does that mean there could be a few instances where we can do the audit and SA 530 will not become applicable? Could there be instances where we are doing the audit, but for that audit SA 530 is completely irrelevant? Could it be possible? 100% possible. So when we are doing the audit, and by some chance, by using our professional judgment, if we have decided that I will not verify the transactions on sampling basis, but instead I will do 100% verification. If you have decided that, then SA530 doesn't have any role to play. No role for SA530 there. So SA530 will come into picture only after you have taken a decision using your professional judgment that you are going to verify the transactions on sampling basis. Then only SA530 will come into picture. If you have decided to do 100% verification, then SA530 will not have any role to play in that circumstance. Then coming to the next part here, so they say one small paragraph here. If you are, I have already explained you what is the meaning of this population sampling unit at all. They say that if you want to perform audit procedures on a sampling basis, and by doing that sampling, if you want to have best results, if you want to have better results, if you want your sampling to make a sense, if you want your conclusions from the sampling to be correct, then the population from which you are selecting the sample should have some characteristics. If you want your sampling results, if the conclusions, whatever you are reaching by performing audit procedures on the sample, if you want that conclusions to be appropriate, then the population from which you are selecting the sample, that population should have characteristics. So what are the characteristics? They say three characteristics. Number one, appropriateness. Number two, completeness. And number three, reliability. So what is this appropriateness? Appropriateness means only those items should be there in the population which are appropriate for the purpose. The population should contain only those items which are appropriate for the purpose for whatever you are performing the audit procedures. I'll give you one simple example. So, in this class, I want to test the level of understanding of audit of the CA inter students. I want to test the concept of audit reporting, understanding of the students of CA inter. So now this class is my population. Let us say in this class you are all there. In addition to that, in this population, in this classroom, there are a few CA final students also. There are CA final students also. By some chance, in this class, along with the CA inter students, there are some CA final students also. But my objective is to test the understanding capability of audit reporting chapter of the CA inter students. That is what my purpose. If my purpose has to survive, my population should be appropriate. My population should contain only those items which are appropriate for my purpose. In this case, my population contains some items which are not appropriate for my purpose. CFN students are also there. So my purpose is not applicable for them. So if you want your sampling results, sampling conclusions to make some sense, then the first characteristic, the population from which you are selecting the sample, that population itself should be appropriate. Clear? Next, second characteristic, completeness. So if your population should be complete, you should not be taking the sample from an incomplete population. If you are selecting the sample from an incomplete population, then your sample results will not be correct. Once again, let us bring back to the classroom analogy. Let us say you are all my regular students. Okay, so now I have taught you some concepts. Thereafter, some holidays came. Let us say 1 week holidays came. You have all gone for vacation. Now I want to test. After you come back from the holidays, I want to test your understanding. I want to test your understanding of that concept of audit reporting or some other chapter. So immediately what I am doing is after 7 days, next day when the college reopened, those students who have come, from them I am selecting the sample. Definitely on that day class will be incomplete. So no, next day after the holidays and all, and 1 day before the holidays and all, classes all will be empty or not. That's what we have done in our schools and all. So in case, let us say for example, the day immediately after the holidays, when I come to the class, 10 people are there. From the 10 people, 2 persons are selected. So definitely those who are serious students, they will only come immediately after the class. So from that I have selected 2 people. I have asked the question. I got excellent answer. Can I make a conclusion about the entire class that this entire class is having an understanding of audit reporting? Why? Because we have performed the sample on a inappropriate sample, incomplete sample. Third, third characteristic which your population should have is reliable. The items in your population should be reliable. Let us once again bring back to the classroom analogy. I want to ask the questions. Okay, I'm calling one person. I took one sample. I'm calling one person and I'm asking the question. But the other person, he is giving me answer, but not genuinely he was giving me answer. The answer was passed on by the person who is sitting beside him. Who is sitting beside him, he is passing on the answer and he gave the answer. Now you tell me, are the items in my population reliable? No. On that basis, if I get the results, on the basis, I have selected the sample, and if I analyze that results, on that basis, if I want to form the conclusion, will my conclusions be appropriate? Definitely not. So if you want your sampling results to be accurate, then the population from which you are selecting the sample, it should contain some characteristics. 3 characteristics it has to contain. What are the 3 characteristics? Appropriateness, completeness, and reliability. Okay, next. Coming to the next concept from this SF530, what are various approaches to sampling? What are various approaches to sampling? So there are 2 broad approaches for sampling. How many we have? 2 broad approaches to sampling we have. What are they? Statistical sampling and non-statistical sampling. Sir, what is statistical sampling? So statistical sampling refers to such a sampling approach which will have certain characteristics. So what characteristics? There will be something called random selection. Characteristic number 1. There will be something called what? Random selection. What do you mean by random selection? Every item will have an equal chance of getting selected. So they will not have any kind of bias. In the statistical sampling, we use scientific methods. So which is scientific methods? Statistics and mathematics, probability theories we are going to use. And that method is going to be very objective. Objective means what? Unbiased. Since you are giving every item equal chance of selection, there will be unbiased also. And we can measure our risk. There will be something called sampling risk characteristics. Since we are using the scientific methods and all, we can statistically measure how much risk we are taking. So the any approach which is having all these characteristics, what are they? They should be random selection, and this method should be scientific, it should be objective, and we should be able to take a calculated risk, that sampling risk characteristics we call it. That approach we are going to call it as what? Statistical sampling. So then what is non-statistical sampling? Any sampling approach which doesn't have the characteristics of statistical sampling, that will become a non-statistical sampling. So that means there will be no random selection. This method is not going to be scientific. This method is not going to be objective. We don't have any sampling risk characteristics. Then it will be called as a non-statistical sampling. So then how, sir? You are telling it this method is not going to be scientific. There will be no random selection. There will be no sampling risk characteristic. Then how the sample will be selected, sir? Purely on the basis of the professional judgment. Purely on the basis of professional judgment. This method will be not scientific. Here we don't use any scientific concepts. This method will not be objective also. We cannot eliminate the bias in case of non-statistical sampling. We can't eliminate bias in deciding in taking the non-statistical sampling. Bias will always be there. Wherever professional judgment is there, there will be bias. Bias cannot be eliminated. So this is what the two broad approaches, statistical versus non-statistical. So you tell me which one is better. Comparatively, if you do, which one is less risky? Let me put it this way: which one is going to be less risky? Statistical sampling is going to be less risky. Why? Because it is scientific, objective. If see how the problem will come is, let us say you have performed audit, you have selected the sample using the statistical sampling. So you did not find out any material misstatement, but later a big fraud was unveiled in the company. Now definitely regulatory authorities will question you. Because there is a fraud in the company, why you are not able to identify? You will say, sir, that did not come into my sample. Now the regulating authority will ask you on what basis you have selected the sample. You will say, I have followed so and so statistical method. Now they will not ask you to prove why that statistical method is appropriate. Why? Because those are all proven scientific methods. But in case if you say that I have selected the sample using a non-statistical sampling, I have used my professional judgment I have selected, the counter question will come to prove your professional judgment. So whether you will be held responsible or not, let us keep it aside. But one more layer of verification you have to do. One more layer of justification you have to do. That itself is a more risky or not? Yes. So when you do a comparative study between statistical versus non-statistical, which one is less risky? Statistical. Does that mean, did I say to follow only statistical sampling? No. We just did a comparative study. Nowhere I told you that you have to compulsorily follow only statistical sampling, ignore non-statistical sampling. I never said that. Understood what I'm trying to convey? So ultimately, whether auditor will go for statistical sampling or he will go for non-statistical sampling, that is something which has to be decided by auditor using his professional judgment. Okay. So these are the two broad approaches to sampling, and this thing we will do. Advantages to statistical sampling. This one small concept we will do. So what are advantages? So you are saying statistical sampling will be less risky than when compared to the non-statistical sampling. So what will be the advantages of the statistical sampling? So they say that amount of testing does not increase in proportion to the increase in the size of the universe or population. See, if 1,000 entries are there, let us say for example, 10,000 entries are there. From that, I have taken a sample of 500 by following statistical sampling. If 1 lakh entries are there, do you think will see that means if the population size increases by 10 times, will I also increase my sample size from 500 to 5,000? Not necessary. Not necessary. Why? Because in 10,000 entries, if I have selected 500, in 1 lakh entries, I might select only 1,000. Why? Because no matter what is the size of the population, I'm randomly picking. I'm giving every item equal chance of selection. I'm not saying that if the population size increases, sample size will not increase. I did not say it. I'm saying that when the size of the population increases, sample size also increase, but not in proportion to what the size of population is increasing. If the population is increasing by 10 times, that doesn't mean my sample also increase by 10 times. That will not happen. Next. The sample selection is more objective, it is more unbiased, therefore more defensible. Defensible means what? That will fight against you. If tomorrow, if someone is making an allegation that your sampling is wrong, no, you can defense it. You can take a defense. You can justify. I followed statistical sampling, so these are all globally accepted methods. So it can be more defensible. This method provides a means of establishing a minimum sample size with a specified risk. With a small sample size, you can take a limited risk also. And it provides a means for deriving a calculated risk. As I have told in statistical sampling, here the risk which you are taking will be a calculated. There will be nothing called unlimited risk and all. There will be a calculated risk which you will be taking. and it may provide a better description of large mass of data than the complete examination of entire data. See, this is not just advantage of statistical sampling, this is an advantage of overall sampling. So instead of doing 100% verification, if you see, I will give you two options. There is a 100% data, 10,000 entries are there. I gave you 10 days of time and asked you to do 100% verification. And another option, 10,000 transactions, take the sample, take 3 days of time and arrive at a conclusion. Where you will get better understanding of the data. If you do 100% verification, you will get better understanding of the data. Or within the 3 days, if you are doing the sampling, you will get better understanding of data. Sampling, you will get better understanding. How? Because if I ask you to do 100% verification, your focus will be on completing. You will not go into the technicalities. But if I give you sampling, so instead of concentrating on routine checking, first you will try to understand the system in a detailed manner and get a better understanding of the entire process, not the transaction. So this is one advantage of overall sampling, not just a statistical sampling. This is an advantage of sampling process itself. It will give you a better description of large mass of data. Then it is widely accepted, which means non-statistical sampling is a widely accepted way of sampling because it is more scientific. There will not be any personal bias, and result of the sample can be evaluated, and even you can do easy projections. What is projection? I will tell you in a short while. At the end of this chapter, we have a concept called projection. They will explain what do you mean by projection of the statements. So these are the advantages of the statistical sampling. Now these are all repeated things only. What is the difference between sampling versus a traditional method of auditing and all? Repeated things will be there. We'll come to the main point here. So factors which are required to be considered for deciding upon extent of checking on a sampling plan. We're able to find one heading called factors which are considered by the auditor for deciding upon extent of checking on a sampling plan. Sir, what is it? This is something related to the point which we have already covered. As I have told, there is no mandatory requirement that auditor should compulsorily verify the transactions on sampling basis only. The standards only says have to express an opinion whether you will do it by 100% verification or by sampling. That is your choice. So, how the auditor will decide using professional judgment, but which factors he will consider. So when they say extent of checking on a sampling plan means whether you will do 100% verification or you will go for sampling. That who will decide? Audit. How he will decide? Professional judgment. But while taking that decision, what and all factors he will consider? Whether he will go for 100% verification or he will go for sampling, that will be decided on the basis of what factors. They say that it depends on a few factors like size of the organization. Size of the organization. If you are conducting audit of a very large entity, 100% verification will become close to impossible. There you have to go for sampling. It depends on state of internal controls. If the internal controls are very much effective, you will be more comfortable going with the sampling. It depends on adequacy and reliability of books and records. If the books and records are more reliable, more adequate, then you will be more comfortable going for the sampling. Tolerable error range. How much error you can tolerate. So tolerating means how much you are willing to accept, how much error you are willing to accept. Some people can tolerate, can take more risk. If they are able to take more risk, they will go for sampling. Some people will not be able to tolerate any error at all. They are very cautious. They don't want to take any chance. Then you will not have any other option. You might be required to go for 100% verification. And then finally, degree of desired confidence. If you are comfortable with the normal level of confidence, you will go for sampling. If you are such a person who want 100% confidence, you have to go for 100% verification. So these are the factors which will help the auditor in deciding upon extent of checking on a sampling plan. Simply put, whether auditor will go for 100% verification or he will go for sampling, that depends on what factors. Five factors they have told: size of the organization, state of the internal control, adequacy and reliability of books and records, tolerable error range, and also degree of desired confidence. Now, before we come to this requirement as to sample design and all, first we will try to do this one part here, methods. What are the various methods for sampling? Sample selection methods. I will come back to the other part later. But there is a concept called sample selection methods. So what methods are available for performing the sampling? So we have various methods, but here mainly they address five methods. We have something called random sampling. Then we have interval sampling or systematic sampling. Then we have monetary unit sampling, haphazard sampling, and then finally block sampling we have. Totally how many we have? Five. We have five methods we have to understand. So what is it? Random sampling, systematic sampling or block sampling. Then we have systematic sampling or interval sampling, monetary unit sampling, haphazard sampling, block sampling. One by one we will try to do. First one is simple random sampling. In the random sampling also two categories we have. First method is random sampling, and in the random sampling also we have two methods. What are they? Simple random sampling and stratified random sampling. So first I will address the simple random sampling. So let us say for example this class is there. Let us say some 100 students are there. Now within that 100 students I need 10 students in my sample. So how can I make sure that I have to pick 10 students? So if I have to pick the 10 students, I can do one thing. One person I can pick. By looking at the faces, I will call in this person, this person, this person, this person. Like the 10 people I have called. But by doing it, I'm doing in a biased manner. No? So since I have been watching you, see if you are my regular students also, since I have been watching you for a long period of time, I know who will listen to the class, who will not listen to the class, from whom I can expect the response, from whom I cannot expect the response, I will know. So when I'm looking at the faces and pointing you, that is a bias. Now I want to eliminate that bias. What I have to do? Roll numbers I will call out. Let us say for example, I will call out the roll numbers. So what I am doing is I'm calling out the roll number like 5, 10, 15, 20, 25 like that. I'm calling out some 10 roll numbers. Am I unbiased here? No. To some extent, in the roll numbers, in the way I am calling out the roll number, there is a bias. There is always multiples of bias. Like that, even when I call out the roll numbers, also some kind of bias will be there. I want to eliminate that complete bias. So now what you can do is you can take the help of some statistical tools like random number generators, random number tables. So one simple tool what you can do is you can go to the Google and search for random number generator. A page will open. So there you have to enter what is the minimum value, maximum value. I will enter roll number 1 minimum, roll number 100 max, and click on generate random number. There will be one option called generate. Now randomly system will throw at you one number between 1 to 100. The system is telling me 9. I will call 9. Then the system next it says 33. I will call 33. Then the system says 1. I will call 1. So like that 10 times I will click the generate random number, and whatever random number generated on the system, that I will call it out in my sample. So this method we call it as simple random sampling, where we have given equal chance of selection for each and every item, and we have taken the help of some statistical tools like random number generators, random number tables to eliminate the bias completely. So this we call it as simple random sampling. But the problem is simple random sampling will be suitable when the population contains similar characteristics or when the population is within a limited range. So what do you mean by range? The difference between minimum and maximum value is very limited. There is no huge gap between the minimum and maximum value. So whenever population is having similar characteristics or whenever the population is in a close range, then simple random sampling will work. On the other hand, when the population is having dissimilar characteristics or when the range of the population is very wider, then simple random sampling will not work. Because the problem is, let us say this class only. So boys and girls are there. Now, here it is having different characteristics. So now, let us take a typical scenario where boys and girls are there. If I am calling out 10 roll numbers, can you give me guarantee in my 10 numbers, boys also will be there, girls also will be there? Can you give me that guarantee? No. Even random numbers also can go wrong. Out of all the random numbers, whatever have been generated, I might get 7 girls, 3 boys. Possible. So there is no there is no guarantee that every characteristic will be covered. Similarly, let us say if you look from the transaction perspective, the minimum purchase value is 100 rupees. The maximum purchase invoice is 1 crore rupees. Huge gap between the minimum and maximum values. Now, if I go for simple random sampling, there is no guarantee that different values will get covered. Might be less than 10,000 only will come into my sample, or might be more than 10 lakhs only will come into my sample. So when I'm having dissimilar characteristics or when my population is spread across wide range, I need to have such a sampling approach where I will cover all the characteristics. So in that case, I will do something called stratified random sampling. So what is stratified random sampling is, first I will take the population having dissimilar characteristics. Now that population having dissimilar characteristics, that I will divide into subpopulation having similar characteristics. Let us say purchases data is there. I made purchases from total 4 vendors, total 10,000 entries are there. Now this entire population I will divide into subpopulations having similar characteristics. Purchases from A, B, C, D, I have divided it. So from A, the purchases are total 5,000, and from B I got some 2,000 invoices. Here I got some 2,500. Here I got some 500. So what I have done? I have divided the entire population into population having dissimilar characteristics into subpopulation having similar characteristics. This process I call it as stratification. What do I call it? Stratification I call it. Now from each of the subpopulation, once again I will select a sample using simple random sampling. From each of the subpopulation, let us say from each subpopulation, I need 10%. So 500 here I want, 200 I here I want, 250 I want, 50 I want. How I will select the samples once again? Now I will use a random number generators or random number tables. So this entire process I am going to call it as stratification, stratified random sampling. So I can do the stratification in multiple ways. Here I have done the stratification on the basis of vendors. I might do the stratification even on the basis of value also. So 100 to 10,000, 10,000 to 1 lakh, 1 lakh to 10 lakhs, more than 10 lakhs, even on the basis of value also I can do the stratification. So whatever it is, random sampling. First method, two subcategories we have: simple random sampling, stratified random sampling. Simple random sampling will be more suitable when the population is having similar characteristics and also when they are in a close range. Stratified random sampling will become suitable when the population is having dissimilar characteristics and they are spread across a wide range. Clear? That is random sampling. The second method we have systematic sampling or interval sampling. What is it? Systematic sampling or interval sampling. Here you have to do a little bit of math. So what is that math is? You have to take the total population size. You have to take total population size. You have to divide it with the required sample size. You have to divide it with required sample size. You will get one figure N, which we call it as sampling interval. We'll call it as what? Sampling interval. Let us say, for example, total 10,000 population are there. In that, I need a sample of 200 entries, required sample size. So if I do that, I'm getting the figure. How much is N here? 50. Sampling interval will be 50. So now what I will do is, I will take the first 50 transactions. N is 50 no? I will take the first 50 transactions. Randomly, I will start at one point within the first 50. Using simple random number, whatever it is, I will start one random point. Let us say I have started at 9. Now what I will do is, after I have selected the first item within the first 50, every 50th item I will take into sample. 9, thereafter 59, thereafter 109, thereafter 159. So like that, every 50th item, every nth item I will select. Sounds weird, but like this also one method is there. So which we call it as systematic sampling or interval sampling. So what happens with systematic sampling or interval sampling? First I will calculate sampling interval. That n figure I will calculate. How to calculate that sampling interval? Population size required divided by required sample size. So I will get n. So in the first n, I will randomly start at one starting point. Thereafter, every nth item I am going to select into my sample. This is what we call as systematic sampling or interval sampling. Then we have something called monetary unit sampling. The other name for that is value weighted selection. We have something called monetary unit sampling. The other name for that is what? Value weighted selection. Sir, what is that monetary unit method or value weighted selection? The name itself says. See, instead of giving importance to number of the transactions, if you are giving importance to value of the transactions, either in selection of the sample, in analyzing the results, in selecting the items, if you are giving importance to the value of the transaction, if you are giving weightage or importance to the value of the transaction in the sampling process, that we call it as value weighted selection. Like I am saying that whatever transactions which are more than 10 lakh rupees, there I will verify bigger sample 50%. Whatever transactions which are between 1 lakhs to 10 lakh rupees, there I will verify only 20%. Whatever transactions which are less than 1 lakh rupees, there I will verify only 5%. So here you are taking the sampling decisions purely on the basis of giving importance to value of the transaction. So this we call it as value weighted selection. Thereafter, we have something called block sampling. Sir, what is block sampling? In the case of block sampling, we select a block of continuous items. I will tell you one simple example. Let us say in front of me I have some 1,000 invoices, one file is there. From that 1,000 invoices, I need 50 invoices. How I will normally pick the sample? One item I will pick till the time I get the count of 50 in my sample. But in the block sampling, what I will do is, instead of picking one item, somewhere randomly 50 continuous items I will pick. 50 continuous items, 50 continuous invoices, one bunch I will pick and I call it as my sample. That I call it as block sampling. But there is a problem with this block sampling. What is it? It will not be representative of the population. It will not be representative of population. Why? Because in the case of block sampling, see, generally you take any data will be arranged in proper order, either alphabetical order or any other numeric order, chronological order, some order will be there. When you try to pick a block of continuous items, what will happen is you will tend to pick up the transactions which will have similar characteristics. If the data is arranged chronologically, when you select the block of continuous items, there might be chances that you are selecting the data only belonging to 1 month. Remaining months might not get covered. If it is arranged in alphabetical order, when you are picking the bunch of items, you might be selecting items only covered from one single vendor, not all the vendors. So there is a problem with the block sampling. Then we have the last method, which is haphazard sampling. What is it? Haphazard sampling. So what is this haphazard sampling? The name itself says haphazard, where we don't have any approach. So in the haphazard sampling, we don't follow any specific approach. But even though we don't follow any specific approach, we make sure that our bias is not coming into play. Bias is not there. So even though we are not following any method, but at the same time, we make sure that we are not bringing our bias into picture. That method we call it as haphazard sampling. I will give you one example. It will sound weird. That is what the example I can give you for haphazard. So let us say in front of me there is a file. In that file, I need 100 invoices. I am not following any approach. Just I am closing my eyes. Someone is turning the pages. Randomly, I will place the finger on one invoice. Whatever touches my invoice, I will keep it into my sample. So like that, 15 invoices I have. Did I follow any approach? No. But at the same time, did I have any bias? No. This is what I call as haphazard sampling. But this method is not used. Why it will not be used? It will be difficult to establish in the future. If tomorrow some judge is asking you how you have selected a sample, I can't show him a video where I am closing the eyes and picking the invoices and all. So that I can do. So it will be difficult to establish in the future. That's why this method is also not used. So these 5 are the methods very important for the case scenario based MCQs. So what are they? Random sampling, systematic sampling or interval sampling, block sampling, monetary unit sampling, and haphazard sampling. These are all the various methods. Now coming back, we have one more important part here. Not one more, we have few more. So one thing which I wanted to say here is 3 terms they use: sample design, sample size, sample selection. There is something called sample design, sample size, and selection of sample. 3 terms you have to understand. So what is sample design? Sample design refers to the decision regarding which method you have to follow. Like we have various methods just now as I have told. So which method I have to follow for selecting sampling? Should I follow simple random, stratified? Should I follow this block sampling? So that decision regarding which method to follow, that we call it as sample design. And how to decide the sample design, sir? Which design I have to follow, which method I have to follow? That auditor himself has to decide, and you have to decide it keeping in mind what is the purpose of your audit procedure and what are the characteristics of your population. The decision regarding sample design should be taken based on 2 factors. What are the purpose of your audit procedures and the characteristics of the population. The second term, which is very frequently used, is sample size. Sir, what is sample size, sir? Simply, if I have to put it, the number of items in your sample. The number of sampling units in your sample, that we call it as sample size. Sir, what should be your appropriate sample size, sir? What should be the appropriate sample size? No universal rule. Once again, it all depends on professional judgment. The standard has played it very safe here. They say that you have to determine the sample size in such a manner that it will reduce your sampling risk to an acceptably low level. You have to set the sample size in such a manner that your sampling risk is at an acceptably low level. And then finally, sample selection. Sir, how we have to keep this? How we have to do the sample selection, sir? This we have seen in the definition only. When you are selecting the sample, try to make sure that you are selecting the sample in such a manner that every item will have a chance of selection, and whatever sample you have selected, that should be representing the entire population. These things you have to keep in mind while doing the sample selection. Now, the next part here is factors which affects the sample size. This is very important. Factors which affect the sample size. As I've already told you, there is nothing called appropriate sample size. There is no universal sample size at all. So this sample size and all going to depend on various factors. Something auditor has to decide himself using his professional judgment. But while deciding what should be the appropriate sample size, auditor will consider various factors. There are various factors which are useful for the auditor in determining sample size for test of controls. There are various factors which are applicable for determining the sample size for test of details. What is the other name for test of controls? Compliance procedures. So when you are deciding the sample size for test of controls, what will be the factors which you will consider? Simply, if I have to put it, will you go for a larger sample size or smaller sample size? That depends on what factors. Simple way if I have to put it. So what will be the factors for test of controls? First, we will try to see it. For determining sample size for test of controls. That means should you go for a bigger sample size or smaller sample size in case of test of controls? What are the various factors you will consider? Listen carefully. First one, reliance placed by the auditor on internal controls. If the auditor wants to rely more on internal controls, if the auditor wants to rely more on internal controls, should he go for larger sample size of test of controls or smaller sample size for test of controls? Let's listen carefully. If the auditor wants to rely more on internal controls, he wants to get more assurance, more reliance on internal controls. Should he verify large number of internal controls or small number of internal controls? Large. If you want to rely more on internal controls, you have to take bigger samples. No. See, you want to rely more on compliance testing than substantive audit procedures. That means what? You have to increase your sample size. So if you want to place more reliance on internal controls, bigger the sample sizes you have to take. That's the first factor. Next, this I will come back. Auditors decide a level of assurance. If the auditor wants higher level of assurance, higher should be sample size. If the auditor is satisfied with lower level of assurance, lower should be sample size. Direct relationship. Next. Then come to the next point. So here we have something called expected rate of deviation. Expected rate of deviation for test of controls. See, one more point you clarified here. So when we are doing test of controls, we are not finding out misstatement. We are finding out deviations. Internal control deviations we are finding out. So the outcome of performing test of controls is deviations in the internal controls. The outcome of performing test of details is finding out the misstatements. By verifying test of details, you find out misstatement. By doing test of controls, you are finding out deviations. So one factor which will affect the sample size of test of controls is expected rate of deviation. And what do you mean by expected rate of deviation? If you are expecting that there are more chances of deviation, if you have suspicion, something similar to risk, you are expecting that there are going to be more deviations. Will you increase your sample size or decrease your sample size? Increase your sample size. Risk is high basically. When you are expecting risk is high, you have to verify more or not. So that's what they say. So expected rate of deviation. If you are expecting there will be more deviations, you have to verify. You have to go for a bigger sample size. The other one is tolerable. So here also there is a direct relationship. Then we have the other one, tolerable rate of deviation. So what do you mean by tolerating? Accepting. How much you are willing to accept. When I say tolerable deviation is high, what do I mean by that? The auditor is willing to tolerate, willing to accept more deviations. That means he is trying to take more chance. Yes or no? When I say tolerable rate of deviation is high, what do I mean by that? Auditor is willing to accept more deviations. That means he is ready to take more risk. When he is ready to take more risk, when he is ready to take more chance, what should be the sample size? Less. When he is ready to take more risk, he will verify less. No. Concept. So when he is willing to tolerate more deviation, that means he is willing to accept more deviations. That means he is ready to take more chance. When he is ready to take more chance, the sample size will be less. On the other hand, when I say tolerable rate of deviation is very low, that means what? Auditor is not willing to accept deviations. That means he doesn't want to take any chance. He doesn't want to take any chance. That means he has to go for larger. Understood? So between the tolerable rate of deviation and the sample size, we have what kind of relationship? Inverse relationship we have. What we have? Inverse we have. So for expected deviations, we have a direct relationship. But for tolerable rate of deviation, we will have a inverse relationship. So four factors have reliance placed by the auditor on internal controls. Higher will be the reliance, the greater will be the sample size. This is also direct relationship. And then I have told desired level of assurance. Once again, direct relationship. Higher the level of assurance, more will be the sample size. Then expected rate of deviation. Here also direct relationship. Higher the rate of deviation, higher the expectation, higher will be the sample size. Tolerable rate of deviation. Here there will be inverse relationship. Then we will have something called size of the population. They say that size of the population will have a very negligible impact on the test on the sample size. So especially when we are using the statistical sampling and all, size of the population will have a very negligible impact on the size of the population, on the sample size. Okay, so that's what they say here. In case of large population, the actual size of the population has very little very little impact on the sample size. So for small populations, however, sampling itself it will not do. The population is very small, sampling itself will not do. If the populations are very big, just because of the size, it is not going to make any difference in the sample size. As I have told you, the sample size need not increase in proportion to the increase in the population, right? So that's why the sample size will have the size of the population will have a very negligible effect on the. So these are the factors which affect the sample size for test of controls. Now, what are the factors which will affect the sample size for test of details? In test of details, what I verify? In test of details, what I will verify? Entries in the books of accounts, and my objective is to find out the misstatement. So now, what factors will affect the sample size for test of details? Here some complications will be there. Listen carefully. Number one, risk of material misstatement. Tell me here, what kind of relationship? Higher the risk of material misstatement, higher should be the sample size. Straightforward point. So what kind of relationship? Direct relationship we have. Next one. First I will complete the easy ones. Desired level of assurance. What relationship? Direct relationship. Higher the level of assurance we want. The more you want the confidence, the bigger should be the sample size. Once again, what kind of relationship? Direct relationship. Then expected misstatements. For test of controls, they told expected deviations. But for test of results, they are saying expected misstatement. If you are expecting more misstatements, what should be your sample size? More sample size. Expected misstatement is just another name for risk of material misstatement only. So if you are expecting more misstatements to happen, the sample size should be larger. Then we have tolerable misstatements. After this, a tolerable misstatement. What is that? Yeah, here we have, sorry. Tolerable misstatement we have. So you tell me, tolerable misstatement, what relationship we have? Inverse relationship. What do you mean by auditor's tolerable misstatement is high? That means auditor is willing to accept more misstatement. He is willing to take more chance. That means the sample size can be lower. Inverse relationship. Till here, everybody comfortable? Now let us come to the complex point. Relying on other substantive procedures. So what is it? What is it? What is it relying on other substantive procedures? Listen, little complex to understand. I will give you logic in a correct way. So if you have to perform substantive audit procedures, I told you you will perform test of details or you can perform analytical procedures. Today morning only we have covered. So now sampling will be relevant only for test of details. Sampling is a concept which is relevant for test of details. But in analytical procedures, sampling have nothing to do. Why? Because in analytical procedures, we are not going to take the transactions, we are trying to study the relationships. See, they say that one of the factors which will determine what should be the sample size for test of details is how much you want to rely on other substantive procedures. Other substantive procedures means they're referring to what? Analytical procedures. When I say if the auditor wants to rely more on other substantive audit procedures, that means auditor is trying to get most of the evidence from analytical procedures. Then will he verify smaller samples for test of details or larger samples? Think once again. See, you can get the evidence required for substantive audit procedures either by performing test of details and analytical procedures. Anything you can do. If the auditor wants to rely more on other substantive procedures other than test of details, that means auditor wants to get most of his evidence from analytical procedures. Then for test of details, what he will do? Smaller samples he will take. Got this logic? Next. On the other hand, if the auditor wants to rely less on analytical procedures, he wants to get most of his evidence from test of details, then he has to increase his. That's it. Got it? So that's what we say here. The higher the auditor, no, where is the point? This one. The more the auditor is relying on other substantive procedures to reduce an acceptable level the detection risk regarding a particular population, the less assurance the auditor will require from sampling, and therefore the smaller will be the sample size. Okay, the sentence framing is little difficult, but you try to understand the logic whatever I have explained. Thereafter, we have something called stratification. We are saying something called stratification. Stratification means what? Division of the populations into subpopulation. See, when you are dividing the population into subpopulation, if you are able to do stratification in the best manner, you are trying the stratification in such a manner that, so I will tell you. See, there is an entire population. Total 10,000 transactions. Okay, these are made from 4 vendors. One way of stratification is divided into 4 subpopulations. divided into 4 subpopulations. This is one way of stratification. Another way, you are doing division, but what you are doing is AB you are clubbing together one subpopulation, CD you are clubbing together one population. Where the stratification is more appropriate, the stratification is more appropriate in the case of first case. There you will require smaller sample size. Why logic I will tell you. See, here you can take 5% of the sample. Let us say in each subpopulation you are taking 5%. Even if you take the 5% in each subpopulation also, there is a guarantee that the final population will represent all characteristics. Let us say here you have taken 10%. But even after taking 10% also, there could be a chance that in this subpopulation you might have covered only A. You might be required to take further sample to get the B involved. So better the way you do the stratification, the lesser is going to be the sample size. Able to understand? So that's what they try to put it here. So when stratification of the population is appropriate, when you have done the stratification in a proper manner, then the sample size will decrease. So when you have done, when population can be appropriately stratified, aggregate of the sample size from the strata generally will be less than the sample size that would be required by 10, blah, 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 all these things you ignore, just you remember this. Okay, when you have done the proper stratification, then the sample size also will decrease. Thereafter, what we have. So size of the population here also they say the same thing. Size of the population will have a very negligible impact on the sample size, especially for larger populations. The sample size will have a very negligible impact. So sample selection methods also we are done. We'll come to the next few important things we will take up. This one projection we will try to do, and somewhere the sampling risk concept should be there. There should be somewhere called sampling risk, non-sampling risk. Okay, in audit documentation, I will have the topic. I will go back and explain. But first, let me do this projection part. Sir, what is this projection of the misstatement? I have a concept called projection of misstatement. Sir, what is the projection of the misstatement? So first, I want here for this one small concept to first I want you to go through for a minute. This particular paragraph which is visible on the screen, just go through it for a minute. Try to interpret what they are trying to say. Then I will explain. It will make more sense. Yeah. Just have a quick, just take 2 minutes, read it, and try to interpret what they are trying to say. Either from the material which you have, either on the screen, whatever it is. Got something about it? Okay, listen. What they are trying to say. See, there will be a population, right? From the population, we take a sample. So let us say the population contains a total 10,000 entries. I have taken a sample of 500 entries. Now, by performing the audit procedures of the sample, I will be able to find out misstatements now. Let us say from the sample, I have identified some 10 misstatements. These 10 are the misstatements which you have found it on the basis of performing audit procedures on sample. But these are not the complete misstatements. These are the misstatements which you have got to know by performing the audit procedures on sample. Now you have to estimate if in my sample of 500 transactions, if 10 misstatements are there, how many misstatements could be there in my entire population? How many misstatements could be there in my entire population? This is what we call it as projection. This is what we call it as projection. On the basis of misstatements, whatever you have identified in the sample, you are projecting what could be the total misstatements in the entire population. And what is the correct way to do that projection is not on the basis of number, you have to do the projection on the basis of value. Sir, what do you mean by that? So what do I mean by that is, so total 10,000 population entries are there. Determine what is the total population value. Let us say this is sales data. The total value of 10,000 transactions is 500 crores. From that, you have taken a sample of 500 transactions. Now, what is the value of that sample? The total 500 entries put together, what is the value? Let us say the value is coming to somewhere around 100 crore rupees. Now, you found out the misstatements of 10. And what is the value of that misstatements that you determine? Let us say, for example, the value of the misstatement is coming to 20 lakh rupees. Now you have to think that in 100 crores worth of misstatements, if there are 20 lakhs worth of, in the 100 crores worth of sample, if there is 20 lakhs worth of misstatement, in total 500 crores worth of population, how much misstatement could be there? So simply if you have to do it, 500 into 20 divided by 100. So it will come to 1 crore, right? So this is correct way of projection. But here they add one more layer. Here they add one more layer. See, in a sample of 100 crores, you are able to find a misstatement of 20 lakh rupees. Before doing projection, they want you to bifurcate how much of that is anomalous misstatement, how much is non-anomalous misstatement. How much is anomalous, how much is non-anomalous. So anomaly is means something which is exception. Something which is exception, which will not happen again and again, which is not represented. You can't expect these kind of things repeatedly. Once in a while. So one of a transaction we say no, that kind of thing is there. So now out of this 20 lakhs worth of misstatement, there is one such misstatement, 2 lakhs worth of misstatement, which is anomaly. One of its kind. It will not happen again and again. One of its kind. It will not be repetitive. Whereas remaining 18 lakh rupees is non-anomalous misstatement. What is it? Non-anomalous. It is a usual thing only. Now you tell me for what amount I have to do the projection. Should I do the projection for total misstatement of 20, or should I do the projection for 2 lakhs worth of anomalous misstatement, or should I do the projection for 18 lakhs worth of non-anomalous misstatement? You have to do the projection for 18 lakhs worth of non-anomalous misstatement. Why? Because anomaly is one of its kind. Yes or no? So now how you will do the projection is, in 100 crores worth of sample, if you are able to find 18 lakhs worth of non-anomalous misstatement, in 500 crores worth of population, how much could be the projected misstatement? So it will come to 90 lakhs. Yes. To that, you have to add anomalous misstatement without projection. Because one of its kind, even though it is one of its kind, it is also a misstatement only, no. So this 2 lakh rupees you have to add it without projection. Now your total projected misstatement will come to 92 lakh rupees. Okay. So, and one more last point they say, for test of details, explicit projection will be required. When you are doing test of details, this projection we will do. Even the sample, this much amount of misstatement is there, how much misstatement will be there in the entire population. This projection we do it for test of details. Whereas projection is not required for test of controls. Projection is not required for test of controls because the sample deviation rate itself is going to be the entire population deviation rate. Something similar to that you might have read. In test of controls, projection is not required because the sample deviation itself is going to be the entire population deviation. So what do you mean by that? Let us say, for example, there is one defective internal control. And that defective internal control, there is a problem. If you pass 10 entries through that internal control, 9 entries will be processed correctly, 10th entry will be an error. 10th entry will be an error. So if you pass 10 entries, 9 entries will be processed correctly, 1 entry is getting a fault by the internal control system. So if you pass 10, how many misstatements will come? How many deviations will come? 1 deviation will come. If you pass 20, 2. That means 10% can I say? In 10, 1. In 20 also, 2. Why? Because after every 9 entries, 1 will be a fault. If I pass 100, 10%, 10. If I pass 1000, 10%. 100. If I pass 10,000, 10%, which will be 1000. So here what is happening? The sample deviation. I took a sample of 10. In that, whatever deviation I have found, the same thing will be the entire population deviation. So no explicit projection will be required in the case of test of controls, but explicit projection will be required in the case of test of details. Clear? So this is what the major discussion regarding audit sampling Sep 530. And I want to explain one more concept: sampling risk and non-sampling risk. There will be something called sampling risk, non-sampling risk. Just in brief, I will explain. See, what is a sampling risk? Sampling risk means selecting an inappropriate sample. If your opinion has gone wrong, that is audit risk, right? That audit risk can happen because of sampling risk also, it could happen because of non-sampling risk also. So what is sampling risk is, if your opinion has gone wrong because you have selected an inappropriate sample. That misstatement did not get covered in your sample. You took a sample. Actually, there is a fraud in the sales. But in the sales, you have taken a sample. In that sample, that fraudulent transaction did not get covered. In that sale, that fraudulent transaction did not get covered. That is a what? Sampling risk. Because you have selected an inappropriate sample. Your opinion has gone wrong because of inappropriate sample. That is a sampling risk. Now, sometimes you will select a sample. In that sample, fraudulent transaction has also come, but you are unable to detect it because you performed inappropriate procedures on the sample items. You have misinterpreted the evidences. You have arrived at the wrong conclusions. That means your sample is correct only, but because of other than your inefficient audit procedures, your misinterpretations, your opinion has gone wrong. That we call it as what? Non-sampling risk. That we call it as what? Non-sampling risk. This much if you understand, it will be enough. So sampling risk, if your opinion has gone wrong because of inappropriate sample, or on the other hand, if your sample is correct only, but because of your inefficient procedures or because of your ineffective methods, your misinterpretation of evidences, if your opinion has gone wrong, that will be a non-sampling risk. Clear about it? Able to understand? Right. So the next standard which we will take it up for revision, the next chapter which will take it up for revision is SA 520, which is going to talk about analytical procedures. So very simple way, I will try to explain it so that if at all any MCQs gets tested from here, so you will be in a position to answer it. These days, some repeated areas also they are testing. First, analytical procedure is actually a method. Out of 7 methods, it is one of the methods. So in that, what we will do? In analytical procedures, we try to study the relationships between what? We try to study relationship between either two financial items, or alternatively, we study the relationship between financial and non-financial items also. So we can study relationship in multiple ways. So first, if you take an example of studying relationship between two financial items, let us say you are calculating a gross profit ratio. By calculating gross profit ratio, you are simply calculating the relationship. You are simply studying the relationship between the gross profit and sales. So here you have studied the relationship between two financial items. So if you have calculated gross profit ratio, you studied the relationship. Well and good. Similarly, you can also study the relationship between one financial item and one non-financial item. What is it? Let us say employee cost with salary with the number of employees. Salary is a financial item, number of employees is the head count. Is a non-financial item. So these are related with each other or not? What is the relationship? When the number of employees are increasing, the salary cost also should go up. So you studied relationship either between two financial items, or you studied the relationship between two non-financial, one financial and non-financial item. That's all. Analytical procedures are over. So just you have studied the relationship. So once you have studied the relationship, the next step is doing the comparison. The second step is what? Doing comparison. Sir, what kind of comparisons you can do? So what kind of comparisons you can do is either you can do inter-firm comparison or you can do intra-firm comparison. So what is intra-firm comparison? Let us say I have calculated the gross profit, I can compare it with the last year's gross profit. It's an intra-firm comparison. What is inter-firm comparison? I can compare my gross profit ratio with the competitor. I can compare my gross profit with the industry average. I can compare the gross profit with some another industry, whatever it is. So there is an inter-firm comparison. Okay, sir, I have done the comparison also. You calculated the gross profit of the current year 25%, last year's gross profit 20%. By doing the comparison, what will happen is you will get to know about deviation or unusual relationships, inconsistent relationships. So either you will find deviation. Mainly deviation we use it for two financial ratios. Like there is a deviation in the gross profit ratio, or there is an inconsistent relationship. When you are studying the relationship between financial and non-financial, inconsistency in relationship. Like number of employees have increased, but salary cost has come down. So like that, by doing the comparison, you will either find out deviation or you will find out inconsistent relationship. That's all. If you find out a deviation or inconsistent relationship, will you automatically conclude that there is a misstatement? Gross profit of the current year is 25, last year's gross profit is 20. There was unexpected increase in the gross profit. Will you automatically conclude that sales of the company are overstated by 5%? So the last step here is once you find out the deviation or inconsistent relationship, the last step is investigating. What is it? Investigating. Why? Because that differences, that discrepancy, that deviation, or that inconsistent relationship might be either because of a genuine reason, or even it could be because of a misstatement. We should not directly conclude. So when you find a deviation or inconsistent relationship, you have to take that last mile. You have to do the investigation, and you have to find out, is that deviation because of a genuine reason, or is it because of a material misstatement? If it is because of a material misstatement, we'll consider its materiality and give a modified opinion. If it is because of a genuine reason, we ignore it. Understood? So this is what only will happen in the analytical procedures, whereby we study the relationship, we do the comparison, we find out the differences or inconsistent relationship, and finally we will investigate, and thereafter we will consider its impact on the opinion. Now, this essay 520, when we will perform analytical procedure, first of all, when we will perform analytical procedure. See, analytical procedure is a method actually. We can use it either as a risk assessment procedure. In the morning, I have drawn analytical procedures can be either used as a risk assessment procedure. So you can use it as a risk assessment procedure. And analytical procedure as a method, you can use it as a substantive audit procedure also. Analytical procedures, you can either use it as a risk assessment procedure, or even you can use it as a substantive audit procedure. See, when you are using analytical procedures as a risk assessment procedure, what is your purpose there? What is your purpose there? When you are using it as a risk assessment procedure, what is your purpose there? To identify and assess the risk of material misstatement. So you can use, that means if they ask you what is the purpose of analytical procedure, the purpose of analytical procedure could be to understand the entity, environment, and its internal control, and to identify and assess the risk of material misstatement. And in case if you are using analytical procedure as a substantive audit procedure, then what is your purpose? To obtain the sufficient and appropriate audit evidence. To obtain sufficient and appropriate audit evidence. So you can use, if you are using analytical procedures as a risk assessment procedure, the purpose is to obtain an understanding and identify and assess the risk of material misstatement. If you are using it as a substantive audit procedure, then your purpose will be, then the purpose is going to be to obtain a sufficient and appropriate audit evidence. And they say one more thing here. At which stages of the audit you are going to make use of analytical procedure? If you are using it as a risk assessment process, risk assessment procedure, you are using it at the planning stage. At the planning stage. If you are using it as a substantive audit procedure, you are using it at the execution phase. And they say one more thing, even at the conclusion phase also, you are required to perform analytical procedures. How I will tell you. But the point which I want to make here is analytical procedure can be used at all the phases of the audit. At the beginning phase, like at the planning phase, as a risk assessment procedure. At the actual testing phase, as a substantive audit procedure. Even at the conclusion phase also, you can make use of analytical procedure. Sir, how at the conclusion phase, sir? How at the conclusion phase means they say that after you have done your entire audit, just before you form an opinion, you have to perform analytical procedures whether information reflected in the financial statements is consistent with whatever understanding you had. So what they're saying at the conclusion stage, how we use analytical procedures? We'll use analytical procedures after we are done with the audit. Just before we express the opinion, we will try to perform analytical procedures to just find out whether the financial statements are consistent with my understanding. At the beginning, you had understanding, no? Let us say, for example, at the beginning, when you understood about the entity, environment, and its internal control, you got to know that you are conducting audit of IT company. You got to know that entire IT industry is coming down. So every IT company is having a hit on their profits. There was a huge dip in the net profit margin. So now at the ending, since I'm conducting audit of software company, one more last time I have to check. What understanding I had, since it is also a software company, this there should be a hit on this company's net profit margin also. To my surprise, the net profit margin has increased in the actual financial statements when compared to the last year. So that means at the conclusion phase, when I am checking it, I am able to find that the financial statements of the company are not consistent with whatever understanding I had. So that you can reassess. You will not give an opinion, you will reassess once again why this one particular company only has increased in the profits when the entire industry is struggling. So like that, even at the conclusion phase also, you can use analytical procedure. Understood? Either at the planning phase as a risk assessment procedure, or at the testing phase as a substantive audit procedure, or even at the conclusion phase to find out whether the financial statements are consistent with auditor's understanding. So this is what regarding the purpose and all. So interform, intraform, everything I have covered. Timing also have covered. Then we have something called substantive analytical procedures. So till now you are saying analytical procedures, okay. What is substantive analytical procedure? Simply here, if you are using analytical procedure as a substantive audit procedure, that will be called as substantive analytical procedure. If you are using analytical procedure as a substantive audit procedure, that is only what? Substantive analytical procedure. See, simply I have word. Analytical procedures can be either used as a risk assessment. Analytical procedure can be either used as a substantive audit procedure. If I am using analytical procedure as a substantive audit procedure, that is a what? Substantive analytical procedures. So you can perform substantive audit procedures either by performing test of details or by performing analytical procedures. Who will decide which audit procedure to perform? Auditor. How you will decide? Professional judge. Nothing new here. So that's what I try to say here. Substantive procedures can either include test of details or even it could include analytical procedures or even a combination. The decision about which audit procedure to perform, whether to use substantive analytical procedures, is completely based on auditor's judgment about the expected effectiveness. If I follow whether test of details will it be effective or if I follow analytical procedures it will be effective, the auditor will analyze it and accordingly he will take a decision. And the auditor may inquire as to availability and reliability of information needed. If at all you want analytical procedures to be performed, first you have to inquire whether you have all the data available. Why? Because for performing analytical procedures, we need lot of data. If you want to perform test of details, correct their data will be enough. Your entity's data will be enough. But if you want to perform analytical procedures, either you might need the last year's data or you might need outside of the firm data, like industry averages, competitors data, all that you need. So if you have decided to perform substantive analytical procedures, first determine whether data is available or not. Next, it may be effective to use even analytical data prepared by the management. See, you are doing analytical procedures, you are doing that comparison analysis and all for your audit. Do you think management also will do it? Yes. Management also will do analytical procedures. For what purposes? Decision making purposes. For their internal decision making, whatever analysis we do, that ratio analysis management also will do. So in case if management has already prepared some data for their decision making, can I use that data for my analytical procedures? Yes, use it. But check its reliability once. What you should do? Check its reliability once. Next. One more thing here. Factors which are required to be considered by the auditor for substantive audit procedures. That means, as I have told just now, whether you will perform analytical procedures or you will perform test of details as a substantive audit procedures. That who has to decide? Auditor. How he has to decide? Professional judgment. But various factors he will consider. So what are the factors he will consider? Number one, availability of data. Just now I have to performing analytical procedures, you need data. If all the data is available, then you will perform analytical procedures. No, sir, only current year data is there. Perform the test of details. Next, disaggregation. Sir, what is this disaggregation? This will mainly happen in the case of large companies like Reliance and all. Let us say you are conducting audit of Reliance. Okay. Now, Reliance is into multiple businesses. If I want to do inter-firm comparison, I can't compare Reliance with any other company. But if the Reliance is having some mechanism whereby from the data of Reliance, I will be able to bifurcate the data of petroleum business. I will be able to bifurcate the data of telecom business. I will be able to bifurcate the data of FMCG business. If I am able to disaggregate it, then I can do the comparison. If I am unable to disaggregate it, for Reliance analytical procedures become impracticable. You have to rely on test of details only. So one more factor, disaggregation you will consider. Third, account type. For certain accounts, analytical procedures might not be suitable for every account. Let me tell you one thing, wherever predictability is there. What is that? Predictability. Wherever relationship is there, whichever item is having relationship with other item, only those items, for those items, this analytical procedures will be suitable. So these analytical procedures might not be suitable for specific items. For that, we can't apply analytical procedures. Then we have to go for test of details only. Similarly, source. Source means reliability here. When they say here source of the data. If the data which you require for performing analytical procedures is coming from an independent source, is coming from a reliable source, you will be comfortable in performing analytical procedures. If the data is not reliable, then you have to go for test of details. Then they say predictability, just now I said. If there is a predictability, then only analytical procedures will be suitable. If there is no predictability, we can't predict certain item. One item is highly unrelatable. For that area, analytical procedures will never be suitable. It also depends on nature of assertion. So now what is it? See, if you are verifying fixed assets, for fixed assets, to know existence, or not even existence also, to know whether the value of the fixed assets is correct or not, we can rely on analytical procedures to obtain evidence regarding valuation assertion that figure whether it is correct or not. For that, we can use analytical procedure. For rights, whether entity is the owner of the assets or not. To get the evidence regarding that assertion, can we use analytical procedures? Not possible. For that, we have to go for inspection compulsory. For that, we have to compulsory do test of details. So it also depends on assertion what you are doing. And it also depends on inherent risk or what can go wrong. If I have to put it in simple terms, it depends on risk of material misstatement. Wherever something can go wrong, wherever risk is very high, there you should not rely only on analytical procedures. Wherever risk is very, very high, there you should not rely only on analytical procedures. Either you perform test of details or use the test of details in combination with analytical procedures. Don't use analytical procedures wherever risk is very higher. Why? Because then we are not checking the supporting documents. So that's why wherever something can go wrong, wherever risk is higher, there you cannot perform analytical procedures, there you go for test of details only. And the next most important parts are what techniques are available for performing analytical procedures. We have four techniques available. How many? Four we have. Sir, what are they? Trend analysis, ratio analysis, reasonableness test, structural modeling. Four things. Sir, what are they? Number one, trend analysis. Sir, what is trend analysis? This is mainly applicable for P&L items, where items will follow one trend. Let us say revenue. From the last few years, revenue has been increasing 10% year by year. Now we will see in the current year also revenue is moving in line with the trend or not. So basically I'm comparing the current year data with the last year data or a trend established in the past few years. So this is what I call it as what? Trend analysis, where mainly comparison with the past years is happening. Then ratio analysis. Ratio analysis is purely study between two financial items, where we are not checking one item's trend, but instead we are studying the relationship and we are analyzing. Individual item of the balance sheet especially is very difficult to predict, difficult to analyze. If I only give you data figures, last year, current year, nothing you will be able to. If I give you sales data also, you will be able to make some meaningful conclusion out of it. So like that, studying the relationship between two financial items is we call it as ratio analysis. Then we have reasonableness test. Sir, what is reasonableness test? In the reasonableness test, we will not go to the prior years. In the reasonableness test, we will not study the relationship between two financial items also. If you are comparing with the prior year, trend analysis. If you are studying relationship between two financial items, ratio analysis. We will do neither. Then what we do, sir? What we do is we take a financial item and related non-financial item of the same year, same period. Like I will tell you one example. The client is saying we have 50 crores worth of inventory as of the balance sheet, financial item. Now to know whether this 50 crores worth of inventory really they are having as on the balance sheet date or not, what I am doing is I am asking them to show me the storage space. Take me to the warehouse where you will keep the stock. They took me to the warehouse. By looking at the size of the warehouse, I can make an estimate how much of stock they can afford. So when they showed me the warehouse, even when the warehouse is completely filled, it can accommodate only 30 lakhs worth of 30 crores worth of stock. I asked for the management, as on the balance sheet date, do you have any other warehouse? They said no. They said, sir, we are having only warehouse. There is no stock with a third party also. Entire stock is kept in the warehouse. Now I will get it down. Now I have to get a suspicion or not. So here I am checking. Here I will say that inventory valuation is wrong. How I found out? Did I go to the prior years and check? No. Did I study the relationship between two items? No. I took a financial item and a related non-financial item of the same period. So this we call it as reasonableness test. The last one we have something called structural modeling. Sir, what is that structural modeling? This is something where completely using statistical concepts, that standard deviation, variance, regression and all, using that statistical concepts, some intelligent people have built some tools, some softwares they have built. So now what are these tools is, if you enter the data of the last few years, it will automatically predict this year's sales should be this much. Now you will compare whether actual sales are within that system generated figure or not. If not, you will investigate further. One of the very rarely used method in the industry, because two gray areas for us. One is technology is a gray area for us. Then statistics another gray area for us. So not that frequently used in the industry. But whatever it is, four methods we have. Next, I will come to the next part. If you want to perform, this will be the last part. So this is connected to the next 4 points. Next 5 points are all interconnected. Listen. So if you want to use analytical procedure as a substantive audit procedure, just now as I've told, substantive audit procedure, either you can perform it by way of test of details or even you can perform it by way of analytical procedures. If you want to use analytical procedure as a substantive audit procedure, you have to follow 4 steps. You have to follow what? 4 steps. Number one, determine the suitability of particular analytical procedure for a given assertion. We have multiple options here. Just now, as I told, trend analysis is there, ratio analysis is there, multiple things are there. But which method will be suitable for the given audit procedure? What is your objective? Which method will be suitable for your objective? That you have to determine. First thing, determine the suitability of analytical procedure for the given assertion. So how to decide it, sir? How to decide it? Which method will be suitable for which assertion? Who will decide it? How he will decide it? That is what the next point. 11.9 will be that regarding the first point. What is it? Suitability of particular analytical procedure for given assumption. First step. Who will decide? So substantive analytical procedures are generally more applicable to large volume of data that need to be predictable. We know it. General statement. So we can perform analytical procedures for large volumes of data, but there should be predictability. And the application of planned analytical procedures is based on expectation that relationship among data exists and continue. So one assumption with what we perform analytical procedures is there will be a relationship between the data and it will exist. However, the suitability of particular analytical procedure will depend upon auditor's assessment of how effective it will be in detecting a material mistake. So suitability, which analytical procedure will be suitable? That depends on what? Auditor's assessment. Auditor will do an assessment. If I follow which method, I will be able to identify the misstatement that he will consider as suitable. Indirectly, what they are saying? Professional judgment. Next, in some cases, even an unsophisticated predictive model also may be effective. In a few cases, some simple things also will work. Revenue has increased, profit not increased. Investigated further, found out fraud. Life is simple. So like this, sometimes some simple unsophisticated models also can give you best evidence, but not always the case. Clear? So this is the first step. Okay, sir. First step is over. Next step is what, sir? Evaluating reliability of data. See, as I have told, one of the most important thing for performing analytical procedures is data. You need data. But just having the data alone will not be enough. The data should be reliable also. Why? Because if you want the results of the analytical procedures to be reliable, the data which you have used for analytical procedures must be reliable. So first you have determined which analytical procedure will be suitable. Then next, you will get the data. Now you have to check whether the data which you are using for analytical procedures is reliable. If the data which is getting used for analytical procedures is not reliable, the results of the analytical procedures also will not be reliable. So now how you will determine whether the data which I am going to use for analytical procedures will be reliable or not? How you will get to know it? 3 factors they say, 4 factors they will say. Number one, source from which you are getting the information. If you are getting from the source, if you are getting from an independent outside source, it will be more reliable. Next one, there should be comparability. Whatever data you are using, that should be comparable. Why? Because when we have something to compare, we can do the comparison and find out whether it is reliable or not. But in case if the data whatever you are having is not at all comparable only, if there is no close source to compare, we will not be able to test its reliability. Like they say one example here. Let us say if you are into business where you are selling customized jewelries. Customized jewelry, something you are selling. You are an e-commerce operator. You are selling all your customized jewelry through your own website. Now you are one of a kind of industry. You are one of a company in the entire India. Let us say, apart from you, no one is selling that customized jewelry. One article you are selling, only that article you will sell, that to customized. Now your data is there, but to know whether your data is reliable or not, you need other source to compare. Can we go and compare it with Amazon? No. Why? Because we are into different business. So like that, any other company I'm unable to find with which I can do the compare. If there is no source to compare, how can you determine if that data is reliable? So that's what the second factor. If there is comparable source, then we can determine its reliability. If there is no comparable source, we can't determine its reliability. Thereafter, nature and relevance of the information. See, even you can compare with the budget source. By doing analytical procedures, you can compare with the budgets. What is the nature of the budget that will determine its reliability? If the company is determining the budgets being realistic, let us say last year's turnover was 100 crore. This year the company kept a target of 120 crores worth of revenue. Here the budget is relevant. If you do the comparison, there will be purpose. On the other hand, some people will be such that what they want to achieve, they will keep it in the budgets, not what is realistic. Last year turnover was 100 crores, budget was 1000 crores. So then that budget will not be reliable. There, if you perform analytical procedures, no use there. And then finally, controls over the preparation of information. What kind of internal controls are operating over the preparation of the data? If the controls over the preparation of the data are working effectively, then data will be reliable. If the controls over the preparation of the data are not working effectively, then the data is not going to be. So 4 factors we have to check to determine the reliability of data. What are they? Source of the information, comparability of the information, nature and relevance of the information, controls over the preparation of the information. Okay, sir. You have determined the reliability of data. Now comes the most troubling point here. So you have determined the suitability of analytical procedure. You have determined the reliability of data. Third point, this is something weird here. Develop an expectation of the recorded amounts or ratios and evaluate whether the expectation is sufficiently precise to identify a misstatement that individually or when aggregated with other misstatements could be material. What is it, sir? You will get the data. Now you will work out the analytical procedure. You do the comparison. You find a deviation. You find a deviation or you find an inconsistent relationship. Immediately when you find a deviation, you will have an expectation. What is that expectation? When you find deviation, generally, just imagine as a child, you did the comparison, you found deviation. What will be your expectation immediately? I will investigate that. If I investigate that, I could find out a misstatement. That is what your expectation, no? But sometimes not every expectation will result into material misstatement. You find out a deviation, but you will have an expectation that this will turn into misstatement. Sometimes you investigate that deviation, then you will find a misstatement, happy. But sometimes after doing all the investigation, you will realize that you are doing wrong analysis. Sometimes after doing all the investigation, you will end up thinking that it is a wrong analysis. Determine that well in advance. No, why you have to realize it at the end? You have an expectation whether I should proceed with the investigation or I should stop it here only. That you have to analyze before you go investigation. Why? Because if you sometimes what will happen is you unnecessarily investigate and finally after completing all the investigation, you will realize that you are ending up doing with the wrong analysis. So that you determine it first. Develop an expectation and whether that expectation will result into a material misstatement or that will end up doing wrong analysis, that you determine it first. Sir, how I will do it, sir? How I will do it, sir? 3 things I will try to say. Number 1, the accuracy with which the expected results can be predicted. If you are performing analytical procedures on such a data which can be predicted with accuracy, let us say gross profit. You are comparing gross profit of your client company with the another company which is into same business, Tata Motors, Maruti Suzuki. If you are comparing gross profit margin, that data can be predicted with more accuracy. Why? Because both the company into same line of business, same kind of raw material, same selling prices, more or less their gross profit margin should be same. So gross profit, you are performing analytical procedures on gross profit, you find a difference. Here, if you, since gross profit can be predicted with more accuracy, if you investigate that, there are more chances for finding out a misstatement. Now, one more analysis you are doing. You are calculating research and development expenditure as a percentage of sales. You calculate one ratio. Research and development expenditure will be there, no? R&D divided by sales into 100 ratio you have calculated. Your client company is having 10% in R&D, but the competitor is having 2% in R&D. Now you are finding a deviation. If you investigate that further, tell me, will you end up doing wrong analysis or will you end up finding material misstatement? You will end up doing wrong analysis. Why? Because you are performing analytical procedures on such a information which cannot be predicted with accuracy. Why? Because research and development expenditure is a discretionary expenditure. Understood? So that is the first point. Whether your expectation will result in a material misstatement or not, you have to analyze. First factor which will decide is accuracy with which you can predict the information. If you are able to predict the data with more accuracy, on that you got deviation, more chances for finding out material misstatement. On less accurately predictable data, you are performing analytical procedures, even if you find a deviation also, you will end up doing wrong analysis, you will not find out any material misstatement. Point next, second one. The degree to which the information can be disaggregated. Now, I will take the Reliance example. Let us say you are conducting audit of Reliance. Reliance is into multiple business. Even after that also, major revenue of the Reliance is going to come from petrochemical business, oil refining business. You calculated gross profit of Reliance. It is coming at somewhere around 45%. And majorly the revenue is coming from oil refining business. It is a conglomerate, but still more than 50% of the revenue is coming from oil. So you calculated gross profit of this Reliance. You calculated gross profit margin of Indian Oil Corporation Limited. That was 35%. There is a huge discrepancy. If you investigate that further, tell me, will you end up doing wrong analysis or will you find a material misstatement? You will end up doing wrong analysis. Why? Because you are comparing the gross profit of the company, which is into multiple businesses, with the gross profit of the company, which is into single business. That means you did not disaggregate the information. On the other hand, if you are disaggregating the Reliance data, for the Reliance also, you divided the data of oil refining, petroleum, this crude, telecom, you have divided. For oil division alone, you calculated gross profit. That oil division gross profit you compared with Indian Oil Corporation. You found a deviation. If you start investigating it, will you end up doing wrong analysis or will you? There are more chances for ending up with a misstatement. There are more chances for ending up with a misstatement. So, second factor which will decide whether the expectation will result into a material statement or not is the degree to which the information can be disaggregated. That means if you are performing an analytical procedure on disaggregated data, even if you develop an expectation, more chances of finding out misstatement. If you are performing analytical procedures on consolidated data without disaggregation, more chances that expectation will not result into a material misstatement. You should stop there only, don't do investigation. Next, third point, the availability of information. This is a simple point. See, you have current year, you are doing analytical procedures. You have the client's data, full year data you have. You have competitors' data, but only 6 months data you have. Still, you compare this 1 year data with that 6 months data, calculated gross profit ratio, found a deviation, and you started investigating. Tell me, end up with wrong analysis or finding out misstatement? End up with wrong analysis. Why? Because you have started performing analytical procedures on incomplete data. Understood? So if you perform analytical procedures on complete data, there if you develop an expectation, investigate further, the chances of finding out misstatement will be there. If you are performing analytical procedures on incomplete data, you develop an expectation, the chances are not there. The chances of finding misstatement will be not there. Clear? So three factors here. So develop that expectation. So the accuracy with which the information can be predicted, the degree to which the information can be disaggregated, and availability of the information. So that is the third step. Now, last step in performing analytical procedures is what? Investigation. Okay, you developed expectation. You will also have a confidence that that will result into a misstatement. Now, what you should do? Investigate. How you will investigate? With whom you will investigate? Management. You go to the management and ask them reasons. Are these differences are there? Explain. And if the management is able to give the reasons, well and good. What if the management is not able to give you the reasons? Not able to give you proper justification? Try to perform alternative audit procedures. If alternative audit procedures are also not possible, modify the opinion. So that will be the last step. So these are the four stages involved in performing the substantive analytical procedures. Clear? So these are the key content from the analytical procedures also. With this, we'll wind up the chapter SA 520 as well.
Yeah, so the next chapter which we are going to take up for revision is the chapter which is risk assessment and internal control. So before I revise this chapter, I would like to give you one small caution regarding this particular chapter. As I am aware, this is one such chapter where many students are afraid of. So this chapter is little bit complex. When I have to categorize the chapters on the basis of their complexity, I will keep this chapter risk assessment internal control at the top. Why I say this is what is causing the complexity in this entire chapter is the terminology. The terminology which is used in this chapter is going to be very complex, which is very difficult to remember. Okay, somehow I can use some simple words and make the concept easy for you, but actual trouble comes in this chapter to remember the terminology and to reproduce that terminology. So that is what will make this chapter a little bit more complex than when it is associated, than when I compare it with other chapters. So that's why students feel it very difficult. And also, I would suggest the students to keep it at the end for preparation. So I am not saying that the questions will not be tested from this chapter. Yes, there will be a good amount of weightage from this chapter, but as compared with other chapters, this chapter is going to be a little bit complex. But the problem with this chapter is I can't tell you to completely leave this chapter also, because it contains so many fundamental concepts. This chapter, risk assessment, internal control, it will contain so many fundamental concepts which will have a linkages with other chapters. Especially if you look at the standards on auditing, if you have already prepared for it, in the standards on auditing chapter, if you pick each and every standard, there will be some connection with the concept risk assessment and internal control. So this chapter, risk assessment internal control, is such a chapter. Even though it is very complex, it contains so many fundamental concepts which are going to have linkages with various other concepts which we are about to learn in this audit. So that's why what I will do here is I might not be able to revise the complete chapter, but actually, and even one more thing, if I have to tell you, this chapter is little bit not suitable for revision. Why? Because we can't give you an overall picture unless we go deeper into the concepts. So that's why what I will do is I will be very selective here when it comes to revision. I will try to cover all the important concepts from this chapter. I might not assure you 100% of the revision, but I will pick all those important areas in this chapter. I will try to revise, and so that these important concepts will help you to learn the future chapters better. That connection will be there. That flow will be there. That flow will not get broken. So that's why I'm taking up this chapter for revision. So I will make your concepts clear, but you have to put a little bit more effort than when compared with the other chapters, especially when it comes to this particular topic. So having said that caution, having given that caution, now I will try to proceed further. So as you could see here, this chapter number 6, it contains two components actually. One is risk assessment part and the other one is internal control part. There are two topics which are associated with this chapter. One is risk assessment, other one is internal control. And mostly whatever content that we are going to learn from this chapter, all that content has been taken from SA 315. SA 315 is the main standard which we are going to cover as a part of this chapter, risk assessment and internal control. So first we will try to take up risk assessment related discussion. We'll try to revise quickly the risk assessment related concepts. Thereafter we'll come to internal control. We'll try to revise the concepts relating to internal control. So first we will talk about this risk assessment. We'll try to understand about risk assessment. Sir, what is risk assessment? What is risk assessment? First of all, as we all are aware, even from the beginning, nature, objective and scope of audit, from there itself we are seeing one point that whenever you're doing audit, your ultimate objective is to express an opinion. And when your ultimate objective is to express an opinion, when you try to fulfill that objective by way of expression of opinion, there is always a chance of your auditor's opinion going wrong. This we are all aware. There will always be a chance of auditor's opinion going wrong. Whatever opinion you have given, that is having a chance of going wrong. And if your opinion goes wrong, then there are some consequences which you are required to face. So that's what I say here. Whenever you have done audit, whenever you are expressing an opinion, there will always be some risk associated with the audit. There will always be some risk associated with the audit. You will be going to face some consequences because of expressing your opinion. So that risk in the audit, we are going to call it as audit risk. So whenever you are doing audit, there will always be a risk of your opinion going wrong. That risk in audit terminology, we call it as audit risk. This is not actually the technical definition. This is what in simple meaning, if I have to put it. We'll get back to that actual technical definition given to this term audit risk in a short while, but I'm telling you in simple terms. So whenever you are doing audit, there is always a chance of your opinion going wrong. That we call it as audit risk. Now, this audit risk, sir, what we can do? Can we completely eliminate this audit risk? No. If you remember the discussion which we had in the nature, objective and scope of audit risk is something which cannot be eliminated. You can't eliminate it. So you can't do the audit and say that, hey, I have done the audit here. My opinion will never go wrong. My opinion will always be 100% correct. Like that, there is no such a circumstance. You can't eliminate that audit risk. What we can only do to that audit risk is we can reduce that audit risk to a very low level. We can keep that audit risk at a very low level by properly performing the audit procedures. So one point which I want you all to keep in mind, we can't eliminate the audit risk. What only we can do? By way of performing better audit procedures, we can try to keep that audit risk at a very, very low level. And one more thing which I have to bring it before you here. So because of this, audit risk can't be eliminated. That's why we always say auditor will only express an opinion. He can't express a guarantee. You can't expect an auditor to give a guarantee. Why? Because as I have told, audit risk you can't eliminate it. So that's why you can't give guarantee. What is the maximum you can do? You can give an opinion. And also that opinion is a reasonable assurance. that opinion, whatever you are going to give, is a reasonable assurance. You can't obtain something called absolute assurance. You can't obtain absolute assurance. So we also know why we can't completely eliminate that audit risk, because the process of audit is suffering from some limitations which are inherent, which are unavoidable in nature. So because of that inherent limitations, number one, you can't eliminate the audit risk. You can't give guarantee. You can only obtain reasonable assurance. The one common reason for all that is the process of auditing is going to suffer from some limitations which are unavoidable in nature, and those limitations we call them as inherent limitations, regarding which we already had a discussion in the chapter nature, objective, and the scope of audit. Clear? Right. So I'm not going to the inherent limitations once again. So let us come back to the concept of audit risk. So first we'll try to understand what is audit risk, how this term audit risk has been defined. So if you come here, this is how the term audit risk has been defined. Audit risk means it is a risk that auditor gives an inappropriate audit opinion when the financial statements are materially misstated. So this is how the term audit risk has been defined. What they're trying to say here, as an auditor, there is a risk that whatever opinion you have given, that could be an inappropriate audit opinion when the financial statements are materially misstated. So what they are trying to say here. So what they are trying to say here is, let us say you are an auditor. You are conducting an audit of the company X Limited. It's a financial statements you are verifying. Now, let us say in these financial statements, there is a material misstatement. Financial statements of your client company is materially misstated. So when they are materially misstated, what should be an appropriate opinion? So I'm saying that you are conducting an audit of the client X Limited, whose financial statements are materially misstated. What should be an appropriate opinion? So appropriate opinion should be here modified opinion. You should have given a modified opinion. But instead of giving appropriate opinion, you are giving an inappropriate opinion. You are giving which opinion? You are giving an inappropriate opinion. That means what you are doing? Unmodified opinion you are giving. So financial statements are materially misstated. That means modified opinion is appropriate. But instead of giving a appropriate audit opinion, you are giving an inappropriate audit opinion. That means you are giving an unmodified opinion when modified opinion is appropriate. Then that risk we call it as audit risk. Because what will happen, sir? What will happen here is, when you are supposed to say modified opinion, that means, what do you mean by modified opinion? If you remember, we have three types. We have qualified, adverse, disclaimer. All these three kinds of modified opinions, we are going to comment negatively on the financial statements. So you are supposed to say either financial statements are not giving true and fair view, or there are some items because of which financial statements are not giving true and fair view. Whatever it is, whenever you are giving a modified opinion, you have to give a negative comment on the financial statements. But instead of giving a modified opinion, you are giving unmodified. That means you are trying to say that financial statements are completely giving a true and fair view. They are correct. So that means trusting on your opinion when you should have told negative comment regarding the financial statements, but you are giving a positive comment regarding the financial statements. By relying on your opinion, some people might have invested their money in the company, and after they have invested, they might have realized what are that wrong things they are doing, because of which they might lose the money. Then those people might raise a complaint against you. Say, this chartered accountant has given a unmodified opinion. He told that everything is okay in the financial statements. That's why we have invested the money in the company. But now our money has been lost. These people can raise a complaint against you, and you are liable to face the legal consequences. You have to face legal consequences. So that is what the risk you are facing here. So this is what I call it as audit risk. This is what I call it as audit risk. So what did I say? Audit risk. Auditor is giving an inappropriate audit opinion when the financial statements are materially misstated. That means financial statements contain a material misstatement and you are giving an inappropriate opinion. That means you are supposed to give a modified opinion. Instead of that, you are giving an unmodified opinion. That we call it as audit risk. Now, let me tell you other way around. Sir, what is the other way around? Let us say the same scenario. You are conducting an audit of the company audit of the company X Limited, whose financial statements you are verifying. Let us say these financial statements are not materially misstated. These financial statements are not materially misstated. There is no material misstatement in the financial statements. So if there is no material misstatement in the financial statements, what could be an appropriate opinion? If there is no material misstatement in the financial statements, what could be an appropriate opinion? So appropriate opinion could be unmodified opinion. You should have given an unmodified opinion. But instead of that, you are giving an inappropriate opinion. So that means, sir, what will be inappropriate opinion I am giving? You are conducting audit of financial statements, and that financial statements are not at all materially misstated. And what should be an appropriate opinion? You should have given unmodified opinion. But instead of that, you are giving a modified opinion. What you are doing, you are giving a modified opinion. So if you are giving a modified opinion when unmodified opinion is appropriate, will this also be falling under audit risk? The answer is no. This will not come under audit risk. Why, sir? He is facing risk. No, you understand here in the second case, what is the risk you are facing? Just think practically. If modified opinion is, if unmodified, when you should have told financial statements are giving a true and fair view, but instead on that, you are giving a negative comment. So now what will be the consequences? What will be the consequences is my client will become unhappy. Definitely, when I should have told financial statements are giving a true and fair view, instead of saying a positive comment, I'm giving a negative comment on that. So definitely my client will become unhappy. If he becomes unhappy, what he will do? Next year, he will not appoint you as an auditor. Let him be. Let him be. Sorry, I'm losing a client. No, sir. Yes, that is your business risk. Losing a client, losing reputation, that is your business risk. When I say audit risk, I'm not talking about your business risk. When I say audit risk, the risk which you are going to face legally, what legal action you are going to face, what penal action you are going to face, that is what audit risk I'm talking about. So if you lose the client, that is not at all an audit risk, because legally you are not going to face any consequences. No, if you take the second case here, legally you are not going to face any consequences. Why legally you will not face any consequences? Because boss, unmodified, you should have told financial statements are giving a true and fair view. You are being little more cautious and you told that something is wrong in the financial statements. Because of that, legally no one will come and question you. But you might lose a client. Yes, lose a client. That is a business risk for you. When I say business risk, that is not the audit risk. So when I say audit risk, I am only referring to that risk which auditor will face from the legal perspective, legally what consequences you are going to face. If you look at this scenario, in the first case, you will face the legal consequences, but in the second case, you will not face any kind of legal consequences, but you might lose a client. That is a business risk here. Okay. Understood? So if I put it in simple terms here, what is audit risk? Risk of expressing an inappropriate opinion risk of expressing an inappropriate opinion when the financial statements are materially misstated. If I put it in even simple words, when modified opinion is appropriate, but you are giving an unmodified opinion, that is an audit risk. Whereas if unmodified is appropriate, but you are giving a modified opinion, then it will not be termed as an audit risk. This point you have to remember. So when modified is appropriate, but if you are giving unmodified, that is an audit risk. But if unmodified opinion is appropriate, but if you are giving a modified opinion, that will not come under audit risk. And even audit risk does not include the business risk also, like risk of losing a client, risk of not recovering the fees, risk of bad reputation. So this is all nowhere coming under audit risk. Okay. Right. So if you come back here, so this second point also have covered it here. An auditor is expressing an unmodified opinion when the financial statements are materially misstated. But the most important thing here is, sir, what is not included in the audit risk, sir? So if you pay close attention, audit risk does not refer to auditor's business risk. When I say audit risk, I'm not talking from the business perspective. Audit risk is different from the business risk. And also, auditor might express an opinion that the financial statements are materially misstated when they are not. That will also not fall under audit risk. You are saying financial statements are materially misstated when there are no material misstatements. This will also not fall under audit risk. If I even further simplify it, in other words, if the auditor gives a modified opinion when unmodified opinion is appropriate, it will not be audit risk. If you are giving a modified when unmodified is appropriate, that will not be termed as audit risk. Now, coming to the next aspect of discussion, this audit risk is made up of various components. This audit risk is made up of various components. So audit risk, the risk of your opinion going wrong, that can happen because of multiple components. The two major components of audit risk is, one is risk of material misstatement and the other one is detection risk. Just give me a minute. So one is risk of material misstatement and the other one is detection risk. Sir, what is this risk of material misstatement? What is this detection risk? The entire audit risk is made up of two components. If I'm saying there is a chance of my opinion going wrong, it could happen because of two components. One is risk of material misstatement, other one is detection risk. Sir, what is risk of material misstatement? Risk of material misstatement, the term itself says material misstatement. Material misstatement means what? The misstatement which is having which could influence the decision of users. Risk of material misstatement, there is a chance of happening of material misstatements in the financial statements. That is what I call it as risk of material misstatement. The chance, the possibility of happening of misstatement in the financial statements even prior to the audit. Even prior to the audit. even before you start doing the audit, or if I put it in simple words, whether you do the audit or not doesn't matter. There is a chance of happening of misstatement in the financial statements, that I call it as risk of material misstatement. If I put it in very simple terms, let us say there is an organization, there is a manufacturing entity. In that manufacturing entity, there is a warehouse. The warehouse means where they will all keep their stock and all. In that warehouse, there are no internal controls. In that warehouse, there are no internal controls. Like, for example, there is no security guard, there is no CCTV footage, there is no proper inventory records. Just like that, anybody is going inside the warehouse, picking whatever item they want, and they're coming out. Now you tell me, if these kind of situation persist in the organization, is there a chance of happening of misstatement in the financial statements? Yes. Is there a possibility of happening of material misstatement? Yes. This is what I call it as a risk of material misstatement. And this risk will be there whether you do the audit or don't do the audit. If there are no internal controls in the warehouse, just because I am doing audit, there is no chance. Even if I don't do the audit also, there will always be a possibility someone can steal the product from that warehouse. So that risk, I call it as a risk of material misstatement, the chance of happening of misstatement in the financial statements even prior to audit. This is something which is happening because of the management. Management is responsible for it, not auditor. This risk is not created by the auditor. Nowhere auditor is involved in the creation of that risk. This risk will be there. Whether you do the audit or you don't do the audit, this risk is always going to persist. So it is something which is created by the management. It is management's related risk. Auditor is not responsible for its creation. Clear? So the chance of happening of misstatement, the possibility of happening of the misstatement, I call it as risk of material misstatement. So if you see it here, what is risk? One first component, risk of material misstatement. SA 200 states that risk of material misstatement is a risk that the financial statements are materially misstated. The most important term, prior to audit. Prior to audit. This will happen even before audit. Whether you do the audit or not doesn't matter. That risk is always there. If I put it in even simple terms, there is a possibility of fraud or error in the financial statements even before doing audit. Just because you are doing audit, this risk is not there. Even before you do the audit also, there is a possibility of happening of frauds and errors. So that risk we call it as risk of material misstatement. Now they are defining the term. What is the meaning of the term misstatement? This we have already understood in introduction to audit itself. Now, this risk of material misstatement is further containing two more components. This risk of material misstatement is even further made up of two more components. Audit risk is made up of two components. One is risk of material misstatement, other one is detection risk. Now, this risk of material misstatement is further made up of two more components. One is inherent risk, other one is control risk. One is inherent risk and the other one is control risk. Sir, what is inherent risk? What is control risk? Let us come here. So if you come back here, what are the components of risk of material misstatement? As you could see, two components are there. One is inherent risk we have, other one is control risk we have. So if you read the term inherent risk, they say that it is a susceptibility. Sir, what do you mean by susceptibility? Doubt. Not a confirmation, doubt. See, when I say risk is always susceptible. Risk is not confirmation. I'm saying risk, guys. Risk means what? Possibility. Okay. So it is a susceptibility. It is a doubt. On what, sir? Of an assertion about a class of transaction, account balance or disclosure. That means either a balance sheet item or a P&L item or a disclosure in the financial statement could be material either individually or when aggregated with other misstatements before consideration of internal control. Most important term, before consideration of any related internal control. So even before you consider internal control, there is always there is a chance of happening of misstatement. That risk we call it as inherent risk. Inherent risk. That means whether control is there or not doesn't matter. That risk will always be there. You should not consider the control only before you assess this risk. If I tell you one simple example, let us say company is going through very bad phase. Company is going through very bad phase. It is continuously in losses and they are not getting funding. It is going through very bad phase that even heavily market competition is there. Many new competitors have come. You are unable to secure the funds. You are continuously showing losses. If one more year, if you start showing the losses or negative cash flows, your investors will start losing the trust in the company. Such a situation you are in. Now, definitely management will be under the pressure to manipulate the results of the financial statements. In the current year financial statements, they can manipulate, they can show higher profits, they can show higher revenue because they are under immense pressure. See, this risk will be there. Whether you, to assess this risk, you will not consider any internal control. No matter how strong internal controls are there, this risk will always persist. No. Susceptibility, I'm having a doubt that company is going through such a bad phase. There is a risk of making a material misstatement in the financial statements. They can inflate their results, they can inflate their profits, they can inflate their revenue. Before considering, I will not consider internal control. I should not think about internal control only because this risk is there. These kind of risk we call them as inherent risk. So if you see here, it is a susceptibility, unavoidable risk it is. It is a susceptibility of an assertion. It is a doubt that an item of financial statements contains a misstatement that could be material either individually or when aggregated with other misstatements. Before consideration of any internal control, I need not consider any internal control. Before considering the internal control only, there is a susceptibility. There is a doubt that there could be a misstatement in the items of the financial statements which could be material. And there is always a risk that, so if I elaborate this once again, there is always a risk that before considering any existence of internal control in an entity, a particular transaction, account balance, or disclosure to be made in a financial statements may have a chance of being misstated. And also they say here, inherent risk is higher for some assertions. Not all items will have same inherent risk. There are some items which are more, which will be subjected to more inherent risk. There will be some items which will be subjected to less inherent risk. Guys, this concept is very deep here. Just on this concept of inherent risk, control risk, I have spent almost close to 1 hour in our regular classes or in our UOB lectures and all. So this is just a revision. I will restrict my explanation to this here. Next, examples also, if you see, yeah, this is what the second example I have used. These examples are very important because from these examples in the exam they create an MCQ, case scenario based MCQs they might create it. So better refer to these examples before you go for the exam. So as you could see here, an accounting standard providing guidance on some complex issue which might not be understood by the management. Management themselves are not able to understand internal control. If they are themselves unable to understand internal control, they might not apply it properly while preparing financial statements. Next, this is a second example which I have taken the help of to make you understand the concept. There are large number of business failures in an industry. Therefore, assertions in financial statements of an entity operating in such an industry can carry an unavoidable risk of being misstated. So this is what I call it as inherent risk. Next, control risk. Sir, a misstatement, there is a possibility of risk of material misstatement even because of control risk also. Sir, what is internal control? Sir, what is control risk? Sorry. What is control risk? See, as we all are aware that management will study about their organization and they will try to implement various internal controls. I already told you what is the meaning of the term internal control. Any policy or procedure which is followed by the management to prevent misstatements in the financial statements, that I call it as internal control. So let us say, for example, management, to prevent mistakes, to prevent errors, to prevent frauds, they will identify the areas in the organization and they try to implement that internal controls. Sir, what is the objective of implementing internal controls? The objective of implementing internal controls is either to prevent the misstatements or to detect the misstatements or to correct the misstatements. So internal controls mainly will try to fulfill three things here. Either they will prevent the misstatements, or they will try to detect the misstatements, or they will try to correct the misstatements. So with these objectives, the organization will implement internal controls. But these internal controls might have some weaknesses and they might fail. I will tell you in the same chapter, I will tell you what are the different circumstances, what are the different reasons because of which inherent controls can fail. We'll talk about it in the same chapter. But I'm telling you that organization, to prevent misstatements from happening, to detect the misstatements or to correct the misstatements, they implement internal controls, but those internal controls can fail miserably because of which they are unable to prevent or detect or correct a misstatement which has already happened in the financial statements. Management will implement some policies, procedures to prevent misstatements from, detect or correct the misstatements from happening. But these policies and procedures, these internal controls which are implemented by the management, they might fail to fulfill their objective. So because of failure of the internal control also, there is a chance of happening of misstatement in the financial statements. This risk I call it as control risk. If I have to put it in very simple terms, failure of internal control. Failure of internal control, that is what I call it as control risk. Okay, so here also you will be able to find some examples. My humble request, please have a look at these examples before you go for the examination. From these examples, they have a chance of asking a question. They might ask a MCQ. They will give you one example and they will ask you to identify what kind of risk is this. Or even they can ask a case scenario based descriptive question also from here. So better just you refer these examples before you go for the exam. Okay, right. So this is what, these are the two components actually. Guys, once again, if I give you context, what we're actually discussing, we are discussing what is an audit risk. So this audit risk contains two components. One is risk of material misstatement, other one is detection risk. What is risk of material misstatement? The susceptibility or possibility of happening of misstatement in the financial statements even prior to audit. And this risk of material misstatement can happen because of two reasons. One is inherent risk, susceptibility of an item of financial statements even before considering the internal control. Then control risk, there is an internal control designed by the management to prevent, detect or correct a misstatement, but failure of that internal control to prevent, detect or correct the misstatement, that I call it as control risk. Both inherent risk and control risk collectively give rise to risk of material misstatement. Till here, comfortable? Yes. Now comes the next concept, detection risk. Sir, what is detection risk? One aspect we have covered. So, as we all are aware, as an auditor, you will perform audit procedures. By performing audit procedures, you want to detect the material misstatements. There are some material. So, whenever you're doing audit, there might be some material misstatements which would have already happened in the financial statements. Now, as an auditor, you are doing audit, you will perform audit procedures, and by performing that audit procedures, you want to detect the material misstatements. But sometimes what will happen is whatever audit procedures that you have performed, those audit procedures are unable to detect the material misstatements in the financial statements. You perform audit procedures to detect the material misstatements only. But because of some reasons, either because of your mistakes or because of inherent limitations, whatever may be the reason, you are performing audit procedures and your audit procedures have been unable to detect, correct, or your audit procedures have been unable to identify a misstatement. That risk we call it as detection risk. So if you look at the meaning here, detection risk, it defines that the procedures performed by the auditor to reduce risk to an acceptably low level will not detect a material misstatement. So whatever audit procedures you are performing to reduce your audit risk, and how you will try to reduce audit risk by detecting more misstatements, but because of some reasons your audit procedures are unable to detect a misstatement which is already there in the financial statements, that risk I call it as detection risk. So this is something for which auditor is responsible. This is something for which auditor is responsible. So if you remember, I told that when it comes to risk of material misstatement, their auditor will not be held responsible. Who is responsible? It is created by the management. Whereas detection risk is the auditor's failure. Okay, so if you perform more effective audit procedures, if you perform more better audit procedures, if you are not careless, if you have been very careful, if you are very strong in your audit procedures, you will be able to detect more misstatements. You can keep the detection risk at a low level. If you are not performing audit procedures properly, if you are not careful, if you are very careless, reckless audit procedures you are doing, your ineffective team you are using, then you will not be able to detect material misstatements. Your detection risk will be very high. So whatever it is, the thing between the two components of the audit risk, between risk of material misstatement and the detection risk, which one auditor can control, which one auditor can influence is detection risk. You can influence the detection risk. If you perform more audit procedures, more you can reduce your detection risk. If you are performing not effective audit procedures, you are increasing your detection risk. But when it comes to risk of material misstatement, as an auditor, you can't control the risk of material misstatement. You can't influence risk of material misstatement. What is the only thing which you can do is you can identify. You can only identify. That to how you can identify, sir, by performing risk assessment procedures. Once again, go back to the audit procedures. So what is the flow of actual auditors? First, you perform audit procedures. By performing audit procedures, you identify the risk of material misstatement. Depending on the risk of material misstatement you have identified, you plan your further audit procedures, that is compliance procedures and substantive audit procedures. You will try to plan properly, and by planning that compliance procedures and substantive audit procedures, you try to control your detection risk so that you can reduce your overall audit risk. So that you can control your overall audit risk. See, I'm telling you objective from the risk perspective. What will happen in the entire audit from the audit risk perspective? So first you perform risk assessment procedures. From that you will identify risk of material misstatement. Depending on that, you plan your compliance and substantive audit procedures, and you will try to control, you will try to influence your detection risk in such a manner that your overall audit risk will be at a very, very low level. That is what the objective we have to fulfill. That's all. If you could do it, your objective of the audit has been met. Clear? Right. So that is what you say here. Then some important points. As an auditor, you can only influence detection risk. That means you can only control the detection risk. You can't do anything regarding risk of material misstatement. You can only identify it. Next, the auditor must reduce the detection risk in order to keep the audit risk at a very, very low level. Next, yeah. And as an auditor, whenever you are assessing the risk of material misstatement, you will not do separate assessment of inherent risk. You will not do separate assessment of control risk. You will do a combined assessment. You will do a combined assessment of inherent risk and control risk. By that, you will try to make an assessment of risk of material misstatement. and this has been mentioned in the formula here. So audit risk is a component of two, is a product of two components. One is risk of material misstatement and detection risk, and this risk of material misstatement is going to be further a component of a product of two components, inherent risk and control risk. So if I have to rewrite this formula, audit risk is a combination of inherent risk, control risk, and the detection risk. All these three put together, they will lead to the audit risk. Understood? So very complex topic. I hope you are able to understand it. So if you are able to understand it, I will try to proceed further with the remaining part of the discussion. Now, if we go ahead with the further discussion, so I would like to say here, so what are the different steps associated? If you come to the second heading, there is one important concept here. So as per SA 315, you are required to identify and assess the risk of material misstatement. And when you are identifying and assessing the risk of material misstatement, or for the purpose of identifying and assessing the risk of material misstatement as an auditor, you shall do 4 steps. Sir, what are that 4 steps in identifying and assessing the risk of material misstatement? Number 1, first you have to identify it. First you have to find it out. What do you mean by identification? Finding out. So first identify the risk throughout the process of obtaining an understanding of entity, environment, and its internal control. As you all are aware, when I'm performing risk assessment procedures, the main thing which I will try to do there is I will try to understand about entity, environment, and their internal controls, right? So throughout your process of understanding the entity, environment, and its internal control, you have to remain alert for identification of the risk. So once you have identified, then you have to analyze it. Then you have to assess it. Assess means what? Analyze. So analyze all the risk that you have identified and evaluate whether they are whether they relate more pervasive to financial statements as a whole. So whatever risk that you have identified, no, now that risk of material misstatement, whatever you have identified, that could be at 2 levels. Now I'd like to introduce one more concept for you all here. So while understanding the entity and its environment, we'll find out what is the risk of material misstatement. Now that risk of material misstatement, whatever you have identified, that could be at 2 levels. One is risk of material misstatement at the financial statement level, and the other one is risk of material misstatement at the assertion level. One important concept which you all must be aware, at various instances we use this. So we have to classify the risk of material misstatement, whatever you have identified, into 2 levels. One is risk of material misstatement at the financial statement level, and the other one is risk of material misstatement at the assertion level. Sir, what is risk of material misstatement at the financial statement level? Very simple terms, if I have to put it, if you have identified some risk, which is having a potential to cause misstatements in the entire financial statements. You identified some risk which is having a potential to cause a misstatement in the entire financial statements. Because of this risk, there is a possibility of happening misstatement, and that misstatement is not just restricted to 1 or 2 items of the financial statements. This risk is having a potential to cause the misstatement in the entire financial statements. That risk, I call it as risk of material misstatement at the financial statement level. On the other hand, if you find some risk which is having a potential to cause misstatement at only one particular assertion, at only one particular item of the financial statement. Let us say, for example, I found some risk. This is having a potential to cause a misstatement only regarding existence of the fixed assets. Or I found some risk. This risk is having a potential only to cause a misstatement on valuation of inventory. So like that, if you identify any risk which is having a potential to cause misstatement in just 1 or 2 items of the financial statements, that I call it as risk of material misstatement at the assertion level. On the other hand, if you find out the risk that is having a potential to cause a misstatement in the entire financial statements, that I call it as a risk of material misstatement at the financial statement level. So first you will identify the risk. Once you have identified the risk, then you have to assess it. Then you have to analyze it. Is it a financial statement level risk or is it an assertion level risk? Thereafter, relate the identified risk to what can go wrong. Okay, you have identified, you have analyzed it. Now you relate it. Okay, because of this risk, what and all can go wrong in the financial statements. So relate that identified risk to what and all can go wrong. Thereafter, consider the likelihood of the misstatement. Okay, you identified the risk, but what is the likelihood of misstatement? Identifying the risk is only possibility, but what are the chances that it could turn into reality? What is the likelihood of getting that risk converted into a misstatement? So even you consider the likelihood of the misstatement. So like that, there will be, whenever you are identifying and assessing the risk of material misstatement, you shall do these 4 steps. What are they? Number 1, identify. Thereafter, you have to assess it. Then you relate that identified risk to what can go wrong and consider the likelihood of the misstatement. Clear? Next. And sir, if I have to identify risk of material misstatement, what and all I can do? Simply, if I have to put it, if you remember the discussion from audit documentation and evidence chapter, as I have told you, to perform any audit procedures, we have only 7 methods available. What are the 7 methods available? We can do inquiry, we can do inspection, we can do observation, we can do external confirmation, we can do recalculation, we can do reperformance, and even we can do analytical procedures, right? For performing any audit procedure, we have only 7 methods available. Now you tell me, for performing risk assessment procedure, that is for understanding the entity environment and its internal control, and to identify and assess the risk of material misstatement, out of these 7 methods, whatever we have, which one will be suitable for performing risk assessment procedures? Can you do inquiry? Yes. Can I do inspection? Yes. Can you go through some documents and understand what about the entity environment and its internal control? Yes. Can you do observation? Yes, we can do something called plant visit. Plant visit is nothing but observation. Yes, I can do observation to understand about entity environment and its internal control. Can I do external confirmation? No, this doesn't fit in here. So you can't get a confirmation from a third party to understand about your client's entity environment and its internal control. External confirmation is not fitting in here. Can I do recalculation? Are you an astrologer? So can you do some math? Are you a numerologist? Can you do some calculation and tell about the entity environment and its internal control? No. Can you do reperformance? Quite not practicable. So will you do the business entirely once again? Will you do your client's business once again to know about it? Not possible. Sir, can I do analytical procedures? Yes. You can study the relationship between financial and non-financial items, and from that financial and non-financial items, you can understand about the entity, environment, and its internal control, and even you can identify and assess the risk of material misstatement. So that's what they say here. So what is included in the risk assessment procedure? As you could see here, you can do inquiries, not just inquiries, even you can perform analytical procedures, and even what you can do is observation and inspection also you can do. So we have 7 methods available. Out of that 7 methods, 4 we can use it here: inquiry, inspection, observation, and analytical procedures. See, out of this also, the most very frequently tested question in the exam is, sir, what and all inquiries you can do? With whom you can do the inquiry? What do you mean by inquiry? First of all, asking the question. So you are trying to get the information by way of going and speaking with the people. Sir, with whom you can inquire? If you want to understand about the entity, environment, and its internal control, who and all are the different people with whom you can inquire? There is no doubt we have to inquire with the management. But do you think management are the only people with whom you can inquire? Or are there other people in the organization also with whom auditor can go and do the inquiries and get to know about the client's entity, environment, and its internal control? Definitely, there will be people other than the management also. There is no doubt. Primarily, we go and inquire with the management to get the information regarding client's entity, environment, and its internal control. But management are not the only people with whom you are going to go and conduct the inquiry. There are various other people also with whom you can go and conduct the inquiries. Sir, who are all that other people, sir, with whom you can inquire apart from management? So apart from management, you can go and inquire with the internal audit person. If in case if your client company is having an internal audit team, go and inquire with the internal audit team. So if you inquire with the internal audit team, you can get to know whether the client is having proper design and effectiveness of internal control, whether management has satisfactorily responded to the findings of the internal audit team or not. So go and inquire with the internal audit team. And you can go and inquire with employees, not just management. Go and inquire with the low level employees, how they are initiating the transaction, how they are processing it, how they are recording the transactions. Even you can go and inquire with in-house legal counsel. If they have a dedicated in-house legal team, go and inquire with the in-house legal team so that they will give you information regarding compliance with the laws. Are they facing any litigation, any fraud, suspected fraud? You can get that information if you go and speak with in-house legal counsel. Even you can go and inquire with marketing or sales staff, what kind of business strategies they are following, all their sales increasing or their sales decreasing. You can get to know about their marketing or sales work. Even if there is any risk management function in big organizations, you will have a dedicated risk management team. Go and speak with the risk management function if any such a department is there, so that you can get to know what kind of risk they are facing and are these risks are affecting the financial reporting. And not just that, if there are IT people in the organization, information system personnel, technical people are there in the organization, even you can go and inquire with them to get to know what accounting software they are using, what ERPs they are using, how much relying they are on the technology, all that you can get to know about it. So this is one favorite area for the examiner. So the auditor will not just inquire with the management. These are all the different people with whom you can inquire. You can inquire with internal audit person, you can inquire with employees, you can inquire with in-house legal counsel, you can inquire with marketing or sales person, you can inquire with the risk management function, even you can go and inquire with the IT personnel also. Thereafter, as we all are aware, what will happen in the analytical procedures? So what is analytical procedure? We try to study the relationship between financial data, non-financial data, try to analyze the relationship. By that, we will find out any deviations are there, any differences are there. We try to investigate the deviations further. From that also, you can identify the risk of material misstatement. So this is general discussion only. You try to study the relationship, you find out unusual relationships. From that, you can identify unusual transactions. That will help you to identify the risk of material misstatement. And observation and inspection, we already know it. You have to go and observe the premises. You have to go and inspect. And this observation and inspection, that can support the inquiries. First, we do inquiries of the management to evaluate the responses of that inquiries. You can support them with inspection and observation. Sir, what and all I can observe, what and all I can inspect? You can observe the entity's operations. You can inspect the documents like the business plans, strategies, MOUs, AOUs, MOAs, AOAs, and even you can go through the reports which are used by the management. Even you can observe the entity's premises and the plant facilities also. So like that, different things you can observe, different things you can inspect to get to know about the entity. Then comes the most important part here, understanding the entity and its environment. So guys, you have all agreed that one of the most important thing which you have to do in the audit is we have to understand about the client's entity and we have to understand about the entity's environment. Let us say you are my article assistant. I'm a chartered accountant in practice. I'm your partner. You are my article assistant. I called you one day and I told, boss, we are required to go to some client. There is a client X Limited. We have to go and conduct audit of that client X Limited. I'm giving you a task. You go to that client, try to understand about the entity, try to understand about its environment. So just imagine, step into the shoes of that article assistant. You are an article assistant. Under me, I told you tomorrow you have to go to that client's premises and you have to come back to me after getting an understanding of entity and its environment. What things you will understand? When someone is asking you, you have to understand about the entity and its environment. What exactly you will try to include in that understanding? Like this also, they might ask a question in the exam. Sir, what will be included? Definitely, sir, understanding the entity and its environment is very important. But what is that things which I will try to actually understand? So that is like this here. First thing, when I ask you to go and understand about the client's entity and its environment, first thing what you should focus is to which industry it belongs. To which industry your client belongs. Is it a manufacturing? Is it service sector? If it is manufacturing, it is automobile sector. Is it metal sector? Is it automobile sector? Is it electronic sector? First, you have to understand the industry to which your client belongs. Regulatory, what kind of laws and regulations are applicable for your client? Or any other external factors like what kind of applicable financial reporting framework will become applicable for your client? Is your client required to follow Banking Regulation Act? Is your client required to follow IRDA? Is your client required to follow Schedule 3? So you have to understand. So first thing, what will be included in understanding of entity environment and internal control is industry, regulatory requirements, and other external factors like applicable financial reporting framework. So here also in this aspect, examples are very important. Please have a look at once and go to the exam before you go for the exam. Just have a quick look at the examples. Like what are the examples of the matters that you will consider? What accounting principles they are following? What are the industry specific practices? What kind of regulatory framework? What kind of laws and regulations will become applicable for you? Legislation and regulation that significantly affect the entity's operation, including direct supervisory. Is there any regulatory department which is having a direct supervision on you? Or taxation, what kind of taxation laws will become applicable for them? What kind of government policies, how the government policies will affect this particular client's business? And environmental requirements affecting the industry and the entity's business. Okay, so these are all, if I have to put it in very simple terms, this I call them as external factors. So external factors I have to understand. After understanding external factors, now I have to get a clear picture of their internal activities also, the nature of the entity. Like what, sir? Like what are their operations? Is it a manufacturing entity? If it is manufacturing, is it labor intensive, capital intensive? And ownership and governance structure. Who are the owners? How they are getting governed? What types of investments that the entity is making and plans to make, including investment in special purpose entities, how they are investing their money, the way in which entity is structured, how it is financed, is it equity financed or debt financed? And all this will enable the auditor to understand the class of transactions, account balances, and disclosures which are expected in the financial statements. So in this point, they're talking about the internal matters. First, you will try to understand about external factors. Thereafter, you try to understand about this internal aspects of your client's business. And particularly here, so what are all the examples that the auditor will particularly concentrate here? Like business operations, such as nature of revenue, from where this company is getting the revenue from, what kind of products they are selling, what kind of services they are offering, how they are conducting operations, where their production facilities are located, who are their key customers, who are their key suppliers. And investment and investment activities such as capital investment, activities planned or recently executed acquisitions. Are they planning any acquisitions? Financing or financing activities such as subsidiaries, debt structure, etc. And financial reporting such as accounting principles, revenue recognition practices. So like that, internal matters you have to understand. So first one, external factors like industry, regulatory requirements. Number two, internal factors. Thereafter, the entity's selection and application of accounting policies. What accounting policies your client is following, and whether those accounting policies are consistently applied or not. Year after year, they are following same accounting policies or not. Then, what kind of entity objectives are there? What is the objective of your client? To achieve that objective, what strategy they are following? By following that strategies, what kind of business risk they are facing and how they are tackling the risk. See, depending on your client's business, different entities will face different kind of risk. Sorry, just a minute. Yeah. So depending on the business which your client is engaged into, they might face different kind of risk. So if I have to show you here, yeah. So these are all the examples. Examples are very important here. So depending on the client's business, different kind of risk they can face. So first you have to understand what kind of risk your client is facing. Like industry developments, sometimes some industries will be very much affected with the changes which are happening in the industry. Or new product and services, sometimes altogether a new product will come into the market. If your client company is not updated with that new technology, they might stay out. And expansion of the business, sometimes all of a sudden businesses will grow and suddenly sudden expansions also will give rise to new risk and all, because you are not ready for that expansion. Next, so like that you have to understand what objectives they have, and to achieve that objectives what strategies they are following, and what kind of business risk that is resulting into. Then, and finally, not just that, you have to even understand, you have to measure and review the entity's financial performance over a period of years. How the entity is performing. Is the revenue growing or stagnant? Is it in the growth phase or declining phase? Is it revenue growing or not growing? So like that, even you have to measure and review the entity's financial performance also. Sir, where I can get that? What kind of things I have to understand it here? Like key performance indicators, like financial and non-financial ratios. Ratios you have to calculate, trend you have to see, statistics you have to observe, period on period financial performance analysis, quarter on quarter, year on year, increasing or decreasing, that analysis you have to do. You have to look at budgets, forecast, variance analysis, departmental or other level performance reports, and even credit rating agency reports. Get their CIBIL score, get their credit score reports also. From that also you can make an understanding how this entity is performing over a period of time. So you have to get to understand about your client's financial performance. So definitely one thing you all have to remember, yes, understanding the entity and its environment is very important, but what is included in that understanding of the entity and its environment? Number one, external factors like industry, regulatory and applicable financial reporting framework. Internal factors like their operations, how they are structured, how they are financed, what kind of investments they are making. Then you have to understand about their selection and application of accounting policies, and what kind of objectives they have for that, what strategies they follow, and even how different kind of risks are resulting from it. And thereafter, finally, you have to measure and review the entity's financial performance also. Clear? So this is what specifically included here. Sir, what is the importance? Now you might get a doubt. What is the importance of understanding the entities and environment? This we are already aware. If you understand the entity and its environment, that will help you in planning the audit in a better manner. You will also get to know which areas require more attention. And it is also one of the important principles in developing an overall audit plan. And without adequate knowledge, proper audit is never going to be possible. And one more important aspect here, understanding the entity is going to be a continuous process. Understanding the entity is not just an one-time activity, it is going to be a continuous process. It is not like at the beginning we have understood about the entity and we'll stick to it. No. Throughout the audit, from the beginning till the conclusion of the audit, you have to keep on updating your knowledge. Definitely, at the beginning of the audit, you will try to get an understanding of the entity, environment, and its internal control. But you should not say something like, at the beginning, I have understood, I will not change my understanding. Whatever understanding I have got, that is final. Even if I get new information, also, I will not consider. Like that, you should not be so rigid. You should be ready to update your knowledge on a continuous basis. That is what they say here. Understanding the entity is a continuous process. And this is one important aspect here. Understanding establishes a frame of reference within which auditor plans the audit and exercises professional judgment throughout the audit. See, from this they can frame a question. So if you understand the entity and its environment, it will help you to plan the audit in a better manner, and it will help you to exercise your professional judgment in a better manner. How? Give some examples. Like this, they can frame a question here. I'm telling you a possibility of an exam question here. So they might take one simple sentence and from that they can frame a question. So understanding establishes a same sentence they will use. Understanding establishes a frame of reference within which auditor plans the audit and exercises professional judgment throughout the audit. Give some examples. That means if you understand the entity, you will get one reference how exactly you are required to do the audit, and it will help you to exercise your professional judgment in a better manner. So how? Examples. So number one, if you understand the entity and its environment, that will help you to assess the risk of material misstatement. That means you will get to know which area is more risky, which area is less risky. And you can also determine materiality. Depending on the understanding of the entity only, will fix our materiality as per SA 500 and SA 320. And thereafter, whether the client is following up accounting policies, whether a client is selecting the appropriate accounting policy, and whether they are applying that accounting policies correctly or not. If you have to judge it, for that you need to obtain an understanding first. So if you have to comment whether your client is using an appropriate accounting policy, you can judge on the appropriateness of accounting policy only when you know the client's business. Then you can also identify areas where special audit consideration is required. This is nothing but other way of stating the first point only. In the first point, they say you will find out where there is a risk of material misstatement. That is nothing but wherever risk is higher, those areas require more audit consideration. Then you can also develop expectations for use when you are performing analytical procedures. This we will try to cover it in SA 520. When we are performing analytical procedures, we will also develop expectation. This is how the figures should be. How you will build that expectation, sir? Once again, on the basis of understanding of the entity and its environment. And also, you have to judge whether the evidence, whatever you have obtained, is sufficient and appropriate. Even for judging whatever evidence that you have obtained is sufficient and appropriate or not, there also understanding the entity plays a very crucial role. So simply, if I have to put it, understanding the entity is a continuous process. It will give you a reference how you should perform audit procedures, and even it will help you to implement your professional judgment in a better manner. How, sir? These are all the different ways. You can get to know the areas where there is a risk of material misstatement. You can determine materiality. You can determine the application of accounting policies. Even you can identify areas where special audit considerations required. You can also develop expectations for performing analytical procedures. Even you can make a better judgment regarding sufficiency and appropriateness of audit evidence. Clear? So one aspect of this chapter we are done with the revision, which is regarding risk assessment we have completed. Now the next part which we have to revise is regarding internal control. So let us try to go ahead and try to revise the internal control related discussion also. So now coming to the internal control, see, regarding internal control, as a part of our earlier chapters also, we had so much of discussion, but we are now going to put all that internal control related discussion into the technical terms. So let us try to have a quick look at the concepts related to internal control. First of all, we'll start with what is the meaning of the term internal control and what is going to be the purpose of internal control. So as we have already told, internal control means any process which is designed, implemented, maintained. That means the designing part, which kind of process should be there, that designing, not just designing, even implementation, not just implementation, even after implementation you need to maintain it. So any process which is designed, implemented and maintained by whom, sir? By either those charged with governance, by the management, or other personnel. So that process, any plan, any procedure, any process which is designed, implemented and maintained by those charged with governance, management and other personnel, that we call it as internal control. And what is the main purpose? What is the main objective of internal control? See, whether they ask you what is the objective of internal control, or even if they ask you the question what is the purpose of the internal control, we are going to write the same 4 points which you have to remember. These 4 points should get printed in your brain. So whether they are asking you what are the objectives of internal control system, or even if they are asking you what is the purpose of the internal control system, we are going to write some 4 points. So what are that 4 points which you are required to write? Whether they ask you objectives or purpose. Number one, the first and foremost objective is to increase the reliability of financial reporting, to make the financial statements, to make the books of accounts even more and more reliable, and also to increase the efficiency and effectiveness of operations. As an organization, you might be doing various kinds of operations. There are some internal controls which are working with the objective of increasing that efficiency and effectiveness of that operations, or even safeguarding of assets. One of the main objective, protect the assets of the company, and even to make sure that you are complying with the laws and regulations. So if you pick any internal control, either it will be fulfilling at least one of these objectives, or it will be fulfilling all the 4 objectives. You pick any internal control in the organization, it will be trying to fulfill at least one of these objectives. I'm saying at least one of the objective. That means there might be some internal controls which can be fulfilling all these 4 objectives also. But whatever it is, once again, if I repeat, what and all are the objectives or purpose of internal controls? Number 1, increasing the reliability of financial reporting. Number 2, increasing the efficiency and effectiveness of operations. Number 3, safeguarding of the assets. And number 4, compliance with the laws and regulations. As simple as that. So whether they're asking you objective, or even if they're asking you purpose, please write the same thing. Then, so Do I need to understand internal control? Definitely, 100%. As a part of risk assessment procedure, you have to obtain understanding of entity, environment, and internal control. Sir, what benefits I'm going to derive by understanding internal control? Number one, it will help you to identify potential misstatements. What kind of misstatements can happen? Because if you understand internal control, you will get to know whether they are working effectively or not. From that, you can make an assessment what kind of misstatements could happen. And also you can identify the factors that affect risk of material misstatement. Depending on that, you can even betterly identify the risk of material misstatement. And depending on that, even you can betterly plan your nature, timing, and extent of the further audit procedures. You can betterly plan your compliance procedures and substantive audit procedures. So these are the benefits of understanding internal control. Then, sir, what will be the limitations of internal control? Guys, if you remember the nature, objective, and scope of audit, as I have told that no matter how effectively you do the audit, no matter how effectively you do the audit, there will always be some limitations because of which your opinion can go wrong, right? Similarly, no matter how effectively you implement internal controls, you might be designing in an excellent manner, you might be implementing it in an excellent manner, you might be maintaining it in an excellent manner, you're using the best resources, you're using the best technology. No matter how effectively you implement internal controls, there is always a chance that internal controls might not work effectively, because like the way audit is suffering from some limitations which are unavoidable, even internal controls also will suffer from some limitations which are unavoidable in nature. That's why we call them as inherent limitations. So like the way the process of audit is suffering from some inherent limitations, even this internal controls are also suffering from some inherent limitations. Sir, what are all that inherent limitations? When I say inherent, something which is unavoidable in nature. So that's why the first point they say internal control can only provide reasonable assurance. Like the way audit cannot provide absolute assurance, even internal controls also can't provide absolute assurance. They can only give you reasonable assurance. Sir, why? Because there are some limitations. What are they? Number one, human judgment in decision making. By the end of the day, these internal controls are all decided by the human judgment. As humans, we decide in which areas there is a chance of happening misstatement and we will implement it. So since there is a human judgment involved, and as humans we always tend to make some mistakes, even while deciding on the policies and procedures of internal controls also we might commit some mistakes. There might be error in the human judgment because of which internal control can fail. So that's what they say here, human judgment and decision making. So reality is that human judgment and decision making can be faulty. Whatever human judgments you have made in designing and implementing internal control systems, that can be faulty, that can go wrong, because of which your internal control will not achieve its stated objective. Then lack of understanding the purpose. Those people who are required, who are a part of the internal control system, those people who are required to implement and monitor the internal control system, sometimes they don't understand the basic purpose. If the people who are required to monitor or implement the internal control system, if they don't understand the purpose of the internal control, then also internal controls will not work effectively. And collusion, one of the most common reason why internal controls will fail is those people who are required to implement internal control, they will collude with each other. See, one of the most common internal control which we often have is segregation of duties. So what management will do is, if entire end-to-end process has been kept under the control of a single person, he can manipulate. So that's why what they will do, they will appoint different kind of people and they will allocate the work among different people. Now what these people will do is, those people among whom the work has been allocated, they will collude with each other and they can make the internal control fail altogether. So this is also one common reason because of which internal controls fail. Collusion among people. Not just that, management also can override internal controls. Management are the people who design internal controls. They themselves can override the internal controls for their personal benefit. And also, especially in small organizations, especially when you look at some small entities, they don't have structured internal control system. They don't have any structured internal control system. You will also be not able to find huge amount of staff there. In small entities we have limited number of people. Since there is limited number of people, no effective segregation of duties. And also in small entities, the owner himself, if he is managing the business, he will have better control and oversight of the entire business. Since the owner manager himself will have a better control or oversight of the entire business, he will not show that much interest in the segregation of duties. So because of this lack of number of people, and also since manager is having oversight of the entire business, there is always a chance that there is more chances that in case of small entities, internal controls might not work effectively. So these are all inherent limitations of internal control. First point is not exactly an inherent limitation. First point, they just say that they can only give reasonable assurance. Why they can give only reasonable assurance? From the second point onwards, they give that inherent limitations. What are they? Human judgment in decision making. Those people who are required to implement internal controls, they don't understand the purpose. Collusion among the people will be there, and management will make sometimes wrong judgments, and even in small entities the limitations are even higher. Okay. Then we have one part called components of internal control system. So this is one such part which is not actually fit for revision, but I will tell you. So when you say internal control, in the internal control, there will be 5 components. How many components? There will be 5 components of internal control. Sir, what are that 5 components of internal control? Number one is control environment. Number two is entities risk assessment process. Number three, information system, including the related business process, which is relevant to financial reporting. Number four, we have something called control activities. And number five, monitoring of controls. So come on, repeat everybody along with me. What are the 5 components of internal control? Number one, control environment. Number two, entities risk assessment process. Number three, information system, including related business processes. Number four, control activities. Number five, monitoring of controls. I will tell you in simple common language what is the meaning of all these 5 components. Number one, control environment. See, if you want to have a good internal control system in the organization, that will be possible only when you have a good control environment. So what is good control environment? Good control environment means the entity should create a culture of honesty. The entity should create a culture of ethical behavior in the organization. If you don't have a good culture, good ethical behavior, like management is not good, their philosophy is not good, those charged with governance are not participating, there is no proper structural framework in the organization, then no matter how many policies you try to bring it, those internal controls will never work. So that's why the first and foremost component, if any organization wants to implement internal control, the first and foremost component which they have to put in place is they have to create a good culture in the organization. Culture of honesty, culture of ethical behavior they have to create. So if environment is good, automatically internal control will work effectively. So that's what they try to say it here. Sir, what is control environment? So if you see here, the governance and management functions and attitude, awareness and actions of those charged with governance and management, and the control environment sets the tone of the organization. So if you have a good control environment, it will set the entire tone of the organization. It will influence the control consciousness of the people. Sir, what will be included in the control environment? What are the various elements of control environment? If I have to put it in even simple words, how you can make sure that good control environment is created? Number one, there should be an effective communication. Not just communication, enforcement is also required. First, as a management, as a those charged with governance, you have to communicate with your staff how important it is to remain honest, how important it is to remain with ethical behavior. Just a communication alone will not be enough. You have to enforce it. If you find someone who is not sticking to that, if you find someone who is not ethical, who is not honest, you should enforce. That means you have to take immediate action. You have to remove him from the company or you have to penalize him. So like that, communication is required, but just communication alone will not be enough. Even enforcement, you have to put that into action. Next, commitment to competence. At the time when you are recruiting the people, you should always show the commitment to capabilities. Don't give undue importance to any recommendations or something. When you are selecting the people, select those people who are competent, who are capable. Then participation by those charged with governance. The more those charged with governance is participating in the business, the better control environment will get created. When I say those charged with governance, the top level management. When I say top level management, they should not be always sticking to their cabins. They have to frequently come and participate in the business. The more the those charged with governance participate in the business, the better control environment will get created. Then management's philosophy and operating style. What kind of philosophy management is having? What kind of operating style they have? Like what attitude they have towards financial reporting? What approach they are taking in selecting accounting policies? How they are developing accounting estimates? This will actually decide whether they have a good culture or not. And also how the organizational structure is there. Like, is there a proper framework? Is there proper hierarchy? Who is top level management? Who is middle level management? Who is low level management? Who can approve what, and what system they have? Is there any proper protocol getting followed? So the better the culture, the better structure is there, the better control environment will get created. And also there should be proper assignment of authority and responsibilities even in your HR policies also. With that, even in your HR policies, like at the time of recruitment, orientation, training, evaluation, counseling, promotion, everything at all stages of your HR policies also, you should be having proper environment. So that is what the first element of components of internal control, which is control environment. You have to establish a good culture of honesty and ethical behavior. Thereafter, next thing, if an organization wants to implement internal control, first they have to study about their own organization, where the risk is happening, then they can implement internal controls. Quite logical. See, if an organization wants to implement internal control, why internal controls are getting implemented? To prevent the risk from materializing. Before you can prevent that risk from materializing, first you should know where there is a risk in the organization. No, to know that risk in the organization should do the risk assessment process. Like the way we auditors are doing risk assessment process, where we try to put our effort to understand entity, environment and its internal control. Periodically, the management also should study about their own organization and find out where the risk is there. Because if you know the place where there is a risk, then only you can implement internal controls. So that's what is the second step, second component. As an organization, you have to understand, you have to establish one risk assessment process. So you have to identify what kind of business risks are there. You have to analyze the significance, what is the importance of this risk, what is the likelihood of their occurrence, and also deciding what actions to take. And risk can arise from various factors. As a management, you should study your own organization and understand what and all risk your organization is facing. Thereafter, the third component of internal control, which is going to be information system. As we all are aware, today the dependency on internal control, the dependence on information technology has improved a lot. And even today, for the purpose of implementation of internal controls also, we are relying on internal controls. Not just for implementation of internal controls, even for maintaining our books of accounts, preparing the financial statements. And frankly, if I have to put it before you, today whatever financial statements we are seeing on the websites of the so-called listed companies, those financial statements are not prepared by a human being sitting there and putting hours and hours of effort. No, they are using advanced ERP softwares like SAP, Oracle and all, where they only do data entry. Automatically these financial statements are getting prepared by the system. So we have to identify that information system, we have to study about the information system, we have to use information system. So that's what they say here. So as an auditor, you shall obtain an understanding of what and all information systems your client is using, which are related to your business processes, like class of transactions in entities operations which are significant to financial statements. That means those transactions which are very much important to financial statements, there how we are using information system, and the procedure by which these transactions are initiated, how that important transactions are getting initiated, how they are getting recorded, how they are getting processed, how they are getting corrected as necessary, and how they are getting transferred to general ledger. From there, how they are flowing to the financial statements. Understand the entire process. And related accounting records for the transactions, how the proper accounting records are getting maintained, how that information system captures events and transactions, whatever software they are using, how it is capturing that data, what financial reporting process they are following, and regarding the journal entries, what kind of controls are there. And when I say information system is a combination of multiple things. It contains infrastructure, software, people, procedure, data, everything put together. We call it as information system. And many information systems are making very much extensive use of information technology. Not many information systems. Today, all information systems are making use of information technology. And the quality of system generated information affects management's ability to make appropriate decisions. Since today all the data which is getting generated is from the information system, and depending on the data, management is taking decisions. Management decisions will be appropriate only when they're using the quality data. If the management is not using appropriate data, the decisions also will not be appropriate. So simple logic here, guys. Management today is taking decisions. On what basis they're taking decisions? Data. From where the data is getting generated? From the system. If the management decisions have to be appropriate, data should be appropriate. If data has to be appropriate, your information system should be appropriate. Next. So that's why the auditor shall obtain an understanding of how the entity communicates the financial reporting rules and responsibilities. So this is what the third step, information system. Then fourth step, control activities. This is where actual control steps you are going to decide. Actual implementation of controls will happen here. So once you have set the control environment, once you have understood the risk, then once you have procured all the information systems, now actual implementation of control activities will happen. This is the stage where actual implementation of controls will happen. And there will be different kind of control activities like performance reviews, periodical reviews of budgets and all. That is also one kind of control activity. Information processing, for example, controls over checking arithmetical accuracy, automatic calculations and all. That is also one kind of control activity. The control activity could be in the form of physical controls like appointment of security guards, CCTV cameras and all. And that control activity can be even segregation of duties. So depending on the risk, whatever you have identified, there could be various kind of control activities which could be implemented. They could be performance reviews, they could be information processing, they could be physical controls, or even they could be segregation of duties. So whatever it is, actual implementation of control activities should happen. So just implementing the controls alone will not be enough. One more last step is there. You have to even monitor the controls also. Whatever controls that you have implemented, whether those controls are working effectively. Are you required to make any changes to the existing controls? Are you required to delete any existing policy? Are you required to add any extra internal control? This continuous monitoring also should happen. and this monitoring should be done on a timely basis. It is not like today you have implemented internal control, after 3 years 4 years you are coming and reviewing. No, do it on a timely basis so that you can reduce the you can reduce the losses. So like that, periodical monitoring is also required. So this is once again a very broader concept, guys. Here I gave you one overview. There are 5 components of internal control. So if you have attended our sessions, this components of internal controls, we take somewhere around some 2.5 hours, 3 hours to complete this components of internal control. That much vast and huge a discussion it is. But in the marathon, I can't afford that much amount of time, but I have touched on all the important concepts. So 5 internal control components. Number 1, creating a control environment. Number 2, doing an entity's risk assessment process. Number 3, information system including related business process. Number 4, control activities. Number 5, monitoring of the controls. I told you what will happen in each of this component. Then comes the next part. Sir, there could be n number of controls in the organization. Do you agree with my statement? 100%. If you look at any business organization, they can have n number of internal controls. There are organizations where there will be 20, 30, 100 internal controls. But as an auditor, do you think we are required to be concerned about each and every internal control? Do you think each and every control is relevant for the audit? Definitely not. So there could be n number of internal controls in the organization, but not every control is relevant for us. Whether a control will be relevant for us or not, it depends on various factors. After considering all the factors, if we have decided that a control is relevant for us, then only we'll worry about it. After considering all those factors, if we decided that some internal control is no longer relevant for us, we need not worry about it. We can ignore it. Now your question will come, sir, what are that factors depending on which auditor will decide whether a control will be relevant to you or not? These are the list of factors which auditor will consider in determining whether a control is relevant or not. Number 1, materiality. Number 2, significance of the related risk. Number 3, size of the entity. Number 4, what kind of entity's business it is. Diversity and complexity of the entity's operations. Are they into more diverse business or one or two just one specific business? What is the applicable legal and regulatory requirements? The circumstances and applicable component of internal control. Nature and complexity of the systems which they are using. And whether how a specific control individually or in combination with others prevents or detects or correct a material misstatement. So these factors you have to remember it, my dear students. Once again, a very important area for the exam. Many times I have tested it. What are all the factors which auditor will consider, or what are the factors that in auditor's judgment will determine whether a control will be relevant for the audit or not? So these are all the various factors which we have to keep in mind. Once again, if I give a recap here, so materiality, significance of the related risk, size of the entity, nature of entity's business, diversity and complexity of the entity's operations, legal and regulatory requirements, circumstances and applicable component of internal control, nature and complexity of the system, and how a control individually or in combination with others prevent, detect, or correct a misstatement. Clear? Right. Next. Yeah. So this is also regarding relevance only. So 5 and 6 you can have a look at it. Thereafter, I will tell you about only important things we'll try to cover. This is one such important area. Factors that auditor will consider in determining and identifying significant risk. See, once we identify the risk, from that risk, whatever we have identified, we need to evaluate which risk is a significant risk. Why? Because if you find certain risk as a significant risk, if you classify certain risk as a significant risk, that there you have to spend more time, more attention. But a question will come to you, sir, how to classify, how to identify which risk is significant risk? Out of multiple risk which you have identified as a part of our risk assessment process, how to identify which risk is a significant risk? If I have to end it in one line, it depends on professional judgment. If you have to end it in one single line, it depends on professional judgment. As an auditor, you have to apply your professional judgment and determine which risk is a significant risk. But here they will give you few examples, few factors which you will consider. So if you read this first line, as a part of risk assessment, the auditor shall determine whether any of the risk identified are in the auditor's judgment is a significant risk. So it depends on your judgment. Depending on your judgment, depending on your professional judgment, you have to determine whether a risk is a significant risk. But while taking that judgment, what factors you will consider in deciding whether a risk is a significant risk or not? What factors you will consider? Like, is it a risk of fraud? If it is a risk of fraud, it will always be a significant risk. Whether the risk is related to significant economic, accounting, or other developments like changes in regulatory requirement, is the risk is related to changes in the accounting or regulatory framework? Complexity, it depends on the complexity of the transaction. Whether the risk involves significant transactions with related parties, if the risk is resulting from a transaction with a related party, that risk will be a significant risk. Degree of subjectivity involved. So if it is more subjective, more the chances of it becoming a significant risk. And also whether this risk is related to transactions outside the normal course of business. Is the risk related to unusual transactions? then also the risk will be considered as a significant risk. So these are all the various factors that the auditor should consider in identifying whether a risk is a significant risk. Next, similarly, if there are non-routine transactions, these three are some complex areas. Just I will try to quickly summarize this. If the risk is a significant non-routine transaction, see, if routine transaction is there, the risk is low. If it is a non-routine transaction, the risk is very high. So they are asking you some examples. Risk of material misstatement is greater for non-routine transactions. Can you give some examples? Yes. Number one, if there is greater management intervention for accounting treatment, if you have to decide on accounting treatment, leave it to your CFO, leave it to your finance team. If board of directors are involving more in an accounting treatment, that is a non-routine matter. That indicates a significant risk. Greater manual intervention, when you are already invested huge amount of money in technology, still you are using manual systems. Might be they want to override something in their technology. That's why they are using manual system. Risk of material misstatement is high. Complex calculations or accounting practices, very complex calculations they are using, there the risk could be higher. And nature of non-routine transactions, which may be difficult for the entity to implement effective controls, or that non-routine transaction is of such a nature that for which you can't implement internal controls. Next, risk of material misstatement is greater for significant judgment matters. Similarly, wherever more judgmental matters are there, there the risk will be higher. Sir, are there any examples? Yes. Accounting principles for accounting estimates or revenue recognition may be subject to different interpretation. So if you are following some accounting principles or if you are using some accounting estimates, that different people can interpret it in a different manner. There the risk will be higher because it is a significant judgment matter. Or required judgment may be subjective or complex or require assumption about the effects of future events, especially when accounting estimate, when you're deciding on a matter which is depending on future, like provisions for warranties and all, these are depending on the future events. These are very much subjective. Since they are very much subjective, risk will be very higher. Okay, so three things I have told here. The risk, whatever risk is there, from that you have to identify significant risk, how to identify the significant risk. And risk is higher for significant non-routine transactions. What are the examples for that? Risk of material misstatement is higher for significant judgmental matters. What are the examples for that? Next, we have one very small general question. What are the benefits of evaluation of internal control? If you evaluate internal controls, how you will get benefited? Very simple, straight away, common sense oriented points. You will get to know whether frauds and errors are likely to be located. If you get to know about internal controls, you will get to know whether there are any chances of frauds and errors. Whether internal control system is properly working effectively or not, that also you will get to know. Whether internal audit department is working effectively, that also you can analyze by understanding internal control. Whether any administrative control has a bearing on his work, that means is he required to be worried about any administrative control? Whether any administrative control is relevant for you or not, you can take a call. And whether entities' assets are protected, whether management is properly discharging their functions, and whether reports given to you are reliable, and also how much amount of examination you are required to do, nature, timing, and extent of your compliance and substantive audit procedures, and which will be an appropriate audit technique. And you can also find out the areas where the controls are weak, and also you can give valuable suggestions for your client. So these are all the benefits of understanding internal control. One more last aspect I will try to cover. After this, I will wind up this chapter, risk assessment, internal control, and thereafter I will continue directly with essay 330, one of the most misunderstood concept and one of the most complicated concept for many students. So once I explain this methods for evaluation of internal control, directly I will go to essay 330. So methods for evaluation of internal control. For the purpose of evaluation of internal control, there are four methods actually. Number one is narrative record. Number two, internal control questionnaire. Number three, checklist. And number four, we have finally flowchart. There are four methods for evaluation of internal control. How many methods? Four methods are there for evaluation of internal controls. What are they? List them once. Narrative record, internal control questionnaire, checklist, and flowchart. I will try to explain one by one. Sir, first I will try to explain you narrative record and flowchart. See, in the narrative record, what will happen is, first I will try to understand the entire internal control, and whatever understanding that I have obtained, that I will try to do a exhaustive description. What I will try to do, I will try to do a exhaustive description. First I will try to understand internal control, and whatever understanding of internal control that I have obtained, I will try to write it in a paragraphical, detailed, exhaustive description. I am going to do it. That is what I call it as narrative record. Whereas when it comes to flowchart, here also I will try to understand internal control, and whatever understanding that I have obtained, that I will try to do a pictorial representation, graphical representation I will try to do. That is what flowchart is. Now if you do a comparison between narrative record and flowchart, which one is more time consuming? Narrative record is very much more time consuming. Flowchart is most summarized and most briefest way of presenting internal control. You can present the entire internal control in the form of one single chart. But for narrative record, you have to write pages and pages. So that's why if I do the comparison between narrative record and flowchart, which one is most concise, which one is most briefest, flowchart, which one is more time consuming, narrative record. See, you tell me, for small organizations, will narrative record be suitable, or for large organizations, narrative record will be suitable? Narrative record will be suitable only for small organizations. We can't do it for large organizations, where we can easily spot errors, where we can easily spot deficiencies or weaknesses. In flowchart, we can easily spot the deficiencies or weaknesses than when compared with the narrative record. So this is what two methods, narrative record and flowchart. Then we have the two most widely used methods of evaluation of internal control. One is internal control questionnaire and the other one is checklist. So what is this internal control questionnaire and what is this checklist is? In both these, we will have a series of questions. In both this internal control questionnaire and checklist, we have a series of questions or series of instructions. In both the cases, these questions are related to elements of internal controls. In both these cases, the questions are related to elements of internal control. And the questions will be drafted in such a manner that answers will be yes, no, or not applicable. Yes, no, or not applicable. In both the cases, we'll draft the questions. Auditor only will draft the questions, and the questions will be drafted in such a manner that they're not descriptive questions. The questions will be drafted in such a manner that answers will be yes, no, or not applicable. Sir, if in both the cases we are going to have the questions, and if in both the cases the questions are drafted in such a manner that answer will be yes, no, or not applicable, then what is the difference between the two, sir? Now, how we are going to differentiate that is on the basis of who is going to answer. Who is going to answer? So in the case of checklist, as an auditor, I will prepare the questions and I will hand over these questions to my audit staff only. I will hand over these questions to my audit staff only, and my audit staff itself will go to the concerned area and they will get back to me with the answers. My audit team itself will fill the answers, or even I can call them as instructions which my audit team will follow. So if it is a checklist, I will prepare the questions. Questions will be drafted in such a manner, yes, no, or not applicable. And these questions I will hand it over to my audit staff. My audit team only will answer it, or even they can treat as instructions which they will be required to follow. Whereas in the case of internal control questionnaire, what I will do is I will prepare the questions. Questions will be drafted in the manner yes, no, or not applicable. And this questionnaire, I will give it to my client's management and I will ask my client's management or the client's staff to fill the answers and give it back to me. So what is going to change in internal control questionnaire and checklist? Who is going to answer that questions is going to change. If it is a checklist, my audit team itself will answer it. If it is a internal control questionnaire, I will give it to the management, client's management. Either client's management will answer it or the client's staff will answer it. That is the main point of difference. And in internal control questionnaire, they will tell you some additional points. Like in the case of internal control questionnaire, if you want, you can add one more reasons column. For negative remarks, you can add one more column called reasons column you can add. And also, in the case of internal control questionnaire, you try to draft the questions in such a manner that, to the extent possible, you try to draft the questions in such a manner that yes answer indicates a satisfactory response, no answer indicates a non-satisfactory response. Not a thumb rule actually, but to the extent possible, try to draft the questions where yes denotes a satisfactory response, no denotes a non-satisfactory response. So like that, there are some few differences between internal control questionnaire and checklist. Basically, both are questions drafted in yes, no, or not applicable format. In case of checklist, my audit team itself will answer it or follow it. If it is an internal control questionnaire, the client's management or client's staff will answer it. So those are the main differences here, my dear students. And the most important thing here, which I would like you to go through before you go for exam, is here we have an illustrative example of internal control questionnaire in different areas. As in the recent times, the questions are going to be more practical. Instead of asking you to write what is internal control questionnaire, they can give an area and they can ask you draft internal control questionnaire in this area. Like they might say draft an illustrative internal control questionnaire in the area of purchases. So generally, what kind of questions you will ask in the area of purchases? Or they might give an area in the area of creditors, draft an internal control questionnaire. What kind of questions you will ask? So like similarly, in the area of inventories, draft an example of internal control questionnaire. In the area of fixed assets, draft an example of internal control questionnaire. So like that, the high chances of asking the practical oriented questions is very high. So my humble request, before you go for examination, please have a quick look at this illustrative examples in the internal control questionnaire. I have added them in the material intentionally. So please do go through it before you go for the exam. Clear? So this is what the major discussion from internal control and risk assessment, my dear students. I hope you are able to get a basic understanding of these concepts. I know the terminology is very complex, but I'm telling you, if you understand these concepts, your subsequent discussion will be very, very smoother. There will be no roadblocks in your subsequent discussion. So understanding the concept is very important. Okay, if you are not putting an effort to remember the content of this risk assessment internal control, I'm okay with that. Even if you don't remember, even if you don't put an effort to remember also, I'm okay with that. But my humble request will be, you should at least go through this important concepts. Conceptual clarity you should have. That will help you answer the MCQs. That will help you understand the standards chapter in a much more better manner. Okay. So with this, I'm winding up with the risk assessment internal control chapter. Hey, my dear students, hope you guys are all doing good. Hope you guys are all perfectly fine. So I do wish and hope that you guys are preparing well for your upcoming exam. And so as a value addition for your exam, I wanted to bring one more important concept before you. So I have been receiving requests from many students saying that, sir, we are facing trouble in learning one particular standard, sir, which is SA 330. So please do a revision video, or please upload the video regarding SA 330. So that's why, considering the request of the students, I'm doing this video whereby I will try to bring before you the concept of SA 330 in a quick manner, in a crisp manner. So it will even act as a revision for you on the day before exam as well. So this is very important video. Please do refer to this video. Please do watch it. Don't miss this video. Compulsorily, please refer this video and then go for the examination. Why? Because this is one such a standard where students are facing a lot of difficulty. I will make it as simple as I could for you. So please do watch this video and then go for the examination. Will not take much of your time. I will try to summarize and make the concept clear in a very simple manner. Okay. So having said that, without wasting much of your time, let me go into the discussion now. So the standard which we are going to discuss now is SA 330. And as you could see, the title of the standard here, the title of the standard says the auditor's responses to assessed risk. So from the title, let us try to make out what does this standard speak about. So as you could see here, the main focus of this standard is going to be on how the auditor is supposed to respond. What should be the auditor's response? For what, sir? So how the auditor is supposed to respond, or what kind of response auditor has to initiate whenever he has assessed the risk. So whatever risk he has assessed, how an auditor is supposed to respond to that. That is what all the standard is about. See, as I always insist, my dear students, first we have to become clear about the objective of the standard. What is the purpose of the standard? Why that standard has been given? If you get to know that, then the standard will set it in a proper place. So that's why I always insist, try to understand what is the objective of the standard. So let me try to put it before you. Let me give you a context what the standard is actually talking about. So guys, if you remember, in our conceptual discussion, we have understood that as an auditor, your ultimate objective is to express your opinion. But to express that opinion, you need some audit evidence. And how are we going to get that evidence? Just because we are appointed as an auditor, evidence will not come and fall in our lap. We need to perform some procedures from our end. And whatever procedures we are performing to obtain that audit evidence, that procedures we are going to call them as audit procedures. And if you remember the discussion, whatever we had in SA 500, I say that I can broadly divide this audit procedures into two categories. I can broadly divide that audit procedures into two categories. Number one is risk assessment procedures, and number two is further audit procedures. I'm giving you context, my dear students. This concept, whatever I'm teaching you, you all know it, but to understand this SA 330 in a correct perspective, revisiting the fundamental things is very, very important. That's why I'm taking you back to the concept which you are all well aware of. So whatever audit procedures which auditor will perform to obtain audit evidence, that can be broadly divided into two categories. One is risk assessment procedures and the other one is further audit procedures. And these further audit procedures further contain two more categories. One is compliance procedures, which you also call it as test of controls, and the other one is substantive audit procedures. All this we know it, right? So now the first and foremost audit procedure, what is that we do? The first and foremost audit procedure is risk assessment procedure. So as a part of that risk assessment procedure, what is the actual thing we are going to do? We will try to obtain understanding. We will try to obtain an understanding. Sir, regarding what we will try to obtain an understanding? We will try to obtain an understanding regarding entity. We will try to obtain an understanding regarding the entity's environment. We will also try to obtain their understanding of internal controls. Three things we'll understand as a part of risk assessment procedure. We will try to, our main objective is to understand that too regarding these three things. We'll try to obtain an understanding regarding entity, environment, and its internal control. Sir, what is the purpose of understanding the entity environment and its internal control? The whole purpose is to identify and assess risk of material misstatement. Yes or no? So this is what the whole objective. So we go into the organization, we understand about the entity, what kind of business they are doing, what kind of environment they are operating, what kind of internal controls they are having. We will try to understand it. And the whole objective of getting that understanding is to identify and assess the risk of material misstatement. And how to identify the risk, how to analyze that risk, all that has already been covered under SA 315. That's what mainly will be covered as a part of your risk assessment and internal control chapter, right? So, till here, what you are supposed to do, how you are supposed to understand, what things you are required to understand, how you have to understand internal controls, and on the basis of that understanding, how you have to identify the risk, how you have to assess that risk, all that discussion we have already covered it in SA 315. So once you are done with risk assessment procedures, by obtaining understanding of entity environment and its internal control, you will identify and assess the risk of material misstatement. First of all, what is the risk of material misstatement? The possibility of happening of misstatement in the financial statements. So I look at the organization, I study the organization, and I will try to make an analysis. I will try to identify in which area there is a chance of happening of misstatement. Let us say, for example, when I try to understand about the entity, I came to know that in the area of inventory, wherever they are keeping the stock in their warehouses, there are no internal controls, there are no CCTV cameras, there are no security guards, there is no inventory records. So I found that there is a chance of happening, since there are no internal controls, there is a chance of happening of misstatement, there is a possibility of happening of theft in the area of inventory. So that possibility, I did not find out misstatement. You have to be very clear here. I did not find out misstatement by understanding entity, environment, and its internal control. What I have found out, I just found out the possibility. There is a chance of happening of misstatement. That possibility, I call it as risk of material misstatement. So by following all the guidance which has been given under SA 315, you will identify, you will assess that risk of material misstatement. Now, once you have identified that risk of material misstatement, now you have to respond to that risk. Now you have to respond to that risk. So once you have identified, okay, in the area of inventory, there is a chance of happening misstatement. In the area of cash, there is a possibility of misappropriation, and or there might be a risk. And even if you remember the discussion, we will identify that risk of material misstatement into two levels. We can bifurcate whatever risk we have identified into two levels. One is risk of material misstatement at the financial statement level, and the other one is risk of material misstatement at the assertion level. See, these are all something which you will learn it as a part of SA 315. To give you the context, I'm revising all this discussion once again. So financial statement level risk refers to that risk which is having a potential to cause a misstatement in the entire financial statements. On the other hand, if you find a possibility of happening of misstatement at specific assertion or a specific item of financial statement, that I call it as risk of material misstatement at the assertion level. I will give you a few examples. Let us say, for example, you understood the entity, you understood the environment, you understood the internal controls, and you got to know that the management of this organization are not having integrity. The management are dishonest. So when you came to know that the management of this organization is dishonest, don't you think there is a possibility of happening of misstatement because of this? Yes. So when management is dishonest, there is definitely a risk of material misstatement. But you tell me, is this risk having the potential to cause a misstatement in only one or two items or one or two assertions, or will it have a potential to cause a misstatement in the entire financial statements? Since management itself is dishonest, this risk is having the potential to cause a misstatement in the entire financial statements. That risk, I call it as financial statement level risk, because it is having a potential to affect the entire financial statements. On the other hand, let us say, for example, the company is having weak policy regarding recovery from collection from debtors. They have debtors, but whenever they are making the collections from the debtors, they are following some system of internal control. That internal controls in the debtors collection is not working effectively. So because of that, there is a chance of happening misstatement. This also, I will say, there is a risk of happening of misstatement in the debtors. But this risk is having a potential to cause a misstatement only in the existence assertion. Might be some debtors amount has been collected, but it was not adjusted in the books. So might be that debtor is not really existing, still it might be showing in the books of accounts. So this is also a risk, but it is having a potential to cause misstatement in the existence assertion of the debtors. So this risk, I call it as risk of material misstatement at the assertion level. So whatever it is, see, I have not yet gone to SA 330. Till now, whatever I am teaching you, I am making you recollect the things, whatever you have already learned in SA 315. I have not yet gone to SA 330. Listen carefully. So by following all the guidance given under SA 315, you will try to identify the risk, what kind of risk is there. And after that, you will try to analyze the risk. You will bifurcate that risk into what kind of risk is a risk of, which risks are risk of material misstatement at the financial statement level risk, and which risks are assertion level risk. So whatever it is, initial 2-3 days of time when you go for the audit, you study the organization, find out all that risk, you analyze all that risk. Now, once you have analyzed, once you have identified, once you have assessed that risk of material misstatement in the organization, you have to respond to that. You have to respond to that. If you take this example, you came to know that management is dishonest. You got to know that there is a risk of material misstatement. There is a risk of material misstatement at the financial statement level. Okay, you got to know, you have assessed that there is a risk of material misstatement, that management is dishonest. Now, once you got to know about it, you have to respond to it or not. You have to respond to it or not. Sir, how you will try to respond? You will try to respond by way of performing your further audit procedures. So you will try to perform, you will try to decide your nature, timing, and extent of further audit procedures. Sorry. So you will try to decide your nature, timing, and extent of further audit procedures on the basis of the risk, whatever you have identified. That is what simply I meant by responses. Okay, so if I relate this with this example, so as I have told, if you got to know that the management of your client company is dishonest, yes, you got to know that there is a risk of material misstatement, and this risk of material misstatement is at the financial statement level. Now you have to respond to that. How you will respond? How I can respond is here. What I will do is I will try to make sure that my team is always very senior management, senior staff. I will keep into my team. In my audit engagement team, I will not keep newly joined article assistants, these kind of people. I will try to keep senior staff in my audit team, and I will try to do more surprise checks. I will try to do more surprise checks. This is how I have to respond. Or I have to maintain more professional skepticism. I have to maintain more professional skepticism. And also, I have to concentrate on getting more evidences. I should not get satisfied with low evidences. I have to concentrate on getting more evidences. So this is how you will respond if you've got to know that there is a risk of material misstatement at the financial statement level. Similarly, if you got to know that there is a risk of material misstatement at the assertion level, for that also you have to respond. Sir, how I will respond to that? So when you found out risk of material misstatement at the assertion level, here also you will try to respond it by way of performing more in-depth nature, timing, and extent of substantive audit procedures. Like I found that there is a risk that there is a risk that debtors might have been not existing. So in order to respond to that, what I will do, I will try to get external confirmations. I will try to get external confirmation. I will try to do reconciliations. I will try to do the reconciliation with the bank statements. So what is the amount which is recorded in the debtors ledger? And I will try to cross verify with the sales ledger. And I will also try to cross verify with the bank statement. So I will do reconciliation. Nothing bad. So like this, I will try to spend more time while performing substantive audit procedures in the area of the trade receivables. So by deciding to perform more nature, timing, and extent of audit procedures, or by taking these precautionary measures like taking only senior staff, doing surprise checks, maintaining more professional skepticism, all this is nothing but responses. This is how you are responding. This is how you are responding to what you are responding to, whatever risk you have identified, to whatever risk you have assessed, to that risk you are responding by way of planning your nature, timing, and extent of further audit procedures, and what factors you will consider while responding to that assessed risk of material misstatement. That discussion has been provided under SA 330. That discussion has been provided under SA 330. So now we have actually come to the SA 330. But to understand what exactly where this SA 330 is going to fit in the entire system of the audit, you need to have this linkage. When you get this linkage in a proper manner, now whatever we are going to learn in the standard, that will fall in place. That will sit in its place. Clear, everyone? So since you got the context now with this background discussion, we will try to read and learn the standard. With that, you can get the better understanding. Clear, everyone? So when this standard will actually become applicable, once you have followed SA 315, once you have performed risk assessment procedures, once you have identified the risk, then how you are supposed to respond. So we will basically respond through by way of further audit procedures. So how you are supposed to respond, what and all factors you have to consider, what kind of compliance procedures you have to perform, what kind of substantive audit procedures you have to perform, that all guidance has been given in the standard. So having said this background discussion, now I will go and take you through the contents of the standard. Okay, shall we do it, everyone? Let us do it without any delay further. So now going into the standard now. So if you see here, first one, what is the objective of the auditor? As we all know, every standard will impose some objectives. Every standard will have some objectives. Every standard will give some objectives to the auditor, which auditor is supposed to fulfill. So what are the objectives of auditor as per this SA 330? Let us see what they are trying to say. So the objective of the auditor is to obtain sufficient and appropriate audit evidence regarding what? About whatever risk that you have assessed. So you perform risk assessment procedures. By performing that risk assessment procedures, you have identified and assessed the risk of material misstatement. No. So depending on that, you are required to obtain sufficient and appropriate audit evidence. Sir, but how can I try to obtain that sufficient and appropriate audit evidence, sir? Here comes the answer. Through designing and implementing appropriate responses to that risk. So whatever risk you have identified, you have to design and implement some responses. Sir, how that responses will be implemented, sir? What are those responses they are talking about, sir? Simply by way of performance of further audit procedures. So you have to design and implement appropriate responses to those risks. So by designing and implementing those responses, you will try to obtain, you have to obtain sufficient and appropriate audit evidence. And even SA 330 specifically states that the auditor shall design and implement overall responses to assess the risk of material misstatement at the financial statement level. That's what even I have also told you. So in case if you have found out risk of material misstatement at the financial statement level, to that also you have to respond. Sir, how I have to respond, sir? As I have told, deploy more senior engagement team members, try to perform more surprise checks, try to maintain more professional skepticism, concentrate on more evidences. So like that, whatever risk of material misstatement that you have identified at the financial statement level, for that also you have to respond. And even SA 330 further states that the auditor shall also design and perform further audit procedures whose nature, timing, and extent are based on and are responsive to assessed risk of material misstatement at the assertion level. That's what even I have clarified it here. So when you have identified risk of material misstatement at the assertion level, depending upon that risk, you have to plan your nature, timing, and extent of audit procedures, but particularly further audit procedures. So, like for example, if you found that in one particular area risk of material misstatement is very high, there you will try to perform more nature, more timing, and more extent of audit procedures. Wherever you find the risk as low, there you will try to perform less timing and extent of the audit procedures. So, whatever risk of material misstatement that you have identified at the assertion level, depending on that, you have to plan your nature, timing, and extent of your further audit procedures. What further audit procedures? So this is what SA 330 specifically says. So once again, if I have to repeat it, so SA 330 states that you have to design your appropriate responses for risk of material misstatement at both the levels. So whatever risk of material misstatement that you have identified at the financial statement level, for that you have to respond appropriately. And whatever risk of material misstatement that you have identified at the assertion level, to that also you have to respond it by way of designing your nature, timing, and extent of further audit procedures. Next, few more things I try to say here. So when you are designing that further audit procedures to be performed, like as I've told, what compliance procedures you will perform. So one more important thing which you have to remember here, when I say further audit procedures, as I've already told you, further audit procedures will contain compliance procedures also. Further audit procedures will contain substantive audit procedures also. So if I have to give a quick recap once again, in the compliance procedures, we will try to verify whether internal controls are working effectively or not. We'll try to verify whether internal controls are working effectively or not. Whereas in the case of substantive audit procedures, what we will try to do is we will try to actually verify account balances, class of transactions, and disclosures. Nothing but we actually do the verification of financial information like OCHing verification. So all that actual verification of the books of accounts and financial information will happen in the substantive audit procedures. So these are some basic things. See, the problem with this SA 330 is SA 330 is very comprehensive. It will take into its perspective so many aspects of the audit. Like it will take into its perspective, it will talk about risk of material misstatement, it will talk about compliance procedures, it will talk about substantive audit procedures, it will talk about audit evidence. So it is a very broader standard. So in order to understand this SA 330, you need to have good understanding of rest of the concepts. That's why the students will face a difficulty in this particular standard. Okay. So once again, since I have given you a few basics, once again, if you come back to the standard, so whenever you are designing your further audit procedures, like if you have to take your decision, what kind of compliance procedures you have to perform, what kind of substantive audit procedures you have to perform, you will take that decision. So when you are designing those further audit procedures to be performed, you shall consider certain factors. You should keep certain things in mind. Sir, what are they? So you have to consider reasons for the assessment given to risk of material misstatement at the assertion level for each class of transaction, account balance and disclosure. Nothing but whenever you are planning your further audit procedures, you have to consider because of what reason you have identified, you have found out that there is a risk of material misstatement. Or if I put it in very simple terms, because of what reasons or what reasons made you think that there is a risk of material misstatement in this area. Like let us say, for example, on the basis of my risk assessment procedures, if I'm concluding that in the area of inventory, there is a risk of material misstatement. Now, because of what reasons I arrived at that conclusion, might be in the area of inventory, there are no proper internal controls. Or let us say, for example, I felt that by performing risk assessment procedures in the area of cash, there is a high risk of material misstatement. On what basis you have decided it? What reasons made you conclude it? Because cash is very liquid asset, so it is highly susceptible to misappropriation. So there is an inherent risk involved in it. So like that, you should keep in mind while you're designing your nature, timing and extent of your further audit procedures, you have to keep in mind because of what reasons you have considered while assessing that risk of material misstatement. Like if you read it below, so consider the reasons for the assessment given to risk of material misstatement at the assertion level for each class of transaction, account balance and disclosure, including, sir, what kind of reasons? Likelihood of material misstatement due to a particular characteristic of relevant class of transaction, account balance or disclosure. See, like inherent risk. Sometimes you might feel certain areas risky because of its characteristics. Like as I've told, cash. Cash is a highly liquid asset. It is highly prone to misappropriation. So inherent nature, it is an inherent nature of the cash that the risk of material misstatement is very high in the area of cash. So that could be one of the reason. Or whether the risk assessment takes into account relevant controls, that is the control risk. So nothing but what they are trying to say here is simply, if I have to put it in layman terms, on what basis you have decided that there is a risk of material misstatement. Is it because of inherent risk or is it because of control risk? Sir, what is control risk? Might be in an area, let us say for example, in the area of inventory, if I'm concluding that there is a risk of material misstatement, what could be the reason for that? Might be internal controls in the area of this inventory are not working effectively. That's why I might have considered that risk as very high. So this I call it as control risk. This discussion, once again, which is something which you will have it as a part of your essay 315. Like if I take you back to the discussion, risk of material misstatement is made up of two components. One is inherent risk and the other one is control risk. That itself they are trying to put it here. Clear? So when you are designing your further audit procedures, you have to also consider because of what reasons you have concluded that there is a risk of material misstatement at the assertion level. It could be because of likelihood of that item, like inherent risk, cash is the best example, or it could be because of the controls, that controls might not be working effectively. So that's what they say here, whether the risk assessment takes into account the relevant controls, thereby requiring the auditor to obtain audit evidence to determine whether controls are operating effectively or not. So they try to say something in the brackets. That point will get clarified in the B point. You ignore the information, whatever has been given in the brackets here. So that I will automatically cover it as a part of B. And one more thing they say here, obtain more persuasive evidence, the higher the auditor's assessment of risk. Very important for the MCQs, my dear students. Here the examiner can play with you. So wherever you have assessed that there is a high risk of material misstatement, there you require more persuasive evidence, more convincing evidence you want. Quite common sense, no? If you assess that risk is very, very high, you try to verify more and more, you try to obtain in-depth evidences, you try to get more convincing evidences. On the other hand, if you assessed the risk as low, if you expect that the risk of happening of misstatement is very low, there will try to get convinced with even small amount of evidences also. We don't go for that much amount of persuasive evidence. So persuasive means convincing evidence. Clear, everyone? So if I have to draft a summary for this, since the standard is complicated, I'm drafting the summary. Okay, sir, what you have told in the objective paragraph. In the objective paragraph, I told that the standard is expecting you to obtain sufficient and appropriate audit evidence by designing and implementing responses to your assessed risk. And also this standard states that you have to respond to two things. You have to respond to risk of material misstatement at the financial statement level you should also respond to risk of material misstatement at the assertion level. So particularly at the assertion level, you have to respond it by way of performing nature, timing, and extent of your further audit procedures. Now they say that when you are designing your further audit procedures, you should consider the reasons for assessment. You should consider the reasons for assessment of risk of material misstatement. That could be because of the characteristics of certain item, which we call it as inherent risk, or that could be because of non-operating effectiveness of the controls. Or and also you should also keep one thing in mind. If you have assessed the risk of material misstatement as high, you try to get more persuasive audit evidence, more convincing audit evidence you want wherever you find the risk of material misstatement to be very, very high. Okay, so this is what regarding the objective paragraph. Now let us come to the next part, B part. So this is something which is very confusing, very conceptual. I will try to make it as simple as I could for you, but please follow the discussion whatever I'm trying to say here. The auditor shall design and perform test of controls to obtain sufficient and appropriate audit evidence as to the operating effectiveness of relevant controls when. So understanding the context of this discussion is very, very important. Listen carefully. See, as a part of risk, very important, my dear students, quite confusing also. I will try to make it very simple with the help of example. Listen carefully. See, as a part of risk assessment procedures, what we will do, we'll try to understand. What we will try to understand? We'll try to understand entity. We will try to understand environment. We will try to understand internal controls. Now, once you understood it, then we need to perform further audit procedures. We all know it. And we all know that further audit procedures will include compliance procedures, will also include substantive audit procedures. See, by performing compliance procedures, we will not get all the evidence required for expression of opinion. By performing compliance procedures, we will only get to know whether internal controls are effective or not. That's the only information we can get. So on the basis of whatever information we have got by performing compliance procedures, then we will ultimately do verification of books of accounts, verification of financial statements, supporting documents and all, and finally conclude whether financial statement contain a misstatement or not. So actual verification of the books of accounts, actual finding of the misstatements is going to happen when? It is going to happen only by performing substantive audit procedures. Yes or no? Whereas when we perform compliance procedures, we are only obtaining audit evidence regarding whether internal controls are effective or not. So even though we are performing internal controls, but ultimate evidence, whatever we require for the purpose of expression of opinion, that evidence we are going to get it only by performing substantive audit procedures. Did you understand my statement? So statement what I'm saying is, even though you perform compliance procedures, by performing compliance procedures, you will get to know only whether internal controls are working effectively or not. But ultimate evidence which is required for expression of opinion, that you will get it only by performing substantive audit procedures. Sir, when actually I will spend my time to verify whether controls are working effectively or not? Since I'm getting all the evidence required for expression of opinion only by performing substantive audit procedures, I can skip the compliance procedures also. But still, if I am trying to do compliance procedures, there should be some purpose, no? When you are getting all the evidence required for expression of opinion only by performing substantive audit procedures, but still, if you are still trying to spend some time on verifying the operating effectiveness of internal controls, when you will take that extra effort, sir? When you will take that extra effort? See, first I will try to explain you the opposite scenario. I will tell you when we can skip altogether compliance procedures and directly perform only substantive audit procedures. So if we could understand what are those circumstances where we can skip the compliance procedures and perform directly substantive audit procedures, if we know that circumstances, opposite of that circumstances will be those circumstances where we will try to spend our time on performing compliance procedures. Able to understand what I'm trying to say? So if I tell you what are those circumstances where altogether we can skip the compliance procedures and perform only substantive audit procedures, if we could know that circumstances, if I exactly write the opposite of that circumstances, then we will get to know when we have to perform compliance procedures, then only we have to perform substantive audit procedures. Okay. So when I explain the provisions, then you will get the better clarity. So first, let me tell you what are those circumstances where I can skip altogether my compliance procedures and perform only substantive audit procedures. Point number one, let me tell you. See, as a part of risk assessment procedure, what you are doing, you are understanding, no? as a part of risk assessment procedures, you will not test the operating effectiveness. But what you will do as a part of risk assessment procedures is you will try to understand the internal control, what kind of controls they have, what is the structure of the internal controls. See, when you are understanding the internal controls, at that point of time only, you decided that these internal controls are completely waste. And you have decided that no, I don't want to rely on controls. At the understanding phase only, as a part of your risk assessment procedures, at the understanding phase only, you have decided that these controls are completely bullshit. I don't want to rely on internal controls. When you don't have an intention to rely on controls only, then will you still spend the time on performing compliance procedures? No. Then what I can do? I can skip altogether compliance procedures and directly perform substantive audit procedures. Okay. So I told you one circumstance where you can skip, where you will not spend the time on performing compliance procedures. What is that? So as I've told, when you are understanding the entity, you have an expectation. That means as a part of your risk assessment procedures itself, you have an expectation that these controls will not work effectively. And you have decided that you will not rely on the controls. When you don't want to rely on the controls only, why unnecessarily perform compliance procedures? There you can skip the compliance procedures and directly perform substantive audit procedures. Second case where we can skip the compliance procedures is if you are so confident that you can obtain all the evidence only from substantive audit procedures, then also you can skip altogether compliance procedures. If you are coming across some circumstances where you are very confident that I can obtain all the evidence only from verifying books of accounts and financial statements, then once again, you can skip the compliance procedures and you can perform only substantive audit procedures. I will tell you when this will happen. Let us say, for example, you are conducting an audit of one small company. Throughout the year, they have done only some 10 sales, some 5 purchases. Some throughout the year, in their books of accounts, I'm able to find only some 25 entries. Dormant company, almost inactive company. See, if you are doing audit of that company, which is containing hardly 25 entries for the entire financial year, there also you can't say, I will verify internal controls and all. So in those cases, what will happen? There you can verify all the 25 entries, 100% verification you can do. You can get all the evidence, you can express the opinion. So in that particular example, it is such an engagement where I'm so confident that I can get all the evidence required only from substantive audit procedures. Then also you can skip compliance procedures. As simple as that. So two circumstances I have told where when you will not perform the compliance procedures, when you will not perform, when you have an expectation that controls will not work, and when you don't want to rely on internal controls, then you can skip the compliance procedures. On the other hand, if you are so confident that substantive audit procedures alone will give you all the evidence required, this will especially happen in the case of small entities, very limited number of transactions, then also you need not waste your time and energy on internal control verification and all. Directly you can perform substantive audit procedures. Clear? See, but that is not what we are learning. What is our intention? Our intention is to learn when we will perform compliance procedures. I told you two circumstances when we will not perform compliance procedures. But the concept here is when you will perform the compliance procedures to verify the effectiveness of internal controls. Now, if you write the exact opposite of the two circumstances, whatever I have told, we have answered it. So what is the first circumstance when we will spend our time to perform internal control verification? Number one, when we performed risk assessment procedures, when we understood internal controls, we have an expectation that these controls will work effectively and we wanted to rely on internal controls. Opposite scenario is when we will not perform compliance procedures. No. So if I put it in other way around, so when you performed risk assessment procedures and you are under a belief that on the basis of your understanding of the internal controls only, you have an expectation that yes, this client is having good internal controls and you have an expectation that these controls will work effectively and you have decided to rely on that internal controls. So if you want to rely on the internal controls, if you have expectation that those controls will work effectively, then we will perform compliance procedures. Point number 2. If you are conducting some audit where you believe that substantive audit procedures alone will not give you all the audit evidence required. When you are conducting audit of such an engagement where you believe that doing substantive audit procedures alone will not give me all the audit evidence, then also you perform compliance procedures. I have to give you one example. Let us say you're conducting audit of big entity. So it is a very decent company. Throughout the year, so many transactions they have done. When I verified their financial information, when I verified their books of accounts, total 10,000 entries are there. You tell me, will it be possible for me to do 100% verification, verify each and every entry and rely only on substantive procedures? No. So why? Because I have a time constraint there. On the other hand, what I can do is on these 10,000 transactions, whatever internal controls are verifying, I can get some confidence on the basis of that effectiveness of controls. I can do sampling, then I can get the complete evidence. So if you believe that substantive audit procedures alone will not give you all the audit evidence required, then also we will perform compliance procedures to know whether controls are working effectively or not, so that we can decide our nature, timing, and extent of the substantive audit procedures. Clear? So these are the two circumstances when auditor will perform compliance procedures to determine whether controls are working effectively or not. Okay. So I know, even though I have explained only 2 points, but to make you understand this point, so much of discussion, so much of conceptual clarity, I have to offer it here. But with the help of these examples, I hope you are all clear about the discussion. Okay. So with this background, if I take you through this, so if you see here, once again, if I read the heading, the auditor shall design and perform test of controls or compliance procedures to obtain sufficient and appropriate audit evidence regarding the operating effectiveness of controls only in the following circumstances. So when auditor will spend his time in performing compliance procedures to determine operating effectiveness of controls. Number one, the auditor's assessment of risk of material misstatement at the assertion level. So that means when you are assessing the risk of material misstatement, when you will assess that risk of material misstatement, when you are performing risk assessment procedures. So simply what they say here is when you are assessing risk of material misstatement, that means when you are performing risk assessment procedures, that includes an expectation that the controls are operating effectively. That means when you are trying to understand, when you are trying to assess the risk of material misstatement as a part of risk assessment procedures, when you are understanding the internal control, from the understanding you have a expectation that the controls will work effectively. Or if I put it in other way around, auditor intends to rely on operating effectiveness of internal controls in determining nature, timing, and extent of substantive audit procedures. Then only you will perform compliance procedures. If you don't want to rely on the controls, you will not perform compliance procedures. You will proceed directly ahead with the substantive audit procedures. Next, one more case where you will try to perform when you will perform compliance procedures is when you believe that substantive procedures alone will not give you sufficient and appropriate audit evidence at the assertion level. So as I've told, in case of big organizations, substantive audit procedures alone will not give you audit evidence. That's why we become helpless and we will perform compliance procedures. So that's all, my dear students. These are two are the cases when the auditor will perform compliance procedures. The remaining 2 points are some conclusions. Let us see what they try to say here. These 2 points are actually answering the issue. Remaining 2 points are some extra points, extra statements they are trying to put it here. Like if you see, in designing and performing the test of controls, the auditor shall obtain more persuasive audit evidence the greater the reliance auditors places on effectiveness of internal control. If I put it in very simple terms, if the auditor wants to place more reliance, if the auditor wants to rely more on effectiveness of internal control, he needs to get more convincing evidence. Definitely, if you want to rely more on internal controls, verify more. If you don't want to rely on controls, verify less. Get less convincing evidence. Or if I put it in other way around, if you want to rely more on controls, try to get more convincing audit evidence. If you want to rely less on internal controls, try to get less convincing evidence. No one is bothering about it. So that's what they say. In designing and performing test of controls, the auditor shall obtain more persuasive audit evidence the greater the reliance auditor places on the effectiveness of a control. Now the examiner can play with you this also in the form of MCQs. Okay, these statements are very important. D point is nothing but other way of stating the C point only. A higher level of assurance may be sought. That means you will try to get higher level of assurance about operating effectiveness of internal controls when the approach adopted consists primarily of test of controls, in particular where it is not possible or practicable to obtain sufficient and appropriate audit evidence only from substantive audit procedures. So nothing but this is other way of stating point number B. What did I say in point number B? When you believe that substantive audit procedures alone cannot provide audit evidence, then you perform compliance procedures. No, the same thing they are trying to put it in a complex sentence. What they're trying to say, you will try to get higher level of assurance regarding effectiveness of internal controls when it is either not possible or it is not practicable to obtain all the evidence only from substantive audit procedures. That's what even point B also says. So when it is not possible for you, when it is not practicable for you to obtain all the evidence only from substantive audit procedures, then you will try to get even higher level of assurance from compliance procedures also. Understood? So this is what regarding when auditor will perform compliance procedures to obtain evidence regarding operating effectiveness of controls. Clear? So the paragraph, as you could see here, very small paragraph, hardly 4 simple lines they have given. But understanding this 4 simple lines is not that easy unless you have a good conceptual clarity. See how much effort I have taken to make you understand 4 simple lines. Many people will just read out and ignore it. I told you even the background behind it, what is the logic behind these points. This is where the conceptual clarity helps you, my dear students. This is what will save you while answering the MCQs. Okay, I hope you have realized that benefit. Now coming to the next part. Now going forward, the discussion is going to run very smoothly. Rest of the standard will try to complete it. So nature and extent of test of controls. See, in the first point, we have told what auditor is supposed to do. So standard told you have to respond it. Now point number B, we have told when auditor will perform test of controls. Point number B is saying when you will try to spend your time on performing test of controls. So now depending on this, you will decide whether you will perform test of controls or not. In case if you have decided to perform test of controls, what nature of internal controls you will perform, what extent of internal control verification you will do, that depends on what factors. Second point will tell you to decide on what basis you will decide whether to perform test of controls or not. In case if you have decided, yes, I will try to obtain evidence regarding operating effectiveness of internal controls. You have decided, okay, I will verify internal controls. Now, what nature of test of controls you have to do? How much test of controls you have to do? That depends on what factors. So let us see what they are saying. So in designing and performing test of controls, what auditor shall do? So if you want to perform test of controls, when you are verifying internal controls or when you want to know whether controls are working effectively or not, what you should do? In the first point, they say that inquiry alone will not be sufficient. You can't rely only on inquiry for performing test of controls. I told you even this point in SA 500 also, we have 7 different methods. If you remember, inquiry, inspection, observation, external confirmation, recalculation, reperformance, and analytical procedures. Out of all that 7 methods, inquiry will give you least persuasive evidence, least convincing evidence. The same point they will remind you here. When you have decided to perform test of controls, when you want to know operating effectiveness of internal controls, any of the 7 methods you can use. But always be careful that you don't rely only on inquiry. Inquiry should be used in combination with other procedures like inquiry and inspection, inquiry and observation, inquiry and reperformance. So whatever it is, don't use inquiry alone. Always use inquiry in combination with other audit procedures. So that's what they say. Perform other audit procedures in combination with inquiry to obtain audit evidence about operating effectiveness of the controls. Sir, what matters I have to obtain evidence regarding internal controls, sir? Number 1, how the controls were applied at relevant times during the period under audit. So for whatever period you are doing the audit, how the controls are getting applied. Let us take one simple example. Management has put an internal control that they will prepare a BRS. Monthly BRS they have to prepare. Now you have to perform audit procedures to understand who is preparing that BRS, who is approving that BRS, what is the process they are following for that BRS, and whether it is getting prepared monthly or not. So like that, how the controls were getting applied, that you have to obtain evidence. Not just that, consistency with which they are applied. If the management has set a policy that bank reconciliation statement has to be prepared every month, now we need to check for all the 12 months of the year has BRS been prepared, or for any month is it missing. Consistency, you have to obtain evidence. Then by whom or by what means they were applied, who is applying that internal control. Let us say for example, this BRS responsibility has been given on the main cashier. So is the main cashier is only doing it, or he assigned that work to someone else? So like that, by using inquiry in combination with other audit procedures, I need to obtain evidence regarding operating effectiveness of internal controls, and particularly what I will try to obtain evidence is how the controls were getting applied, whether they are getting applied consistently or not, who is applying it, and determine whether the controls to be tested depend upon other controls. Sometimes you want to verify internal control, but that internal control itself will depend on some other control. Let us say, for example, the client has designed one software. The client is having an internal control where salary will be computed automatically. Salary of each employee every month, depending on the attendance record, depending on paid leaves and unpaid leaves, after taking all the calculation, the software itself will automatically calculate the salary. So this is the control. The client has automated this entire salary calculation. Now, whether this software is working effectively or not, that depends on overall IT controls. See, this software, whoever is, this software should be given access only to the finance heads. General employees should not be given access. the server wherever this employee's attendance data is stored, that should be access restricted. That means access controls should be there. So if the server is not protected, if the data is not protected, if the user access is not protected, ultimately there is no purpose in this control itself. So here this automatic salary calculation, whether this control is working effectively or not, it will depend on whether overall general IT controls are working effectively or not. Like whether systems are protected or not, access is restricted or not, only a person with username and password should have access to the system. So if you expect that salary calculation software to work effectively, that is going to depend on whether that information technology, whether that software is getting protected or not. So that's why if you are particularly verifying some internal control, and if you decide that effectiveness of that control is depending on other controls, even you should try to obtain evidence whether these other controls are also working effectively or not. So if I am checking whether this automatic salary calculation internal control is working effectively or not, since it is depending on overall IT controls, I need to even obtain audit evidence regarding this IT controls also. Because when they are effective, then only this salary calculation internal control will be effective. So that's what they try to put it here. So if you see it here, determine whether controls to be tested are going to depend on other controls, which we generally call it as indirect controls. If so, whether it is necessary to obtain audit evidence supporting the effective operation of those indirect controls also. So in case the control which you are testing is depending on other controls, then it becomes necessary for you to obtain evidence regarding that other controls operating effectiveness also. Clear? So that is what they try to say it here. Once again, if I tell you in the first point what they are telling, how you have to design and perform test of controls. Number one, use inquiry in combination with other audit procedures. Try to obtain evidence regarding these aspects. And if you determine that the control which you are verifying is going to depend on other controls, you should obtain evidence regarding operating effectiveness of that other controls also. See, conceptually very simple here, but the sentence formation, lack of proper approach only will make the things complicated. Clear? So I'm telling you, once you listen to this class, never ever you will feel SA 330 as difficult. That I can assure you from my side. Next, matters which may be considered in determining extent of test of controls. Extent of test of control means, will you perform more compliance procedures? That is, will you perform more test of controls or will you perform less test of controls? That depends on what factors. Straight away point. So what are the factors which auditor will consider, or what are the matters which auditor will consider in determining extent of test of controls? That means, will you perform more test of controls? Will you perform less test of controls? That depends on what matters, what information auditor will consider. Very simple straight away points they will try to say here. Like number one, frequency of the performance of the control. See, if some internal control is getting performed very frequently, let us say for example, salary calculation. So or let me put it this way, approval. Every cash payment should be approved. So that means this internal control will work on a daily basis. They have designed a software in such a manner that before any cash payment can be made, it needs an approval of some finance head. So every day some cash payment will happen. For all that cash payments, approval is required. So the frequency of this internal control is more. You have to verify more of this internal control. On the other hand, let us say for example, management is doing one internal control of inventory verification. They will do inventory verification. But inventory verification will happen only once in a year, close to the balance sheet date. So there is an internal control, but the frequency of that internal control is very less. Only once in a year that control will be executed. For this, we will try to perform less. We'll try to spend less amount of time there. So first factor which auditor will consider in determining extent of test of control is frequency with which the control is getting performed. Higher the frequency, more verification. Lower the frequency, less verification. And length of time during the audit period that the auditor is relying on the operating effectiveness of internal control. Let us say for example, if the auditor is conducting the financial year audit of 24-25, for the entire financial year, there is some internal control in the area of sales. So he wants to verify for throughout the year. He wants to rely on that throughout the year, whatever sales data is there for all that year, he wants to verify, he wants to rely on internal control. So then he will try to verify more. On the other hand, let us say for example, he wants to rely on internal control only on March month sales. Only for 1 month sales, he wants to rely on internal controls. There he will try to perform less test of controls. So second factor which will decide the extent of test of controls is length of time during the audit period on which auditor is relying on internal controls. Longer the duration auditor is relying on the internal control, more test of controls you have to perform. Lesser the duration auditor is relying on internal controls, lower the extent of test of controls. Next, expected rate of deviation. If you are expecting more deviations in the internal control, by looking at the control itself, you are feeling that, okay, here there are more chances of deviation. If you are expecting more chances of deviation, you have to verify more. When the risk is higher, you have to verify more or not. Same logic here. So when the expected rate of deviation is higher, when you are expecting more, there is a chance of happening more deviations in this control, more verification you have to do, more extent of test of controls. On the other hand, if you expect the deviation to be low, the controls is all looking perfectly fine, the chances of deviation are very, very less, then you need not unnecessarily spend most of your time there. You can reduce your timing of test of controls. Next, relevance and reliability of audit evidence. So it also depends on relevance and reliability. If you are getting, if you are such a person who is looking for more relevant and more reliable audit evidence, if you want to obtain regarding effectiveness of internal controls, more extent of procedures you have to perform. On the other hand, even if you are going to get satisfied with lesser relevance and lesser reliability, then you will try to perform less extent of test of controls. Not just that, the extent to which audit evidence is obtained from tests of other controls related to the assertion. So what is the meaning of this is, for example, let us say for one area, in the area of sales itself, there could be multiple controls. All these controls collectively put together make sure that controls are fine. Now, in this one area, let us say, for example, there is an internal control 1. Like that, internal control 2 is also there. Internal control 3 is also there. Internal control 4 is also there. Now, even though if internal control 1 is not working effectively, but still it is getting compensated by internal control 2, 3 and 4, then you don't need to spend more amount of time on testing that internal control 1. Why? Because there is a compensatory control. Even though this control is not working effectively, there is a compensatory control. There are other controls are there which will take care of it. So for those kind of controls, you can do less extent of verification. So that's what they say here. The extent to which audit evidence is obtained from test of other controls. Clear? So 5 matters you have to consider. Very, very important, my dear students. These things you have to remember. So what are the 5 matters which you are required to consider to determine the extent of test of controls? Number 1, frequency of the performance of the control. Number 2, length of the time during the audit period on which auditor is relying on the internal control. What is the expected rate of deviation? Relevance and reliability which auditor is trying to obtain, and extent of reliance on, extent to which audit evidence can be obtained from other controls. Next, timing of test of controls. Sir, at what time we have to perform the test of controls? So here, more or less, they try to repeat the things whatever they have told in the previous point, more or less related to extent only they will try to say. So let me read it, you will get the clarity. The auditor shall test controls for particular time or even throughout the period for which auditor intends to rely on these controls in order to provide an appropriate basis for the auditor's intended reliance. So what is the meaning of this is, let us say, for example, same logic, whatever I have told you in extent of controls. You want to rely on internal controls throughout the period. For entire 12 months of sales data, you want to rely on internal controls. Now you have to test the controls throughout the year. On the other hand, let us say, for example, you wanted to obtain evidence regarding inventory verification related control. You need not perform the test of controls for throughout the year. You can perform test of controls only at that particular point of time. Whenever inventory verification has taken place, only at that point of time, test of controls, if you do, it will be enough. As simple as that. Nothing complicated, my dear students. Only sentences and paragraphs are complicated. So if you want to rely on the internal controls throughout the period, you have to perform test of controls throughout the period of audit. On the other hand, if you want to rely on internal controls for only one particular point of time, like for inventory verification, it will happen only once in a year. At that point of time, if you verify internal controls, it will be enough. That's what even they try to clarify it in the second point. Audit evidence pertaining only to a point in time may be sufficient for the auditor's purpose. For example, if you are testing internal controls over entities inventory verification, you need not verify that controls throughout the period. Only at one point of time, if you verify that effectiveness, it will be fine. Next, if on the other hand, the auditor intends to rely on a control over a period of time, tests that are capable of providing audit evidence that the control has operated effectively at all relevant times during that period are appropriate. That means if you want to rely on internal controls over a period of time, now you have to obtain audit evidence that whether that controls are operating effectively throughout the period. So if I want to rely on internal controls for throughout the 12 months of sales data, now I have to take samples in every month to make sure that control is operating effectively in each and every month. Are you able to get it what I'm trying to say? So if you want to rely on controls over a period of time, you have to test whether control is operating effectively throughout that period or not. Like as I was saying, if you want to rely on sales related internal control for all the 12 months, then for every month you have to take a sample of transactions. You have to check in every month the control has operated effectively or not. Samples you have to take in every month. Understood? So very simple, guys. One simple point they say, the auditor can rely on internal controls. The auditor can perform test of controls either at one point of time or throughout the period of the audit. That all depends on how auditor intends to rely on internal control. If the auditor intends to rely on internal controls throughout a period, you have to perform test of controls for over the period of time. On the other hand, if the auditor wants to rely on control only at one particular point of time, like physical verification, you have to perform test of controls for only that one particular point of time. That's it. Nothing much here. Now, using audit evidence obtained in the previous audits. This is also one such important area. See, sometimes what will happen is, let us say, for example, for the financial year 24-25, there is a client X Limited. For this client X Limited, I have been appointed as a company auditor. But what is the reality here is, in the last year 23-24 also, for the same company X Limited, the same person, let us call him Mr. A. The same person, Mr. A, has audited even the audit of the last financial year also. Now, in the last financial year also, he might have verified internal controls. That is, he might have performed compliance procedures or test of controls. Yes or no? So, in the last year, when you have performed audit procedures regarding compliance procedures or test of controls, you would have already obtained audit evidence regarding operating effectiveness of internal controls. Sir, whatever evidence I have obtained regarding operating effectiveness of internal controls in the last year, can I use that evidence for the current year? Instead of doing the internal control verification once again, can I use whatever evidence I have got in the previous audit regarding the operating effectiveness of internal control? Can I use it in the current year also? The standard says yes, but with some restrictions. Yes, you can use even the audit evidence, whatever you have obtained from the previous year, but subject to some restrictions, subject to some conditions. In some cases, there might be a few cases where you should not rely on only past year audit evidences. You might have to perform the audit procedures afresh. In some cases, you need not perform new compliance procedures. You can rely on the past evidence. So whether you can rely on the past evidence or you can't rely on the past evidence, that decision has to be taken by the auditor. Sir, how auditor will take the decision? As we all are aware, the weapon of the auditor we have, the auditor has to use his professional judgment. But while exercising that professional judgment, he will consider various factors. So what factors auditor will consider in taking that decision, whether to rely on the previous year's audit evidences or not? So if you see here, in determining whether it is appropriate to use audit evidence about the operating effectiveness of controls obtained in the previous audits, and if so, length of the time that may elapse before retesting a control, the auditor shall consider the following. So definitely you will see, definitely you will consider what is the length of the time which has passed from last time you have done the verification till now, how much time has elapsed, that you have to consider one factor. But in addition to all that, you should also consider some extra factors in determining whether you can use the evidence of the past year. Sir, what are that factors I have to consider? Number one, effectiveness of other elements of the internal control. See, if you remember the discussion, the risk assessment and internal control, we have various elements of internal control. 5 elements we have: control environment, we have risk assessment, we have control activities, we have monitoring, we have, so like that internal control components we have. If whether there is any change, if before you take a decision whether I can rely on the previous year audit evidence or not, first you have to check, is there any change in the elements of the internal control? Last year the board of directors are very good people, honest people, but in the current year what happened is, in the board of directors some old directors are removed, new directors have come, they are dishonest, entire control environment has changed, or company's risk assessment has changed. Last year company used to do good monitoring, but in the current year they are not focusing on monitoring of the controls. If that has happened, it might not be suitable for you to rely on past year's evidence. You have to perform fresh audit procedures, because because components of internal controls might undergo change. So first factor which you have to consider is definitely whether effectiveness of the other elements of internal controls like control environment, monitoring, risk assessment processes. So when compared with the last year, in the current year, has any of the components of internal control undergone some changes? Next, the risk arising from the characteristics of the control, whether it is manual or automated. See, if it is an automated control, if the programming is all done correctly, if it is a completely automated control, you can rely on the past year's audit. Why? Because automated controls are already coded. Unless a program code has been changed, the control will work effectively. But in the case of manual controls, you can't rely on past year's evidences. Why? Because manual controls might undergo some changes. They are not coded, no. Let us say, for example, last year finance manager was different. Current year finance manager is different. There is some manual control. Let us say, for example, the company is having a system that each and every voucher should be signed by the manager. Last year, the manager was different. In the current year, the manager was different. Since it is a change in the manpower, there could be a possibility that in the current year, the control might not work effectively. So like this, one more factor which you have to consider while deciding whether you can use the past evidence or not is considering the characteristics of the control. That means whether it is a manual control or it is an automated control. It also depends on overall effectiveness of general IT controls. Nothing but if the company is relying on information technology, when compared with the last year, in the current year, does the overall general IT controls has undergone some changes? If overall general IT controls has undergone some changes, definitely you can't rely on the past evidence. See, what is general IT control, what is application control, all these things we have covered in the audit in an automated environment. Next, it also depends on effectiveness of the control and its application by the entity, including the nature and extent of deviations in the application of the controls noted in the previous year. Last year you have done the audit. Last year you performed compliance procedures, but in the last year you found out so many deviations. In those cases, you can't simply rely on the past year evidence. Current year you have to verify once again. Might be more number of deviations, you could find it out. And also whether there have been any personal changes that significantly affect the application when compared with the last year. In the current year, has the manpower changes happened? Has the personnel changed who are implementing internal controls? That also will affect. Whether a lack of change in a particular control poses a risk due to changing circumstances. Sometimes what will happen is control will remain the same, but business conditions might change. When compared with the last year, in the current year, your client's business condition, your client's environment, some things have changed, but the client did not update their internal control. So whatever control that has worked effectively in the last year, that might not work effectively now because conditions of the business might have changed. So that factor also you have to consider. And the risk of material misstatement and the extent of reliance when compared with the last year. In the current year, is there any extra risk of material misstatement? Then also you can't rely on the previous year audit evidences. So these are all the factors which auditor has to consider while determining whether you can rely on the previous year's audit evidences or not. So definitely one thing which you have to consider, what is the length of the time that has elapsed from the last verification. In addition to that, these are all the factors you have to consider: effectiveness of the elements of internal control, risk arising from the characteristics of the control, that is whether it is manual or automated, overall effectiveness of the general IT controls, effectiveness of the control and its application, and whether there are deviations identified in the previous year or there are any personal changes. Sometimes change might not have been made in the control, then also you might be required to do a fresh compliance procedures. And also risk of material misstatement when compared with the last year. Then one more concluding statement they say here: if the auditor plans to use audit evidence from a previous period about operating effectiveness of specific controls, the auditor shall establish continuing relevance of that evidence by obtaining audit evidence whether significant changes in those controls have occurred subsequent to the previous audit. So particularly if you want to rely on the audit evidence from the previous audits, you have to be very careful when compared with the last year. In the current year, have they made any significant changes? When compared with the last year, in the current year, if the controls have undergone significant changes, you can't rely on the previous year audit evidences. You have to perform the audit procedures afresh now. So that's what they try to say. Simple general statement only. So if the auditor plans to use audit evidence from a previous audit regarding regarding operating effectiveness of specific controls, auditor shall establish continuing relevance of that evidence by obtaining audit evidence about whether significant changes in those controls have occurred. If significant changes have occurred, you can't rely on previous year's audit evidence. You have to perform the compliance procedures afresh. Next. So finally, what will happen, sir? Till now, what paragraphs we have seen? So first we have seen objective. Second, whether you will perform compliance procedures or not. In case if you have decided how you will perform the compliance procedures, nature and extent, then how much time you will spend on performing the compliance procedures, then whether you will use the audit evidence in the previous year regarding the compliance procedures. Now finally, after you have performed all the test of controls, depending on whatever evidence you have got, finally you have to do the evaluation. Finally, you have to arrive at a conclusion whether controls are working effectively or not. That evaluation we have to do. No, that is the whole purpose of performing the compliance procedures. So once you perform the test of controls on the basis of whatever evidence you have gathered, now you have to finally evaluate whether controls are working effectively or not. That is what the whole objective. So let us see what evaluation we are required to do. So when evaluating operating effectiveness of relevant controls, auditor shall evaluate whether misstatements have been detected by substantive procedures indicating that controls are not working effectively. See, sometimes what will happen is initially we performed compliance procedures, we felt that controls are working effectively. But later, when you perform substantive audit procedures, you are finding out so many misstatements. Now, these misstatements will give a hint that maybe you are unable to identify some weaknesses in internal controls. So you have to remain alert while performing, after you have performed substantive audit procedures. If you found out any misstatements, are those misstatements detecting that controls are not working effectively? So you have to remain cautious about it. So sometimes we perform compliance procedures, we might arrive at a conclusion that controls are working effectively. Might be those errors might not have come in our sample. That's why we concluded that compliance procedures are working effectively. But later, when you have performed substantive audit procedures, if you found out misstatements, you analyze whether my understanding, whether my conclusion from the compliance procedures is correct or not. Next, some general statements they say important for MCQs. Let us see what they say here. The absence of misstatements detected by substantive procedures, however, does not provide audit evidence that controls tested are effective. Very important statement. See, you performed compliance procedures. Thereafter, you perform substantive audit procedures. In the substantive audit process, if you did not find any material misstatement, is that a guarantee that controls are all effective? No, my dear students, don't fall under that wrong perception. If you are unable to find out a material misstatement in the substantive audit procedures, there is no guarantee that controls are effective. Why? Because there might be a misstatement in the financial statements, but since you have verified the transactions on sampling basis, those mistakes might not have come into your sample. Okay, so very general statement. If there is any absence of misstatement by performing substantive audit procedures, however, it does not provide complete audit evidence that controls are working effectively. Might be there are misstatements in the financial statements which might not have got into your sample. That's why you are unable to find it out. So you should always maintain professional skepticism. Don't accept anything blindly. That's what they try to say here. Next, they say one more statement here. However, if a material misstatement is detected by the auditor's procedures, it is a strong indicator that there is a significant deficiency in internal control. So if you don't find any material misstatement, don't jump to the conclusion that controls are effective. But on the other hand, if you perform substantive audit procedures and if you find a material misstatement, there is a strong indication that there might be a significant deficiency in internal control. Why? Because by performing substantive procedures, even by verifying the transactions on sampling basis itself, if you are able to find out misstatement, might be if you do 100% verification, there might be more errors. There might be a chance that there might be a very much bigger deficiency in the internal control system. So these two statements are very important for true or false statements. So just remember, if there is any absence of internal control, absence of misstatement in the substantive audit procedures, that doesn't provide evidence that controls are effective. On the other hand, if you are finding a material misstatement in the substantive audit procedures, there is a clear indication that there is a significant deficiency in the internal control system. Understood? Next. One more. Last two paragraphs we have. Very simple paragraphs only. Specific inquiries by the auditor when deviations from the controls are detected. So let us say, for example, you performed all your test of controls. By performing all the test of controls, you have decided, you got to know that, okay, controls are not working effectively. You found some deviations in the internal controls. After you are done with your compliance procedures, on the basis of your evidence, on the basis of the information, whatever you have gathered, you have concluded that yes, controls are containing deviations. There are some defects in the internal control. So when you got to know that there are deviations in the internal control system, or when you have detected some deviations in the internal control system, there are some matters which are required to specifically inquire. So what are that specific inquiries which as an auditor you are required to do when you found out deviations in the internal controls? Let us see what are they. So when deviations from controls upon which the auditor intends to rely are detected, so whatever controls you want to rely, in that controls itself you are able to find some detection, the auditor shall make specific inquiries to understand these matters. So what are that deviations, why they have occurred, you have to understand. And what will be their potential consequences because of these deviations, because of these weaknesses in the internal control, what will be the possible outcomes. And also shall determine, and you should also determine the test of controls that have been performed, are they appropriate for relying on internal controls, or do you need to perform additional test of controls? That is what they say in the second point. You perform compliance procedures. By performing that compliance procedures itself, you have found out some deviations. Now you will get in dilemma, no? So you have to ask yourself, okay, whatever test of controls I have performed, will it be appropriate for me, or is there any need to perform additional test of controls? And also, what will be the potential risk of material misstatement that need to be addressed regarding substantive audit procedures? So I performed compliance procedures. From that, I have found out detections. Now, what impact it will have on my substantive audit procedures? That potential risk of material misstatement, you have to address it by using substantive audit procedures. Simply, if I have to put it, if you found out that controls are defective, then you have to increase your substantive audit procedures to address that risk. More substantive audit procedures you have to perform to address that risk of material misstatement. So very simple. if whatever controls you want to rely in that, if you are able to find any defects, you need to do specific inquiries. What specific inquiries we have to do? Whatever test of controls you have done, is it appropriate? Is there any requirement to perform additional test of controls? And also try to address that risk of material misstatement by increasing your substantive audit procedures. And one more important statement here: irrespective of assessed risk of material misstatement, the auditor shall design and perform substantive audit procedures for each material class of transactions and account balances and disclosures. So, what does this statement say is, let us say, for example, while performing risk assessment procedures, I felt that in the area of sales, there is low risk of material misstatement. Just because I have concluded that there is a low risk of material misstatement in the area of sales, can I altogether ignore that sales area from performing substantive audit procedures? Can I skip altogether substantive audit procedures in the area of sales? No. If you want, you can reduce your substantive audit procedures, but you can't altogether skip the substantive audit procedures just because risk is low. So even though risk is low, but that item is a material item, either it could be an account balance, P&L item, or that could be a disclosure. Even though you find the risk as very, very low, irrespective of the risk, for every material class of transaction, account balance, and disclosure, you have to perform substantive audit procedures. Maybe what you can do is, if you found the risk as low, you can reduce your substantive audit procedures, but you can't completely eliminate the substantive audit procedures. So that's what they try to say it here. Once again, important for MCQs. This requirement reflects the fact, sir, why they are saying, irrespective of the risk, why they are asking me to perform substantive procedures in every material area. Why? Because the auditor's assessment of risk is judgmental. You are not making exact or precise measurement of risk. Whatever risk you have expected as high, whatever risk you have expected as low, that is purely your judgment. That is not 100% fact. It is a purely your judgment. Your judgment can go wrong also. So since auditor's assessment of risk is judgmental, and so he may not identify all risk. Sometimes there might be a risk, but you might not have identified. So that's why, just because there is no risk, don't skip any area from performing audit procedures. And also there are inherent limitations on internal controls. So sometimes even this concept also we have discussed in the risk assessment. See, when you look at the controls all might look very effective. But even though no matter how effectively the controls might look, these internal controls always suffer from some inherent limitations which are unavoidable in nature, which can make the control fail. So recognizing this fact, which fact they have recognized, that assessment of risk is judgmental and there are inherent limitations. So for internal control. So that's why, irrespective of assessed risk of material misstatement, you need to perform substantive audit procedures for each material class of transaction, account balances, and disclosure. Then finally, one more further audit procedure. So once again, guys, if you remember, so when I say further audit procedure, first we'll perform compliance procedures. No, after performing compliance procedures, we have to perform substantive audit procedures also. So now they are talking about substantive audit procedures. Till now they spoke about compliance procedures. Now they are talking about the substantive audit procedures. But if you remember, when I say substantive audit procedures, you can perform it either by way of test of details also, or you can perform it by way of analytical procedures also. Sir, what will happen in the test of details? In the test of details, we try to check the supporting documents, whereas in the case of analytical procedures, we try to study the relationship. So when you felt that risk as low and when you felt that controls are very effective, there you can take the chance of performing only analytical procedures. On the other hand, if you felt that risk is very high, controls are not operating effectively, then studying the relationship alone will not be enough. You have to perform test of details there. In some cases, you might try to perform combination of test of details and analytical procedures. So what you are supposed to do, that is purely auditor's professional judgment. So for performing substantive audit procedures, whether you will perform analytical procedures or you will rely on test of details or you will use a combination of both, that is something which auditor has to decide depending on the risk and effectiveness of internal controls. So that's what they say. Depending on the circumstances, the auditor may determine that performing substantive analytical procedures alone will be sufficient to reduce the audit risk to an acceptably low level. In some cases, auditor might take a call that I will perform only analytical procedures. Generally, when he will do is when the auditor's assessment of risk is supported by audit evidence from test of controls. That means when you feel that risk of material misstatement is low and controls are also working effectively, then you can take a call, okay, I will perform only analytical procedures. And in some cases, he might take a decision that I will rely only on test of details. I will not perform analytical procedures. And in most cases, what generally auditors will do is they will perform combination of substantive analytical procedures and also test of details. In most of the cases, auditor will use a combination. Because the assessment of risk of material misstatement takes account of internal control, extent of substantive procedures may be increased when the results from test or controls are unsatisfactory. This is a truth. This is a fact which we know it from a very long period of time. if you performed compliance procedures, and if you got unsatisfactory responses that controls are not working effectively, when you get non-satisfactory responses from the compliance procedures, you have to increase your substantive audit procedures. Next, in designing test of details, the extent of testing is ordinarily through in terms of sample size. So when you're doing test of details, that is when you're checking supporting documents, we try to decide the extent on the basis of sample size. So when I say I'm performing more extent of test of details, which means what? I'm going for bigger sample size. When I want to perform less test of details, I will go for small sample size. So that's what they say in designing test of details. The extent of testing is ordinarily in terms of sample size. Higher the sample size, more will be the verification. However, other matters are also relevant, like whether it is more effective to use selective means of testing. In some cases, what we will do is we will not go for sample size and all. We'll do some selective testing, like whatever sales which are more than 10 lakhs, I will do 100% verification. Whatever purchase which are made only in the month of March, that I will do 100% verification. So like that, you can do selective testing also. So how you will do the extent of testing? Mainly in terms of sample size, and in some cases, some selective testing also we can do it. So that's all, my dear students. This is what the standard SA 330 is all about. So what and all we have understood? Objective of the standard we have understood. And then we have understood when you will perform test of controls, what will be the nature and extent of test of controls, what will be the timing of the test of controls, and whether you can use the evidence you have obtained in the previous year audits or not, and how you will evaluate whether controls are working effectively. In case if you have detected any deficiencies, how you will make specific inquiries, and what kind of substantive audit procedures you have to perform. That's all, my dear students. I have given you good conceptual clarity. Now, after my explanation, you start reading the standard. It will feel like a cakewalk. It will be very easy. So bye everyone. Take care. All the very best for your exams.